and it's down 90% year to date. Gene therapy is this new and very promising thing. Duchenne muscular dystrophy eventually kills anyone who has it. But there were 2 deaths that was very concerning. It was related to liver disease. There was the 3rd death with a man in his 50s. It was not the same gene therapy. This was being used for someone who was non-ambulatory, who had already gotten to that point. But the company didn't disclose clearly what had happened with it. I think last Wednesday when it first talked about it, there's a lot of questions that have been swirling around it. But gene therapy still holds a huge amount of promise, and there have been some very successful ones. The toxicity is always an issue, but again, you are also dealing with people who are dealing with a fatal disease. So lots of things that need to be dug into and need to be taken a look at surrounding all of this too. In the meantime, a report says that Berkshire Hathaway-owned railroad BNSF is working with Goldman Sachs and looking into a takeover of a rival railroad. That's according to Semaphore as well. The site says that it's unclear if BNSF is considering buying Norfolk Southern or CSX. Reports last week said that Union Pacific has been looking into Norfolk Southern for a takeover. If that deal came together, it would create a railroad that spans the entire country and would leave BNSF at a disadvantage. The one thing I will say about this, not knowing anything about this report, not talking to anybody at Berkshire about it, it would be a very un-Berkshire thing to do, to go to an investment banker to try and figure out a deal. That's not been the way deals have been done in the past. They kind of shun investment bankers on these things. They seek their own advice. Again, I don't know anything about this. I don't know what BNSF is doing separately, but it's a very un-Berkshire-like move to say that you're going to bring an investment banker to tell you your options, because Warren Buffett has always known all of his options on his own and has never really been keen on having a banker advise him on what to do.
Yeah, when I read this, I thought maybe they were that Goldman might be trying to sell the other
railroad to
a Goldman Sachs, and then
to a Berkshire, to a BNSF.
Right, and then for a hot minute, I thought, well, there's going to be a new CEO in town running the place. Maybe he'll use bankers in the future. I don't know.
I would be surprised if that is the case right here. I think you may be onto something if the bankers are like, hey, we have a deal and we're shopping it around type of thing. But I cannot imagine Berkshire or a Berkshire major unit saying, hey, help me think through my strategic options on this. That was the only thing that it stuck out to me.
I 100% agree. Meantime, a new congressional budget office report saying that President Trump's tax and spending bill will add $3.4 trillion to the national debt over the next decade and will increase the number of people without health insurance by 10 million people by 2034. The nonpartisan CBO taking a final look at the legislation after it narrowly cleared the House and Senate, and Trump signed it on July 4th. The analysis said the law will result in $1.1 trillion of net spending cuts. It will also decrease federal revenue by $4.5 trillion compared to if the measure had not passed. Of course, there's lots of debate over the math and how they approach it, but
whether you take growth into account with GDP.
It's a big question about what the GDP number is, meaning if you believe the GDP is going to be 2.8, 2.7%, which is what the Trump administration has said, or if you believe what the CBO believes, which is that it's closer to 1.8. That's a huge delta.
It is. AstraZeneca said that it plans to invest $50 billion in the United States before the year 2030. The company said that the investment would go toward manufacturing and research and development. At an event last night in Washington, Trump administration economist Kevin Hassett said that AstraZeneca's commitment would mean that substantially all of the company's pharmaceuticals sold in the United States would be produced in the United States. European drug makers have been touting their U.S. investments to try to mitigate the impact of tariffs from President Trump. Since April, European drug makers, including Novartis, Roche, and Sanofi, have announced investments in the United States of at least $20 billion apiece. All right, when we come back, market technician Katie Stockton will join us on what she's seeing in the charts after the S&P 500 closed above 6,300 for the first time. Right now, as we head to a break, though, take a look at shares of Alphabet. They're up 9 straight sessions and about 9% over that period of time. If the stock closes higher today, that would tie the stock's longest ever streak to the upside. Right now, you see that stock at $190.58. Stay tuned. You're watching Squawk Box, and this is CNBC.
And make it count.
All right, welcome back, everybody. The S&P and the NASDAQ coming off record closes. For the S&P, yesterday was its first ever close over 6,300. Joining us right now with a technical look at the market is Katie Stockton. She's Fairlead Strategies founder and a CNBC contributor. And Katie, what do you think? 6,300, closing above that, but it's been a pretty steady march higher for these markets. People wondering if they're overbought or if you think this momentum can.
Yeah, I would even argue that it's been remarkably strong. I mean, we've had barely a pullback since May into June. And I think things changed towards late June when we saw this gap up, and then we saw a bit of a melt up into the end of the second quarter. And that's when we saw breakouts start to unfold. And breakouts are something that tend to foster additional upside momentum. Mm-hmm. We did see a breakout by the S&P 500. It confirmed that breakout, meaning it held above there for a couple of weeks. And that breakout allows for a pretty impressive measured move objective of about 68.80. that would be not relevant likely for this
68,
year.
80 by, oh, not by the end of this year.
Yeah, it would be more of a 2026 type of objective based on the current trajectory of the trend. Now you have to imagine it's not going to be a straight path up to that point. And I will say that, there are overbought indications. So far, those indications haven't been all that meaningful. And the loss of momentum that we have seen, especially relative to the early stages of the move off the April low, has just really not made a difference, right? So there just feels like this underlying bid to the market. What I think could change that, and only temporarily because we have the breakout confirmed, are mega cap earnings, right? So these mega cap stocks are coming into earnings really, I'd say, coming in hot, right? They have very strong upside momentum for the most part and look pretty overstretched. And so that creates, in my opinion, more of a proof point for them as they come into those reports.
I mean, you better hit your numbers and say something the street likes, otherwise you could see a sell-off.
That's right. And honestly, a sell-off would be pretty healthy in the big scheme of things because it presses the reset button on the uptrends.
So you would feel better if there was actually a reset.
I think so, because it helps the trend not get too steep. Because what happens when you get a very steep uptrend, and arguably we're getting kind of close to that, is that the way it's sort of resolved is in pretty dramatic fashion. So we want sort of that orderly stair-stepping higher, and that would suggest that we could use a pullback to sort of normalize the slope of the uptrend. We have some indications of that, but they're moderated by the fact that there are so many breakouts, and there is a breakout in breadth, meaning that we've seen rotation, even though the mega caps have been quite strong, we have seen rotation that's benefited other sectors of the market.
The sell-off that we're watching, if you look back to April, that was the day that Trump came out and announced the tariffs, and it caught the market off guard. I think since then, the market has figured, look, this is a negotiation, this is part of the art of the deal. We may see higher tariffs, but it's not going to be the highest numbers as advertised. And I realize you're a technician, not somebody who's looking at the headlines that come out along these ways, but how do you take those headlines and try and figure out what it means from a technical perspective?
It's a really interesting tape in that regard, in that there's top-down headline risk. It used to be that it just was individual sort of company headlines that we worried about. Now we have something much bigger than that. So I do care, of course. And it seems like August 1st is sort of a date with the tariff headlines that could change things. So we have these dates in mind. We can't predict it, of course. We can only react to it. So if we did see some kind of volatility-producing event, we will then judge the impact on our indicators, which right now are sort of more neutral short-term and have whipsawed more positive longer-term. If that changes, we're very willing to change with it. And that would, of course, be likely a response of the sentiment and its response to the tariffs.
Dare I ask you about crypto?
We have a breakout there as well. So we finally confirmed the breakout by Bitcoin above about 108,000. And that allowed for a pretty conservative measured move objective of 134, 135. Seems very reasonable based on the volatility that we've seen historically for Bitcoin. But what's interesting about this rally is that it has really expanded to the altcoins in a pretty meaningful way. And they had been previously out of favor in consolidation phases. And Ether, not only Ether, but names like Solana, these breakouts look pretty compelling to me. Almost even more so than Bitcoin at this time, sort of a risk-on move.
What's the upside? If you look at Ether, for example, we had a fellow on yesterday who's actually building an entire company around an Ether, almost treasury-like leveraged
heard
vehicle.
a number of them, but they all want to be like the micro-strategy of Ether.
Right. And so for Ether, the resistance is around 4,000, and it's a pretty big level. These are massive wide ranges in the altcoins. So if they do resolve to the upside, I think that would be a pretty major development within the cryptocurrency market. But it shows a spreading out, a breadth, if you will, within that space that is compelling. For Bitcoin, I'd still love to see some consolidation. It has a propensity to stair step higher. So usually you're well served to wait for that consolidation.
Can I ask you very quickly about the dollar? We're about out of time, but
of course,
that's been one people have watched. So
the downtrend has kept hold, right? But it watched the dollar index against its 50-day moving average. If we were to see that cleared somewhat meaningfully, it would feel like we have at least a period of dollar strength in store. But for now, we want to respect the fact that that 50-day moving average and resistance is still intact. and that the longer term momentum is still to the downside, even though it's a little bit less so than it was previously.
Okay. Katie, thanks a lot.
Of course, good to see you here.
Always good to see you. Coming up, Congress questioning some of the biggest tech companies, including Microsoft, Alphabet, and Meta, about safety under the sea. We're going to explain what's going on and show you why this is becoming such an important topic. That's next, right here on Squawk.
Now.
Welcome back to Squawk Box this morning. Lawmakers trying to make sure that the heads of big tech companies are safeguarding the submarine cables that crisscross the globe and carry nearly all international internet traffic. Now, in a letter to the CEOs of Alphabet, Meta, Amazon, and Microsoft, 3 Republican House members on the China Select Committee raising concerns that entities affiliated with China are providing maintenance to cables in which the companies have ownership. Lawmakers have grown wary of potential Chinese or Russian interference with those cables. Later in the show, we're going to speak with China Select Committee ranking member Raja Krishnamurthy about all this, but it's become a big issue in tech about who's maintaining these cables, whether if somebody's down there fixing the cable, they can somehow get access to the cable, and then what they can do to siphon off information from the cable, but that's what's at issue here.
I wonder if satellites are safer as a result. No interference between here and there.
Until people are going up in space every other day to go fix the satellites.
Right.
Yeah.
All right, healthcare company Humana says that it is eliminating about a third of prior authorization requirements for outpatient services. The company says that by January 1st, it will roll out a faster, more streamlined process for approvals that will provide a decision within one business day for at least 95% of prior authorization requests. And it's launching a national gold card program that will waive prior authorization requirements for certain items, services, and providers who have a proven record of submitting coverage requests that meet medical criteria. Yay! Humana will also begin publicly reporting metrics on authorizations, including approvals, denials, and approved after appeal stats. Very interesting, especially after the conversation we had yesterday with the guy who's using AI, what is it, claimable, using AI to try and appeal any denials from insurance coverage that come through. This would be a welcome request. I think everybody's gotten caught up in that you submit an appeal or you submit an authorization, don't hear back, don't hear back, don't hear back, finally get denied. If you can speed some of that process up, that would be good.
But ultimately, it's going to be the bots fighting the bots,
Yes.
right?
Right. Builds a better mousetrap. This is same thing as the story before.
Right.
Continues to upgrade. But look, if you can help smooth this process along, make it better for the people who are sick, who are trying to get coverage, that would be great. When we come back, we're going to talk about the latest company getting the meme stock treatment up about 380% just since last Tuesday. We'll have that story for you next. You can see the mystery chart right there. Right now, though, as we head to a break, let's take a look at yesterday's S&P 500 winners and losers.
Itself to apply.
Good morning, everybody, and welcome back to Squawk Box. We're live from the NASDAQ market site in Times Square, and if you check out the futures this morning, it's a little bit of a mixed bag. Not massive moves one direction or the other, but the Dow is indicated up by about 33 points. NASDAQ indicated off by 40 points after closing at a record level yesterday. And the S&P 500, which closed above 6,300 for the first time yesterday, is flat this morning. Take a look at Treasuries and you'll see that the yields, at least at this point, are a little bit higher. The 30 years at 4.95, the 10 years at 4.39, and then you've got the 2-year at 3.86. And finally, energy prices this morning, if you check out WTI, down a little bit, off by close to 50 cents, $66.73 a barrel right now.
Meantime, shares of Open Door jumping 42% in yesterday's trading session that extended a one-week gain to more than 300%. It appears to be getting the meme stock treatment. Retail traders on social media have been buzzing about comments from hedge fund manager Eric Jackson, who's the founder of EMJ Capital. He made a series of posts on X encouraging buying and arguing the stock could go to $82. As Jackson gained prominence by taking a stake in Carvana after a 98% drop and was rewarded with a 1,000% gain back in 2023. Open Door listed as the most actively traded stock now on StockTwits yesterday. That's, of course, on Twitter, I should say X, was heavily discussed on Reddit's Wall Street Bets thread as well. According to S3 Partners, short interest in the stock is roughly 24% of the free float. Now, Open Door uses technology to buy and sell homes. Company's revenue and homes sold slid in the first quarter and it's racked up about $370 million in losses over the past year.
General Motors out with second quarter results, and Phil LeBeau joins us with those numbers right now. Good morning, Phil.
Good morning, Becky. Let's take a look at shares of General Motors under a little bit of pressure after posting a Q2 earnings that beat the street, also revenue better than expected, but that's really not the main thing that the investor community is focused on. It's really what's the impact of tariffs on margins. We'll talk about that in a bit. Earning $2.53 a share versus the street at $2.44. Revenue better than expected at $47.12 billion. The street was expecting $46.28 billion. Here's the story. You'd look at EBIT adjusted. The profit in the quarter, $3.04 billion versus $4.44 billion last year, down 31%. The EBIT adjusted margin, 6.4%. A year ago, it was 9.3%. This is where you see the impact of the margin or the tariffs that went into effect on April 2nd. Automotive free cash flow, $2.82 billion. A year ago, it was $5.3 billion. North American EBIT profit, $2.42 billion. A year ago, it was $4.43 billion. That North American margin, boy, it took a hit. 6.1% in the second quarter. A year ago, it was 10.9%. If there is good news, if you're an investor in General Motors and you're looking for something to say, wait, is there any bright spot out there? They have not changed their guidance. It remains the same as it was on May 1st. EBIT adjusted for the full year of between $10 and $12 billion. EPS in the range of $8.25 to $10 for the full year. And automotive free cash flow in the range of $7.5 to $10 billion. Lots to discuss with GM CFO Paul Jacobson. First on CNBC, that's coming up next hour, guys. And again, the focus here, it's not whether or not they beat the street. It's whether or not the impact on margins, which you clearly see here, down 45% in terms of EBIT, and then the margins they've just been cut down dramatically because of the tariffs. Is that the new normal? Is 6.4% margin the new normal versus 9.3%? That's going to be one of the first questions we have for Paul when we talk to him next hour.
You know, Phil, GM has been pretty clear about the idea that with this $5 billion headwind they're expecting from the tariffs, they could deal with about a third of it by taking care of stuff in-house, getting sharper. Yes. What happens to the rest of it? Can they put pressure on suppliers? Can they expect to pick up some of the rest of that in other places? How do they handle it?
They're clearly eating it right now, Becky. I mean, you look at this. I mean, that's the impact of margins. Your North American margin, I mean, let's be clear here. When it comes to General Motors, when it comes to Ford, North America is the profit driver. That's where it all happens. And because you have a 25% tariff on vehicles built in Canada and in Mexico, or in GM's case, or in Korea, and look, a lot of that can be offset, or not a lot, a certain amount can be offset because of USMCA and ways that the tariffs are written right now, but not all of it. And that's where you see the impact on margin, Becky. They have to eat it. 6.1% margin in North America versus 10.9% last year. I mean, that's the story right there. Now, the counter to that, you may have some people sit there and say, hey, look, in North America, you made $2.4 billion. You didn't die because of the tariffs, and you're still selling vehicles at an average transaction price that has not dropped. It's over $51,000. You are not raising your incentives to the same degree that some of your competitors are in North America. But if you're an investor, it's about margins. You guys know this. This is what we talk about all the time. And that's going to be the first question we're going to have for Paul. Look, they are offsetting some of this by adjusting production, making changes in headcount where appropriate. But at the same time, they're still building vehicles outside the United States, and they have to bring those into the United States. That's not changing. That is not changing. I mean, and that's at the heart of the debate. If you're an investor, okay, is this the new normal if I'm investing in General Motors?
Bill, thank you, and we will see you in just a little bit. We look forward to hearing more on it.
Coming up, what is next for cryptocurrency and stablecoins following the passage of the Genius Act? That's the question in the morning. We're going to speak with the former head of the Consumer Financial Protection Bureau about all of that. And a reminder, you can get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app. You can listen anytime. You can shoot your phone right at the screen right now and download it as we speak. We're coming right back. Welcome back to Squawk Box. The passage of the Genius Act to regulate stablecoins in this country was a big win for crypto firms, but our next guest warning that the legislation could increase Americans' trade deficit and hurt small American businesses. Joining us right now is Rohit Chopra. He's the former director of the Consumer Financial Protection Bureau. Tell us your litany or list of issues that you have with the Genius Act and what you think the true implication is.
Well, we all want there to be faster payments. We want there to be better innovation when it comes to paying people for services. But we also want those payments to be safe. We want, when there is a failure, for consumers and businesses to be able to be made whole. We also want to make sure that banks continue to have a reserve of deposits to be able to lend to Main Street businesses. And what we see in the Genius Act is essentially the creation of a new type of bank charter, a tokenized money market fund that I think will have some real implications that are far beyond crypto.
Give me some examples.
Well, I think you hear Scott Bessent talk about that he wants to stimulate trillions of dollars in demand for treasuries by having more US-based stablecoins. Where is that demand going to come from? In many cases, it will move from the commercial banking sector. That means that what money market funds issue, that's going to take away from some of the bank lending that is so critical to the economy. We also know that money laundering is a key part of the US's power as the reserve currency, using our sanctions to stop terrorism financing, to stop and respond to those countries that pose a threat to us is powerful. And anything we do to undermine that may actually be harmful to the power we have as the reserve currency.
Rohit, I looked through your list of concerns. I will admit some of this makes me a little uncomfortable. I want to see through it, but it just looked like you threw up a laundry list of 50 million things that could go wrong, including it's going to draw people from overseas, which will make the dollar stronger, and that's the opposite of what the Trump administration wants to do. I mean, I think all in all, the idea of getting more buyers into treasuries would be a good thing. It would be a good thing for the economy overall because it would keep rates down. It would allow more U.S. taxpayer dollars to go to things that matter instead of paying off interest. I mean, there's a lot of good things that could come out of that, too.
Well, we all talk about this, that yes, stimulating demand for treasuries can lower particularly our long-term borrowing costs. But really, where is that coming from? We want to think about where would those dollars be elsewhere. And in many cases, we see that it siphons money from commercial banks. And again, commercial banks continue to be a place where most farms, most businesses still continue to get credit. I also think, Becky, we want to make sure that digital technologies don't totally get hijacked by one or two or three players. The Genius Act does allow big tech companies to issue stable coins, use that as part of their business model, potentially track payments across their ecosystem. That's kind of what we see happening in China, and I would have liked to see much stronger protections when it comes to consumers and to our privacy. But look, this bill is passed. We are going to deal with some of the implications, and everyone needs to watch what the regulators are going to do to implement it. But unfortunately, many of the regulators, like the agency I ran, is essentially now a dead fish, not really doing anything to enforce the law. So I do think we have some real problems we're going to have to look out for.
Can I just go back to the Treasury issue for a second? There's an argument being made right now that actually the demand for Treasuries is about to get very interesting because of all of the folks who are going to end up ultimately having to buy Treasuries to back the stable coins, and that they could those buyers effectively could make up for whatever you think the lack of buying might be from China. Some people would say that's a good thing. Is that a good thing?
Well, we're all trying to look closely at what's happening in our treasury markets. It has such a huge impact also on our fiscal situation. But a lot of the predictions that people have been making about demand for treasuries are quite uncertain these days. And look, I do think we have to make sure that the country is on a sustainable fiscal path, that we have a way to keep the treasury markets liquid. I just think we have to make sure that where we are stimulating demand, we understand the consequences that if you're taking it out of banks or taking it out of other sources of financing, that could have some real crowding out and implications on the real economy in the US too.
Hey, Ray, let me ask you a separate question. There is a move afoot, and we talked to the head of the SEC yesterday about this, potentially to allow more private investments to be wrapped inside, if you will, 401ks. How do you feel about that?
Well, look, 401ks have been a real mixed bag from a policy perspective. We have an enormous amount of undersaving in retirement plans, but we also have very, very high fees. So I do think that while there are some ways that consumers, savers are able to get different exposures to different asset classes, it often leads to huge harvesting of fees for investments that people don't really understand. So I do think there's a lot we have to do to make sure that retirement savers have some access to plain vanilla products that over the long term are going to serve them well. We see study after study that shows those who simply put their retirement assets in a diversified portfolio end up beating most other savers.
Ray, what do you make of the viewer who's watching you now and who says, look, the only real way to make big money, the way a lot of the people that we talk about, the CEOs and entrepreneurs in this country have made big money, is to get into early stage private companies. They want access to things that sort of have a shoot the moon kind of approach to them. And that by preventing folks that maybe considered historically, quote, unaccredited, meaning people who are not already wealthy, that we're preventing people from having access to the American dream.
We've heard this argument a lot, and I think going back to even the gold rush, where people were often sold opportunities to make big money quickly. I want people to be able to invest in awesome businesses that can create a lot of good for our long-term economy. But I also, as you know, Andrew, I've seen a lot of scams, fraud, and abuse. And that's kind of why we need basic rules of the road that are actually enforced. I think one of the reasons the U.S. capital markets are some of the best in the world is because we have those rules, not because we constantly turn a blind eye.
Okay, great. Thank you. Appreciate it. Nice to see you. Meantime, we have some other news for you this morning because the defense contractor Northrop Grumman out with quarterly results. Earnings coming in at $8.15 a share, which includes, we should mention, a $1.04 earnings benefit from its previously announced training services divestiture. Now, that is on revenue of $10.4 billion. That topped expectations of $10 billion, which had been the estimate for analysts. Now, Northrop Grumman raising its full-year earnings guidance now to the range of $25 and $25.40 per share, also narrowing its sales guidance in the range of $42.05 billion to $42.25, and the stock up marginally on the back of that news. We'll keep an eye on it for you.
All right, when we come back, a reported 10-figure streaming deal for South Park coming just before its season premiere. We've got the details on that story next. And we're standing by for earnings from Coca-Cola. We'll bring you those as soon as we get them. Stay tuned. Squawk Box will be right back.
Welcome back to Squawk Box. Entertainment giant Paramount agreed to buy the global streaming rights for South Park to be shown on Paramount Plus. The deal values those rights at $300 million a year. It's according to the Los Angeles Times. It says that the 5-year streaming deal is worth $1.5 billion, and South Park's 27th season, I can't believe that, 27 seasons, premieres tomorrow. It had previously been pushed back amid some ongoing drama of Paramount's sales process to Skydance Media. So
It was supposed to be a $3 billion 10-year deal or
right,
something. And
it's been cut back down just a little bit, but
Skydance
still
said they wanted to be involved in those
negotiations.
Right. All right, when we come back, bank analyst Mike Mayo will join us on the Fed, regulations in the financial sector, much more. What he thinks about some of these banking stocks right now. Squawk Box will be right back.
Plus.
The Federal Reserve is hosting a major conference on bank regulation today in Washington. We'll be hearing from the Fed's Michelle Bowman in her first CNBC interview in the next hour about all of this. Right now, though, we're joined by Mike Mayo. He's a banking analyst with Wells Fargo, who's also attending and actually going to be speaking at this conference. And Mike, if I hear this, the evolution of the capital framework is your panel. This is the integrated review of the capital framework for large banks conference. That sounds like a giant dose of ambience, but you think that this is the biggest inflection point for the bank in decades. Explain.
Yeah, I think this is a big regulatory reset. I think this is the most positive change in bank regulation in 3 decades. And this is the first time there's been an event like this at the Fed. It has regulators, ex-regulators, academics, and investors like myself. And everybody agrees to keep banks safe and sound. But having said that, I think the goal is to cut as much bureaucracy and red tape as possible. So here's my visual, Becky. This is the goal. Cut the red tape. And it's not always as easy as you think it is. But once they do that, then banks can be a lot more efficient, and hopefully they have more capacity to make more loans. The Treasury Secretary was at a dinner last night with this whole group, along with the Fed chairman, and the goal still is to delever the public sector, relever the private sector using banks, which have been marginalized too much. So I think this is a very positive event. You're seeing the direction of travel when it comes to banks and changes after 15 years since regulations have been piled on since the global financial crisis. Thank you regulators for the first 5 years after the global financial crisis. They did a great job. But I think the 10 years since then, it's already mission accomplished. It's become too burdensome. And I think a healthy debate is what to expect for today.
All right, this is really interesting because we just spoke with Rohit Chopra, the former head of the CFPB, who thinks that the stablecoin, the Genius Act, is going to be a big problem because by soaking up funds that would have otherwise gone to the banks, by soaking up those funds, maybe taking them into treasuries, that's going to eat away at the bank's abilities to loan. You think this is something that will ease up and allow the banks to loan a lot more without putting us in a perilous position? Nobody wants to see a repeat of the financial crisis, but you're right, if there's too much regulatory red tape, it holds back the economy. It keeps the banks from lending what they could and should be doing to small businesses, to consumers, and the like.
Yeah, in my view, there's no question that regulation now, the pendulum has swung too far, and it's too confusing, too constraining, and too costly. We did a proprietary survey at Wells Fargo in our equity research group, and 9 out of 10 investors find their capital rules too confusing. These are some of the most sophisticated investors around. And if they don't understand it, do you really think all the bank executives understand it? You think, especially the bank boards, you need to make regulation more understandable for it to be useful. And by the way, the next crisis is not going to be like the last crisis. So you need to have a more dynamic regulatory environment instead of simply repeating the global financial crisis scenario, year in and year out. Whatever's going to hurt the banks in the future, it's probably not going to be, mortgages or what we've seen in the past.
What do you think it will be in the future? Only because Jamie Dimon has raised some issues about whether it's private credit. Where do you think the next potential buildups, the next potential bombs are in the financial system?
Well, a lot of people like to mention private credit, which has grown 5 to 10 times since the global financial crisis. And when I worked at the Fed 35 years ago here in Washington, D.C., the adage was, if it grows like a weed, maybe it is a weed. Now, private credit might not be a systemic risk, but there are a lot of concerns about the procyclicality of private credit. In a recession, are the private credit lenders really going to step up? Possibly not. So it could exacerbate a downturn. So I think that's the more possible risk.
Mike, on terms of the private credit piece of this, you questioned Jamie Dimon about his interest in being in the private credit business. How do you think about banks entering that space? How do you think about the leverage that does exist in it? So there are private credit funds that are duration matched, 10-year money in, 10-year loan out. That makes a lot of sense. But there's some that have added a whole component of leverage to that. And I don't know if we fully all understand, who effectively is on the hook when it's over, if the music stops.
Well, what is one area that's grown at the banks. One reason why I'm so bullish on the banks right now is because you've had 15 years of de-risking in the banks. Capital is about double. Liquid assets are about double. Banks have de-risked their customer base. But one area that has grown is the lending to the non-bank financials, such as private credit. I'll tell you, as an investor, I don't have enough data on that. I will say a lot of these loans are much more well secured, though. And there may be some regulatory arbitrage here. Instead of lending to the companies directly, they lend to the private credit firms where the loans are more secure. But I'd say we need more data on that.
Mike, we're out of time, but your first, second, and third stock picks, all the same name.
As I said on your show last year, and I think you kind of rolled your eyes at the time, but it's Citigroup. Citigroup's restructuring. This is their 13th. The prior 12 failed. The 13th is going to be Citigroup's lucky number, and they're also a tariff beneficiary.
The stock up 43% for the 1 year, and I think it's up 31% year to date, so it is a very smart call. Mike, thanks for joining us.
Sure, thanks for having me.
It is just past 7 a.m. right now on the East Coast. You're watching Squawk Box right here on CNBC. I'm Andrew Ross Sorkin along with Becky Quick. Joe is off today. Got a lot of big stories to tell you about, though. OpenAI now entering into an agreement with Oracle to develop 4.5 gigawatts of additional Stargate data center capacity. That new capacity, combined with an existing site in Central Texas, will mean more than 5 gigawatts of capacity under development. And we should mention that news follows a report from the Wall Street Journal claiming that Stargate is having some trouble moving into high gear and scaling back some near-term plans. Meantime, Goldman Sachs in search of a deal. Semaphore reporting that the company's CEO, David Solomon, held takeover talks with asset and wealth manager Northern Trust earlier this year and got close to making a $6 billion deal for that money manager, or I should say for money manager Cliffwater. Cliffwater talks said to have fallen apart over price. Others have looked at Northern Trust too, including Bank of New York Mellon. A new congressional budget office report saying that President Trump's tax and spending bill will add $3.4 trillion to the national debt over the next decade. The nonpartisan CBO taking a final look at the legislation after the president signed it into law on July 4th. The analysis saying the law will result in $1.1 trillion of net spending cuts. And Coca-Cola out with quarterly results. Its earnings coming in at 87 cents a share. That's 4 cents better than estimates. It's on revenue of $12.6 billion, also ahead of expectations. Now, global unit case volume slipping 1%, dragged down by declines in Mexico, India, and Thailand. Coke expecting earnings growth of about 3% for the full year versus estimates of 3.2%. It's also affirming its organic revenue growth outlook in the range, they're saying, of 5 to 6%. And you don't want to miss an interview a little bit later today with Coca-Cola CEO James Quincy. That's going to happen with the gang on Squawk on the Street at 10 a.m. Eastern Time this morning. Meantime, take a look at futures. We are looking at some red on the screen. The Dow off about 78 points. The NASDAQ down about 22 points. The S&P 500 powering just marginally higher, about 2.5 points higher. Want to get straight over to Dom Chu, who's got a look at this morning's pre-market movers. What's on tap?
All right, good morning, Andrew. Good morning, Becky. We're going to start with a check on some of the biggest cruise line operators out there. We're talking Royal Caribbean, Carnival Cruise Lines, Norwegian. They're all higher here. You can see fractionally so after being initiated at a buy rating by TD Cowen. Those analysts are saying that cruise lines offer a unique and accessible experience with a strong value proposition, and they're pleased with some of the improving margins in the industry. So those shares moving higher on the day. Also, shares of NXP Semiconductor down more than 5.75% after the chip maker reported lower second quarter profits as revenue fell 6%. The company expects sales to decline again this quarter, hurt by a sluggish auto market, which accounts for more than half of NXPI's revenue. So those shares down about 5 to 6% at this point. Next up are shares of Medpace Holdings, soaring more than, at this point, 45%. After the clinical research company reported better than expected second quarter profits and raised its full year outlook. The company said that net new business awards came in around $620 million and a 12.5% climb from the prior year. Those shares are now positive on a year-to-date basis. You can see there just because of today's move. So Medpace Holdings, a key stock. And we'll finish with shares of Shopify, which are down just about 2.25% right now on a downgrade to hold from buy over at Loop Capital Markets. Those analysts there are concerned about valuations, with the stock trading at almost 15 times their 2025 revenue estimate. Loop says that the Shopify remains one of the most compelling long-term fundamental stories, and it is cementing its position as the dominant online retail operating system and infrastructure platform. So keep an eye on Shopify. Now, for more on that and other top analyst calls of the day, just head over to cnbc.com/pro. Subscribers, as always, get all the access to detail behind those big calls and upgrades and downgrades, Andrew, of the day. So keep it on Shopify. I'll send things back over to you guys.
Tom Chu, thank you, sir.
Sure.
All right, as we head to a break right now, let's take a look at shares of GM. The automaker reporting results just within the last hour, beating the street on both the top and the bottom lines, but the margins getting squeezed. The big reason are the tariffs that the company is dealing with right now. That stock down by about 4%. GM CFO Paul Jacobson will join us first on CNBC to break down those results. That's right here when Squawk Box returns. Let's get to Phil LeBeau and his special guest, GM CFO Paul Jacobson. Phil, good morning again.
Good morning, Becky. Paul, thank you for joining us today from General Motors headquarters in Detroit. Let's get right to the matter that everybody's discussing when they look at your earnings results. Yes, you beat the street on the top and the bottom line, but your earnings tumbled about 25% year over year. How much of that is due to the tariffs that were put into effect in early April?
Well, good morning, Phil and team. Thanks so much for having us today. It's a beautiful day here in Michigan, and we're pleased to report another quarter of, I think, strong momentum that we've seen. Tariffs are obviously a big story for us, as we've seen throughout the quarter. They impacted our quarter by about $1 billion, $1.1 billion, in line with our expectations that we laid out earlier in the quarter when we talked about a $4 to $5 billion impact for the year. So we're in a bit of an adjustment phase right now, but I think the team is really firing on all cylinders right now.
Your margins, they dropped overall 6.4% compared to 9.3% a year ago. But North America, that's really the profit driver for you guys. Your North American margin, 6.1% versus 10.9%. Is this the new normal? If you're an investor in GM, is this the new normal in terms of the margin range to expect because of the tariffs that do not appear to be going away?
Well, actually, what we expect is this was going to probably be the peak of the tariff impact for us. While we experienced a little bit of timing pushback from some of the indirect tariffs that we will see later in this year, we'll begin to work in the 30% offsets that we've talked about. So we've uncovered a number of initiatives. We've been working on these really since the beginning of the year, really into the end of last year. Those 30% offsets will start rolling in the back half of the year, and we actually expect the margin impact to be lessened from the tariffs. It was about 300 basis points this quarter, which explains the bulk of the difference between margins last year and where we were in this quarter. But I think we've got a path to begin to mitigate some of that in the short run. And then longer term, many of the manufacturing announcements that we made earlier in the quarter about onshoring production here into the U.S. with $4 billion of capital initiatives are going to have an effect as we get 18 to 24 months down the road. So we've got a good plan in place, and in the meantime, we're continuing to generate strong cash flow and investing in our great suite of products.
What about Korea in terms of you import a number of vehicles that are built there, highly successful vehicles that are in demand. If there cannot be a trade agreement worked out with Korea and we see the tariffs staying in place, who knows at what percentage, but staying in place, do you keep production where it's at there, or do you look at some of that being onshored as well over the next couple of years?
Yeah, Phil, we haven't made any long-term decisions about Korea yet, mainly because there is a lot of uncertainty about that. What we said is that with the current tariffs in place, the vehicles that are coming over are still contribution margin positive. So what we want to do is make sure that we keep that flow going for our customers. As you mentioned, that vehicle is in strong demand. We've seen it particularly on the lower end of the pricing curve. It's a great vehicle for our customers. So we want to keep that coming. Obviously, we're watching very closely the trade discussions. We're optimistic that the U.S. and Korea can find common ground. We know the auto industry is important to both sides in those conversations. So we actually believe that there's some reasons for optimism from seeing in the news, but we're going to continue to watch it. In the meantime, it's important to make sure that we keep the vehicles flowing for our customers. And like I said, they're contribution margin positive in the short run, so it allows us to buy a little time while we work through that uncertainty.
Hey, Paul, I know to this point, GM has been not passing on the cost to consumers. You've been eating it, and that's why you see the lower margins. Is there a point where you say, okay, we can no longer degrade our margins to this point? We have to think of shareholders too, and you pass some of those higher costs from the tariffs on to the consumer?
Yeah, well, good morning, Becky. What we've been trying to do for the last few years is really make sure that we differentiate ourselves in terms of pricing. So while we've seen a lot of heavy incentives from our competitors over the last few years, we've maintained a lot of pricing consistency. And we think that's important for our customers to make sure that they can count on us, but also to make sure that we're watching and monitoring residual values because our customers do hold on to these vehicles and want to make sure that they maintain their value. So that strategy has actually served us well. When the tariffs were first announced, we announced that we didn't need to take any incremental pricing increases to offset tariffs, and we wouldn't be responding. But when you look at the first quarter, pricing was up. Second quarter pricing was essentially flat, but we banked some of those gains, and that's part of our 30% offset that we've talked about. So we don't expect any specific price increases related to tariffs, but certainly pricing and stability is important for us as we continue to manage our inventories with discipline and really drive the business for cash flows.
Paul, do you expect that to be the case with the industry too? I mean, let's be clear, incentives are going up. Some of your competitors are raising incentives. And when I've talked with executives at other companies, everybody says the same thing. As the pre-tariff inventory burns off, at some point, you start to see people within the industry, I think people, I'm talking companies, say, okay, we've got to start moving prices up here. Do you expect that to change?
Well, I think we're obviously watching it. We watch it every day. But, over the last few years, we've seen competitors get into inventory challenges and increase their discounts. We've seen companies out there really trying to buy market share. But that's not something that we've responded to. And if you look at our performance, our pricing has been consistent. We're operating near the lower end of the industry in terms of incentive levels, which is important. Our customers have an understanding then of how much the vehicles cost, and that consistency is really important. And through that strategy, we've actually been picking up share. We gained almost a full share, almost a full point of share year over year in the second quarter, despite what others have been doing in terms of some discounting. So we'll watch that, and we're ultimately pricing to the demand for our vehicles, and right now that demand remains very strong.
Hey, Paul, real quick, when it comes to EVs, you guys highlight in your earnings release that you've had some success, some notable success in North America in terms of picking up EV market share, becoming the number 2 brand in terms of Chevy behind Tesla. But there are more than a few people who look at the EV market and they say that $7,500 tax incentive goes away on September 30th, and this is what's going to happen with EV sales. What's your perspective?
Well, we're absolutely committed to continuing on our journey of getting to profitable EV growth going forward, and we've made some great progress. As you mentioned, our EV sales doubled year over year, and we're experiencing significantly higher growth than what the rest of the industry is, even as demand is slowing. We expect actually there to be a little bit of a rush on EVs. Those customers that are very interested in EVs, obviously, I think are going to come to us and come to others ahead of the expiration of the $7,500 tax
But after
credit.
September 30th.
And then, we're likely, yeah. And then we're likely to see it slow down a little bit after that. But, I think what we're looking for is over the long term, a lot more stability in the electric vehicle market. What we've seen is a lot of irrational behavior by some of our competitors that are really selling vehicles to buy compliance. So as Congress has taken action to ultimately balance out the EV mandate to where customer demand is, we think we can be there for our customers. So we actually feel like we're in a very, very good spot. Demand has been slowing, but despite that, it's been growing for us, and that's because we're bringing a suite of great products to the market that have features that customers love, and we think we can keep that momentum even in the face of a slowing EV growth, and that'll ultimately help us on our journey towards profitability.
Paul, thank you very much for joining us today. Actually, I said you were at the headquarters. You're over at the Design Center over in Warren, Michigan. So, Paul, thank you very much. Paul Jacobson, CFO of General Motors. Andrew and Becky, I will send it back to you.
Okay, Phil, thank you for that. Before we head to a break, though, we told you just a couple minutes ago about Coca-Cola's earnings. The company also just announced it's going to launch a version of Coke made with cane sugar in the U.S. this fall. Now, this comes after pressure, remember we talked about it on the broadcast, to release a product with cane sugar from President Trump on Truth Social last week. He said he had been talking to Coca-Cola about using real cane sugar, and apparently now it's happening.
Look,
We'll see
the
how it
original
all
question
pans out.
was it going to be all their sodas? And we did not know at the time. We thought, yeah, there'd be a version of it that you get. There's Wall Street Journal wrote a story over the weekend that talked about how there's not enough pure cane sugar
To do it
in the United States
for all the beverages
for all the beverages that are out there, that you'd have to import a whole lot more pure cane sugar, and I'm not even sure when or how you would go about doing that, particularly when you're talking about tariffs and the like. But would be interesting. The version in Mexico has always had pure cane sugar, and that's been a commodity that's been a hot commodity that people have tried to get their hands on. So this should be interesting too.
Could be a new market opportunity. Yeah. We'll see. Coming up, the economic power of the nation's Latino community. We're going to talk to the chairman of the Latino Donor Collaborative and founder of the Trujillo Group. We're going to bring the results of his latest report as well. let's just say, the U.S. Latino GDP bigger than some of the world's largest economies. We're going to break it all down. And then later, former Fed chair, you do not want to miss this, and former Treasury Secretary Janet Yellen on everything from the Fed's independence to where interest rates should be right now. She's going to join us at 8:10 Eastern Time, and she's going to break all of this down for us.
Let's take a look at shares of Dow Components, Sherwin-Williams. Earnings there coming in at $3.38 a share. That was well below what the street was looking for. Street was looking for $3.81. It comes on revenue of $6.3 billion. That was roughly in line with expectations. The company, though, said that it saw demand softness during the quarter and that it expects that to continue into the second half of the year. That's why you see the stock off by about 3% right now. Sherwin-Williams also saying that it's cutting its full-year earnings guidance. The new range is below what the street had been anticipating, and I'll take a look at some of the other numbers. But again, you see that stock is off by about 3%. That's a Dow component, so it pulls down the Dow as well.
Okay, a new report showing U.S. Latino GDP reaching $4 trillion. It's about the same size as India. If ranked as a world economy, it would come in at number 5. The results are based on 2023 data from the Latino Donor Collaborative. Saul Trujillo is here. He's the chairman of the Latino Donor Collaborative and founder of the Trujillo Group. He joins us with part 1 of the report. More data is going to be released this fall. Let's talk about the data we know about, but I'm also curious, maybe you'll tease us about what you think the next component part of this is all about.
Well, good morning. First of all, thank you for having me. The story is always a continuing story, and if I were to make one bet for the United States of America as a core component that's going to grow for the next 3 or 4 decades, it's this part of our economy. It's today 65 million people. By By the end of this decade, it'll be almost 78 million people. And just a quick factoid for everybody here. Guess what percentage of total young people, 18 years or younger, that are Latinos in the country are native born?
I'm sorry, phrase it again. What percentage of Latinos
are native born that are 20?
It's going to be a very high number. Super high.
You got it. 95%.
Wow.
And 80% of the people that are here that are Latino last name are basically, with documents, etc.
Okay, you bring that up because this has been a big question, a turn in where the country has come at this point. The numbers, I've been watching you for years, Saul. Take a look at the numbers, and they have exploded.
Right.
What we see with this has gone up and up and up. I guess your point with this is that's going to continue. There's nothing that's going to stop this.
Yeah, and the big point is that you just had General Motors on.
Right.
And I was listening to the interview. We're going to show in September at our new event called Velocity, we're going to show benchmark data, that shows the magnitude of this cohort, this $4 trillion, and all the workers that are there as consumption. Mm-hmm. And I want to make sure that we always talk, we tend to talk about tariffs, we tend to talk about a lot of things that you have to deal with every day. But at the end of the day, this is a 2/3 consumption-based economy. So you need people buying things.
So my question to you is, if demographics are destiny, what does this mean in terms of the kinds of products that you think somehow the Latino community is more inclined to buy, the spaces with which they're more inclined to work? I don't know if you break it down like that,
Yes.
or think about it like that, but if you do, what does that mean for every business leader and investor out there that's saying, okay, I'm seeing what you're saying, but how do I think about that in practice?
Yeah, I don't want to pick on companies per se, but if you look at, for example, the story of Budweiser beer, iconic brand for 100 plus years, and now they're the number 2, maybe moving to number 3 kind of volume sales. And there's a Mexican brand called Modelo beer.
But Bud was kind of self-inflicted with some of the damage.
Well, some of that was, but it's really who they focus on as the consumer.
Right.
And so, when I was in college, I drank beer.
Right.
I don't really drink beer anymore. I don't drink anything. But my point is that you have to go with how, the cohorts in our country are. This cohort is the youngest cohort by a lot. And so, a couple of years ago, we were talking about the most populated age for the Latino cohort was 11.
Right.
The most populated age for the Anglo-American cohort was 58.
So here's a different question, though.
But this is about business.
No, I get it, but here's my question. We just talked about General Motors.
Yes.
And are we talking about how a company markets their product to a different group of people? Is that what we're talking about? Or are we talking about the product itself?
Well,
And then people will start to get into, why are we discriminating or targeting one demographic versus another? I'm curious what you think about that.
yeah. So just as context, as you know, I've run businesses on every continent in the world minus one, the coldest one. So I've done business everywhere. And I'm a believer in segmentation, right? It's really segmentation. And if somebody says, well, if you're going to segment, that's DE&I and you shouldn't be doing that, or it's discriminatory, I'd say you don't know anything about business. Business is about finding the customers that have the money, that have the interest, that you can tap into the interest, etc. And also the talent in companies that can help nurture that growth. So for example, in the automotive sector, you will see that over time, the Japanese car makers have been the market share takers in the United States. And as we would say, ¿y sabes por qué? Or in French, you'd say pourquoi? And the answer is because they're focusing on a cohort that fits the profile of who they think their consumer should be, etc. If you look at beer, the younger cohort is the Latino cohort. It's not about Anglo cohort is bad or Asian cohort is bad or anything like that. This is about business. This is my message to every CEO I talk to, and whenever I have a chance to talk about this, we need to understand the consumption part of our economy and the fact that we have a growth cohort. So here's part of the punchline. The U.S. Latino cohort is our nation's differentiation as a competitive entity versus Europe, fading, versus China now because of the single child policy, fading. Japan is our historical example, fading. And there's one country outside of India, which is just a young growth country. This cohort is a buoy for
Okay, so here's my next question.
But back to your original question, is this the products that you make, or is it the marketing, to Andrew's original question? Do you market it differently, or do you actually make products that are different?
It's a little bit of a combination of both. Because I remember giving a speech in Silicon Valley in 1999 when AOL was the number one market cap company. And I was saying it's going to fade because of a lot of the things that have happened. And I said, but just to show you, at that point in time, salsa was outselling ketchup and mustard. And we have lots of examples of how that's happening now. Tacos outselling, whatever. And it's because of consumptive patterns, but it's also focus.
Let me ask you about politics. When you think about this cohort, can you wrap this cohort in one political bow? And how is that going to impact the politics of America over the next however many years? How does that cohort think about tariffs? And by the way, the impact on some of you just said 95% of them were born in America, so maybe they don't think about what's happening in so many of the other countries with which their parents or grandparents may have been born. But how does that engage this group that you're talking about?
Yeah. I mean, in our country today, take the Jewish cohort. There are affinities there with the Jewish community in terms of products, companies that they do business, and all that sort of thing. The Asian cohort, there are certain affinities that they have. And the Latino cohort is no different, African American cohort. So my point is that smart marketing is always, I want to know your need set, I want to understand them, and then serve them better than anybody else. So politically speaking, I mean, the Latino cohort has evolved. And the story I told before, I don't know if you remember when I was talking to Joe last time, 1/3 of the Latino cohort families own businesses, right? So they do care about taxes. They do care about regulation. I'm a registered Republican. I didn't support this guy who's president today because I think he's not building kind of what I would call long-term growth prospects. But that's an opinion of mine. I'm not here to talk about politics. I'm just here to say, as a country, we should value this cohort, nurture the cohort, and for brands, they should be leveraging the cohort. And that's what the GDP, the Latino Donor Collaborative, it's a nonprofit. I started it when I came back from Australia to say, all this negative conversation makes no sense because this is a crown jewel that we have in our country.
So very quickly, you were on the Pepsi board. We were just talking about this announcement from Coke today that they're going to be starting a line with pure cane sugar instead of the corn sweetener. What do you think of that?
I'm not on the board anymore, so I guess the question is what does it do to your cost of product? And do you have consumer data that says it's preferential? And I heard you say a little bit about the fact that, around border cities and other places, there is the Mexican beer, right? But I don't know what the volumes are really, other than one person's personal preference that seems to be influencing a corporate decision. I don't know. So I don't want to sit here as an expert because I haven't seen the research and I don't know what happens to the cost structure per unit sold.
Thank you, Saul. This is fascinating. We look forward to hearing more about the second part of this. So we got a tease here.
A lot of detail.
We always like episode 1, then you got to wait for episode 2.
Yeah, and
Well,
so
we're
to
kind of like
that
the
point,
Netflix approach, where it all just dumps at one time.
yeah, no. We've got a lot of detail by state. We've got a lot of detail by sector, and we're going to have some benchmarking data that you will look at and say, really? Like this conversation you just had.
Good cliffhanger. Thank you,
Thanks.
Saul. All right, Lockheed Martin out with quarterly results. Those earnings coming in at $1.46 a share. That does include pre-tax losses on programs of $1.6 billion and other charges of $169 million that impacted earnings per share by $5.83. The stock right now off by just over 8%. Revenue of $18.2 billion was below expectations as well. Lockheed's also lowering its earnings guidance to the range of $21.70 to $22 a share. We're going to have much more on that defense stock coming up at 8 a.m. Eastern time. But again, that stock's taking a big hit, down more than 8% at the moment. Squawk Box will be right back.
Welcome back to Squawk Box. The Federal Reserve holding its large bank capital conference today, focused on regulatory and oversight reform. Leslie Picker joins us with Federal Reserve Vice Chair of Supervision, Michelle Bowman. Good morning, Leslie.
Hi, good morning, Andrew. Thank you. And Mickey, thank you very much for being here. It's a big day for you. Just 6 weeks into the role, you've moved very quickly with a slew of proposed deregulatory actions. And the level of capitalization at the banks is kind of a function of, it's a balance between economic growth and the safety of the banking system. So was there something in the macro backdrop that compelled you to make this slew of changes?
Well, I think we realized that we're 15 years past the financial crisis and the implementation of the Dodd-Frank regulations, and that it's time for us to take a look backwards to understand what's been working, what isn't working, what's duplicative and overlapping, and how we can have a more comprehensive review of what those, especially the capital regulations are, which is the whole focus for today's conference, and how we can have a much more rational, much less duplicative, less overlapping framework for banks, for the large banks, to comply with capital.
Was there something you felt like was holding back the banking system? I ask only because they just reported earnings and they were kind of, knocked it out of the park, profitability-wise. Did you feel like they were being held back in a way that was still, harming economic growth?
No, actually, I think that the capital framework is something that we've been engaged in and have committed to changing. We have several pending regulations like Basel III. We have a GSIB surcharge proposal that's been pending for over a year now. And then we've also committed to improving our stress test regulations in that process. So as a part of reviewing all of those in context, we wanted to make sure that if you make changes to one of those individual regulations, that we want to make sure that they all work together, because there is such overlap and interaction between those four pieces of capital. So we wanted to make sure that we had the opportunity to, one, understand what all of those expectations are, and two, make sure that as we're recalibrating some of them, that we arrive at the right level of capital for the system as a whole.
Do you feel like you have consensus among your peers in achieving this agenda? Do you have everybody on board with you?
So we're working very closely together, especially within the interagency context, because many of the rules that we'll be talking about today require an interagency agreement. But we also are working very closely, and I think you'll see from many of the proposals that we put forward that we have broad consensus from the board on some of the changes that we've been making.
Michael Barr, your predecessor, he gave a speech last week where he said, quote, weakening regulation often drives risk-taking and increases bank fragility during the boom, meaning kind of the boom times, making the ensuing bust more painful. In other words, he's basically suggesting that deregulating during times of strength can have worse outcomes down the road. Is that a concern of yours?
Well, I wouldn't call my approach deregulation. What I think we're looking at is making sure that the regulatory framework is appropriate for where we are in the system now. We've more than doubled the level of capital and liquidity in the system since the 2010s. And so I think now is the right time for us to understand what works, how we can improve the framework, how we can make it more transparent and more interactive so that it works together in a way that makes sense.
We've seen a slew of headlines over the last few weeks raising questions about the Fed's independence. President Trump, taking aim at Fed Chair Powell. Are you concerned at all about the threat to Fed independence right now?
Well, it's very important, and I've said this a number of times in the past, that we maintain our independence with respect to monetary policy. I think that's very clear. But we also, as a part of that independence, have an obligation for transparency and accountability as well. But we also have an obligation, in my view, as we have throughout the time that I've been here on the board since 2018, to listen to a broad range of voices and to understand how others are viewing the economy and how that should influence our decisions in monetary policy making.
I want to ask you about supervision as well, because the Fed, and I know you've cited this in a speech, you say that 2/3 of banks were deemed unsatisfactory last year. You're reforming the rating system, and you think the problem, I assume, is the grader, not necessarily the test taker here. And that is especially true since Silicon Valley Bank, I believe, in the years leading up to its demise, had a satisfactory rating, and then ultimately, we saw what happened there. Because of these poor ratings, there are many banks in the penalty box, and I'm just curious if you think reforming the rating system would allow more banks to merge, and whether you think that's necessary.
So let's start with the rating system. So we made some changes to the large bank rating framework back in 2018 that allowed for one particular category to bring down a bank's grading, which to make it not well managed versus well managed. And when you have three components, two of them are related to their financial condition, and one is related only to their operations and other non-financial factors. It doesn't make sense that we would allow non-financial factors on their own to degrade a bank's financial standing. So the changes that we made balanced that outcome a little bit more. It requires at least a downgrade in one of the liquidity or capital components, in addition to potentially the GNC rating system. And it's important that we do look broadly across all of our ratings frameworks to ensure that we're calibrating them the right way and emphasizing things that are likely to bring a bank down. I think part of the problem with Silicon Valley Bank in particular was that we focused on things that were not financially related. I mean, all of these things were available for us to see if we were looking at the reports. So it's important that we're focusing on financial related factors when we're thinking about the condition of a bank.
Are there areas that you think warrant more regulation? And I ask this because under the current capital framework, we've seen a lot of activity get moved into the non-bank financial sector, into private credit, for example, direct lending. Do you think that warrants more scrutiny, more attention in this new environment?
So in my mind, I'm a banking regulator, and the Federal Reserve oversees the banking system, but also financial stability. So from my perspective, I think expanding the banking perimeter would be a better outcome to allow banks to engage in what were traditional banking activities like mortgages, mortgage servicing, those kinds of activities. I think the risk weightings in the capital framework that we have now have really limited banks' ability to engage in those, especially our smaller banks.
Mickey Bowman, Fed Vice Chair for Supervision, really appreciate your time today. Your first ever CNBC interview. Really appreciate it.
It was great to be with you. Thanks, Leslie.
Thank you. I'll send it back to you guys in studio.
Wow, thank you for the debut interview. We appreciate it. Hope we'll have a lot more of them. Thanks, Leslie. When we come back, former Fed Chair and former Treasury Secretary Janet Yellen, you do not want to miss this conversation. She is speaking out on maintaining the Fed's independence, the attacks from the White House and Chairman Powell, and so much more. We're going to have that conversation at 8:10 a.m. Eastern Time in just a little less than half an hour from now. Squawk Box, coming right back.
Plus.
a lifesaver.
All right, coming up, Alphabet and Tesla are two of the Mag 7 companies set to report earnings this week. We're going to take a look at some of the challenges facing those two tech giants and what might come out of the results. Plus, some of the biggest names in the defense sector reporting results this morning. So far, it's been a little messy, especially for Lockheed Martin, which is off by about 6 1/3%. We'll get a rundown on the numbers and the guidance. Squawk Box, we'll be right back.
NBC Plus.
Big tech earnings kick off tomorrow with Google and Tesla both set to report. Joining us right now is Ray Wang. He's Constellation Research founder and chairman. And Ray, first of all, thanks for being here. We're trying to figure out what to expect from the Mag 7. This is going to be our first look at some of those numbers. What are your expectations overall?
Well, overall, the Mag 7 are going to operate differently. We have the folks that are completely AI enabled, we have the folks with China risk. You have to factor those two things in place. So on the Google side, they don't have the China risk, but the question is AI going to crush the search and ad business, and is Google Cloud Services going to continue to grow? The short answer is we're actually seeing a lot of improvements on the Google side in terms of AI. We actually think they might be in the lead in terms of their AI capability, but the question is how are they commercializing on the AI side? But so far, what we've noticed is services continue on the cloud services and the Google search side and the ad side are probably going to continue in like 8 to 10% growth, and on the Google Cloud side in the high 20s.
Google's stock is flat for the year to date. All those questions that you brought up have kind of played out in investors' mind. Where do you come down on this? Is this a good time to jump in? Do you believe it's going to win on the AI front?
I actually think it's going to be one of the three winners in AI, and actually it is a good time to go in. If you look at that P ratio versus everyone else, the overhang is really coming from antitrust and this perception that they're behind in AI. But when we talk to developers, when we talk to system integrators, I was actually in India last week doing that, they all recognize that Google is ahead. In fact, Google is ahead of Microsoft on the AI front in terms of the advancements, but they might be behind on the big LLMs that are getting a lot of the money and a lot of the talent. And
Explain how people think they are ahead of Microsoft, or the people you spoke with in India.
Because the technology behind what's going on from VO3, from Gemini, it's actually being used by developers. It's actually being used on the coding side. It's actually being used to build products. We have a client that basically, with 10 people, beat out another client with 110 people to do the same job in half the time and half the price using Google Gemini.
And you've got a price target, I think, of $210 for Google, for Alphabet. So you're a big believer here. What about Tesla? Because it is one that if you look over the last year, it's up 30%, but just for the year to date, it's down 13%.
Well, Tesla's trading on headlines, and that's a little bit different. And it's a question if you believe in the long-term thesis of autonomous robots, power, energy, and what Elon's able to do there, and if Elon's actually going to be focused on Tesla. And the answer is no, don't buy into the Tesla stock. But if you actually think this is going to be one of the winners in terms of where energy and robotics and automation are going, and especially on the AI front, then it's a good bet.
Well, where do you come down on it?
I'm a big Tesla believer, and actually believe that whether they build cars or whether they build robots or deep tech infrastructure, they're going to be one of the pioneers for American innovation and in terms of where tech's headed.
Is Elon the key man who has to be there in order for this to all come about?
The short answer is yes and no. Elon, on one hand, drives the vision, gets everyone out there. On the other hand, he creates a lot of chaos, a lot of turmoil for a lot of the executives that are there. And so you have to be a very special person to be able to operate within Elon's empire. So for example, take the SpaceX COO. She's doing an amazing job, right? That's a very different story than what's going on right now with the overhaul at Tesla. I mean, they're flipping all the executives out through Tesla.
Well, there's been a view that people want Elon back sleeping on the factory floors, and that's how you get things done. It doesn't sound like you're necessarily in that camp, though.
I think depending on where you are on the stage of business, where Tesla is, they need someone that can help them scale out, think about what the next model's supposed to be. Might not necessarily make the bet on robo-taxi today, but you may make the bet on automated factories that are coming back to the US that Elon's able to do. So you'd want Elon focused on Grok, you want Elon focused on Optimus, but you need someone to take the business and scale at Tesla, which is very different.
All right, let's talk a little more broadly about all of the Mag 7, not just these two that are reporting this week. We had Katie Stockton on earlier this morning. She's a technician, and her concern is there has been so much straight upward movement for the markets that it's hard to go into this earnings season and not potentially disappoint. Unless you give investors everything they want to hear and more, you could see a pullback with some of these stocks. What do you think of that thesis?
There's so much riding on the Mag 7 right now. I mean, it's priced to perfection. And if you don't hit, the numbers don't come out, the expectations don't come out the way, you're going to see a little bit of a pullback. But the challenge is, where do you put money in at this moment, right? This is flight to safety, and this is also risk on at the same time, and that's confusing to a lot of folks that are on the technician side. But if you're looking at where the market's going to be in Q3, Q4, what you're hoping for is tax cuts come into play, tariff stability is there, a little deregulation in place, and the 15 trillion, let's say it's not even 15 trillion, $1 trillion of foreign direct investment comes into play. We're actually posed for some growth, especially on data centers, especially on AI, especially on those key components of the Mag 7.
I will say that was Katie's short-term view versus her long-term view that over the next 12 months you could see 68, 80, I think, on the S&P 500. So she's talking about a potential pullback, but then powering back through.
Exactly.
Yeah. All right. Ray, thank you for coming in today. It's great to see you.
Oh, thanks for having me.
All right, it is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Andrew Ross Sorkin. Joe's out today. Among our top stories this morning, Sarepta Therapeutics says that it will pause all shipments of its gene therapy, Elevidys, for Duchenne's muscular dystrophy in the United States at the end of today. In a statement, the company said that pause will give Sarepta the time it needs to respond to requests for information and to allow it and the FDA to, in their words, complete the Elevidys safety labeling process, the supplement process. That stock is down another 4.6%, but that comes after several days of big declines after that latest news. Year to date, that stock is down by almost 90%. AstraZeneca says that it plans to invest $50 billion in the U.S. before 2030. The company said that the investment would go toward manufacturing and R&D. And a report says that Berkshire Hathaway-owned railroad BNSF is working with Goldman Sachs and looking into a takeover of a rival railroad. That's according to Semaphore. The site says that it's unclear if BNSF is considering buying Norfolk Southern or CSX. Reports last week said that Union Pacific had been looking into a Norfolk Southern takeover. If that deal comes together, it would create a railroad that spans the entire country and leaves BNSF at a disadvantage, although Andrew and I talked about this earlier. I don't know about the veracity of the report. I have not checked it with anyone, but it's not really the Berkshire way to go hire an investment banker to figure out what their options are. That's not been what Warren Buffett has ever done. Comes up with these things on his own, so we'll see.
Meantime, let's take a look at futures right now. You have some green on the screen with a little bit of red. You got the S&P up about 8 points, the NASDAQ up, I want to call it like half a point. You're looking at the Dow, though, off about 4 points. Morgan Brennan has the defense names on the move this morning after earnings. Dom Chu has some other key names to watch. Morgan, we'll start with you.
All right, good morning, Andrew. Well, it's a mixed picture for defense today as those earnings get underway. Northrop Grumman higher on a beat and a raise. The B-2 bomber maker getting a boost from its Sentinel ballistic missile and B-21 bomber programs. RTX, though, that was lower, down about 2% here in pre-market after trimming full-year profit guidance. Higher costs amid steel and aluminum tariffs, even as defense demand stays strong. But the morning's big mover is really Lockheed Martin, which is down about 7% right now. Pre-tax losses on programs of $1.6 billion. Other charges of $169 million. That impacted earnings. It triggered a 2025 profit forecast cut. Lockheed's CFO, Evan Scott, telling me this was the result of portfolio reviews. He doesn't expect more charges, at least for now. Quote, we've just recommitted to our portfolio and are investing for growth and creating shareholder value. Now, I asked how much a shift in weapons mix is factoring in as the Pentagon looks to acquire more lower cost systems that are faster to produce, for example, drones. Scott saying he does see that happening, that Lockheed is looking to, quote, bring more of those new technology companies into our supply chain and looking for partnership opportunities with some of the new entrants here, but that there's still a need for complex, big ticket systems. That's really what we're hearing from earnings so far this morning. Be it the 5th-gen fighter jets like Lockheed's F-35 used in some of these strikes on Iran, nuclear modernization with Northrop, or missile defense via Patriot systems for RTX and also Lockheed. U.S. defense spending is growing. Everybody's benefiting, especially as Golden Dome now gets funding. International sales are growing as Europe and others boost their defense budgets as well. So bottom line here, guys, you've got some legacy defense programs that are phasing out. Lockheed today looking to get ahead of that. Pentagon priorities are shifting, but global demand overall amid heightened geopolitical risks is spurring more orders overall.
Okay, Morgan, thank you for that. I want to get straight over to Dom Chu with some other movers this morning. Dom.
All right, so Andrew, Becky, let's start off with shares of Coca-Cola down roughly 1/3% despite reporting better than expected profits and revenues for its second quarter. Coke's, though, global unit case volume fell by 1% last quarter, driven by declines in pretty much every geographic region, with the exception of EMEA, which is Europe, Middle East, and Africa. It did reiterate its forecast for 5 to 6% organic revenue growth for full year 2025. Those shares are up roughly 11.5% so far this year. Now let's turn to shares of Oracle, lower by just roughly maybe 1% or so, now actually higher by 0.25%. This is all after entering an agreement with OpenAI to develop 4.5 gigawatts of additional data center energy capacity in America. That expansion is all part of the Stargate project, that American artificial intelligence push that was announced back in January. And we're going to finish with shares of Lululemon, just about 1% declines here so far. This is due to a downgrade to neutral from JP Morgan from an overweight rating. The target price was also cut to $224. It was $303. Analysts there say that the recent fieldwork they had shows that consumers are responding well to new products and fabric innovation, but that's being offset by some poorer response to updated core seasonal colors and products. Now, for more on that and other top analyst calls of the day, just head over to cnbc.com/pro. As always, subscribers get all the access and detail to those big upgrades and downgrades each day, Andrew. I'll send things back over to you guys.
Dom, thank you for that. Appreciate it.
Up next, Fed independence and the economy. Former Fed Chair and Treasury Secretary Janet Yellen joins us for a wide-ranging interview. And later, the big business of sports. Ted Leontis, the CEO of Monumental Sports and Entertainment, will join us. Squawk Box will be right back.
and make it count.
Welcome back to Squawk Box. I want to talk about the high tensions taking place between the White House and Federal Reserve Chair Jay Powell, the state of the economy, and so much more. Joining us right now, first on CNBC, is former Treasury Secretary and former Fed Chair Janet Yellen. We're thrilled to have her on the broadcast this morning. Before we even get into it, I want to read you, if I could, an op-ed co-written with Ben Bernanke. Yellen writes the following: recent attempts to compromise that independence risk lasting and serious economic harm. They undermine not only Mr. Powell, but also all future chairs and indeed the credibility of the central bank itself. So let me start with this question, which we asked Janet Yellen. We also asked Scott Bessent recently. If in fact Jay Powell were to be fired, ousted, or otherwise pushed out, what would happen to the market? I don't know if
I don't
we're
think
frozen.
she's hearing us.
Can you hear us? Maybe she can't hear us. We're hoping that she will be able to hear us in just a moment. We're going to check in with her and make sure that we can get that connection made.
Now she can.
I think we can. Janet, are you with us?
I am with you. I didn't hear your question, though.
Where I was going to go with this is I just read a piece from the op-ed that you wrote with Ben Bernanke.
Yes.
And then I followed up by saying that we had talked to Scott Bessent and we had asked a similar question of actually Elizabeth Warren recently, which is, if in fact Jay Powell were to be fired, ousted, or otherwise pushed out, what would the market's reaction actually be?
Well, I think we got a taste of that when President Trump announced that he had shown a letter to Republicans that would call for Chair Powell's ouster. And while the market reaction was brief, what we saw was the exchange value of the dollar declined, longer-term interest rates moved up, and the stock market declined. Now, President Trump quickly said he had no plan to fire Chair Powell, but I think that gives you directionally a sense of what would happen. Look, importantly, markets rely on the independence of the Fed and the Fed's commitment to achieving its congressionally mandated goals of price stability and maximum employment in assessing the soundness of the U.S. economy and their security in terms of returns they can expect investing in the United States. And when a president threatens to remove a chair unless he radically lowers interest rates with the stated purpose of helping the government finance its borrowing, not the congressionally mandated goal of price stability, but to ease financing costs on the outstanding federal debt. This is really disconcerting to markets, and what we've seen throughout history, both U.S. history and history around the world, is when that kind of pressure drives monetary policy in a country, high inflation is the inevitable consequence. And we've seen that in the United States as well. That happened during World War II. Ultimately, in the 40s, we saw double-digit inflation in the United States. And the Fed really rebelled, and there was an agreement in 1951 that the Fed should not have any obligation to help the Treasury finance its debt payments, but rather to focus on price stability and full employment.
Now, let me ask you this. There is a perception that the Fed has been wholly independent, that historically presidents have not made the kind of comments that this president has, and that this is all new. The truth is that to some degree, this is not new. You can go back 1965, you know the story, LBJ physically shoved Fed Chair William Martin against a wall at his Texas ranch as he was demanding that he lower interest rates. And I wonder, when you start to think about that story, or you start to think about the story that Paul Volcker used to tell about when he was brought into the Oval Office with Ronald Reagan, how we should think about the very concept of the Fed as an independent entity.
Well, you're absolutely right. There have been episodes in the past that we know about now where presidents have attempted to pressure Fed chairs. We've seen what happens when that occurs, and probably the most prominent example would be Richard Nixon exhorting Arthur Burns to hold interest rates down before the 1972 election. And what that ushered in the United States was a period of stagflation, weak growth, high unemployment, high inflation, and it really took Paul Volcker to come in, and it cost us a very deep recession to re-anchor inflationary expectations to get them down. So this kind of pressure, which has sometimes existed, but certainly not, in my experience, not during the Clinton administration or any subsequent administration that I'm aware of, we see that the consequences are very poor for the economy. We end up with higher inflation, worse economic performance, and it undermines the global role of the dollar and the willingness of foreigners to invest in the United States.
Secretary Yellen, on that point, there is a lot of concern about President Trump inserting someone from his administration directly into the Fed. There's this idea that the Fed is supposed to be apolitical, but I wonder if you think that that was broken down to some extent when you went directly from chairwoman of the Fed to the Treasury Secretary, going directly into an administration, Leo Brainerd doing a similar move with that. I just wonder if you think that that door between the administration and the Fed should be closed a little more tightly, more of a Chinese wall to prevent any sort of perception of a lack of independence at the Fed.
So it has not been uncommon. Many Fed chairs have had past experience in the White House in an administration. This was true of Greenspan as well. And I suppose it's natural because presidents come to know people who serve in their administration and gain confidence in their judgment. What's really important, though, is when an individual is wearing the hat of Fed chair, that they have the capacity and willingness to make fact-based judgments and to pursue the goals that are congressionally mandated, namely price stability and maximum employment. That becomes their job, and they have, I believe, whether it was myself or Bernanke or Greenspan, I think all of us were able to establish a track record for independence, staying out of politics, getting, not succumbing in any way to short-term political pressures, behaving in a nonpartisan way. And the track record, by and large, although all of us are human and have made some mistakes, I think the Fed's track record over many decades has been one that's been successful. We've had low and basically stable inflation. The post-pandemic experience was an exception, but look where we are in the economy now. Inflation is coming down and it's close to the Fed's 2% goal. The labor market remains strong with 4.1% unemployment, and really the United States was like every developed country that experienced a surge in price pressures during and after the pandemic.
I guess I would ask if the key is just making sure that you're apolitical when you're in the job, that you're not too exposed to any pressure that comes from the administration. Do you have any concerns about the top candidates who have been mentioned as the potential next Fed chairman. I guess that would include Kevin Hassett, Kevin Warsh, Scott Bessent. Those have been some of the top names along with Waller.
So I'm not going to comment on individual candidates for this job. What is very important is that the president choose a person who strongly believes and will defend the Fed's independence and keep it divorced from short-term political pressure. And it concerns me when I hear President Trump say a qualification for the job is that the person must have the views that interest rates need to be cut radically. I believe the person needs to carefully look at the data, consider economic trends, work with the other members of the Federal Open Market Committee, and make fact-based judgments that reflect a commitment to achieve the congressionally mandated goals. And keeping financing costs low for the federal debt is not one of the goals, and it would be very dangerous to pursue that, as I said.
But
that is a sure road to high inflation.
Secretary, though, to the extent that, and we just had Kevin Warsh on the broadcast last week, we've had Kevin Hassett on the broadcast, obviously we've had Scott Bessent on the broadcast recently, all three of whom have praised the president, have praised the president's economic policies, have called effectively for lower interest rates themselves. Is that something historically that other potential nominees for this role have done?
Well, I honestly can't recall past selections of Fed chairs in which candidates have come out and actually expressed their opinions about the direction of future monetary policy. I think most candidates in the past have indicated, as I said, a commitment to fact-based analysis, making judgments depending on how the economy performs and in light of achieving the mandated goals.
I'm going to ask you just a separate question, and maybe it's a personal one, about the collegiality of the Fed and former Fed heads and also former Treasury secretaries. At least historically, and maybe I'm wrong here, most maybe talked in private about these issues with each other. I know there are dinners and things that have been set up over the years between former heads of the Fed and former heads of Treasury. But I don't know if it's all spilled out in public in such a way where former heads of these units are then writing op-eds critically in the press out there about their successors. And I haven't even, and I don't think I've seen those in the role then criticizing back, which is to say you probably saw that the current Treasury Secretary made some comments about you and your China policy and made what I think was, he was attempting to make a joke about mushrooms and beer. But I'm curious just how you think about that.
So, as you said, there is a tradition in which former Treasury secretaries and Fed chairs get together with an incoming Treasury secretary to provide the benefit of their advice and insights from their own experience. And there is a kind of camaraderie that has developed among former Treasury secretaries and Fed chairs, all of whom are given the profoundly important job of stewarding the American economy in a way that is successful. And personally, my hope would be that Secretary Bessent will be very successful in his role as Treasury Secretary. All of us know how difficult the job can be and how challenging it is. As soon as Secretary Bessent was nominated, I called him and offered to provide any advice that would be useful. and that offer still stands. So I would like to see him be successful. We do, however, have significant policy differences, and he hasn't reached out to me to seek my advice, but I stand ready to give it.
Let me ask you a separate question, which is, he had proposed before President Trump was elected this idea of a shadow Fed chair. That was actually something that he developed and then made public, this idea. There's an argument already being made to some degree that there is a shadow Fed chair. We may not know who that name is in practice, but that by default, come next May, there will be a different person in that role. And the likelihood is it's one of the names we might have discussed, and that those individuals have made a pledge to some degree, publicly or privately, or will have to, that they will lower interest rates, and that the market is already expecting that, and therefore planning for it and seeing through whatever happens between now and then. What do you think of that idea?
Well, I think that that's a very dangerous idea, and I hope you're wrong that the market is assuming that a person will not be independent and will cave to political pressure. I think this is one of the dangers of what President Trump is doing, insisting that he will only put in place a Fed chair who believes in lowering interest rates. And as we noted earlier, you can see what the market reaction is going to be to that. Secretary Bessent even yesterday expressed his belief that monetary policy should be independent. And I think most market participants continue to expect that the next Fed chair will act independently. But this idea of creating a shadow Fed chair immediately casts a shadow over whoever it is that gets the assignment next May of becoming Fed chair, that it impairs their credibility with the markets and creates a problem for them right from the outset, where people will expect that they're political.
Secretary Yellen, you mentioned that you think inflation's coming down and kind of under control. What do you think about the economy more broadly, how things are going?
Well, I think the economy has been remarkably resilient and is in basically a good place. But I do have concerns going forward. The tariff policy, we still don't really know what it's going to be. So there remains a lot of uncertainty around what the level of tariffs will be going forward, what the response of other countries will be. We are seeing some limited pressure on prices of goods that are most exposed to the tariffs, things like apparel, toys, and the like, household appliances. I expect, because it's still in a way early days, that we're going to see further pressure and more significant pressure on inflation as a result of the tariffs over the remainder of the summer and into the fall, although we need to wait and see. And we're beginning to see some softness in the labor market, although the unemployment rate remains low. Average job creation over the last 3 months has been running at around 150,000 jobs per month, which is fine. But hiring rates are low, quit rates are low, that suggest some softness developing in the labor market. And as the tariffs begin to take effect, household incomes are going to decline. And that can really reduce spending significantly. I think that the uncertainty about tariffs is weighing on capital investment spending as well. And so we could see stagflationary kinds of outcomes in the months ahead of weaker employment and rising inflation. And I think that's what we need to keep an eye on.
A couple other quick questions for you. One is Mohamed El-Erian calling for, I don't know if he's calling for it, Becky.
But
but
he's suggesting
effectively-
that Jay Powell should step down in order to protect the Fed's independence. His quote is, if your objective is to protect the independence of the central bank, then it's better that he step down than to stay on and have the attacks multiply. What do you think of that?
Well, I disagree with that strongly. I think Chair Powell is completely committed to the Fed's independence. I don't believe that the president actually has the ability to fire Chair Powell, except as the law specifies for cause. And I think that he should fill out his term and stay on until his
What do you think for
term
cause means,
expires
by the
in
way?
May. Some gross mismanagement of monetary policy or the Fed or some corruption, a serious breach of his responsibilities as Fed chair, which I don't believe there is any such basis.
Let me ask you two other quick questions. We've talked for many years, Secretary, about crypto. I think you have been a critic or at least a skeptic, and we have watched crypto just explode. Obviously, the Genius Act just passing last week. What do you think now?
Well, I have concerns about some of the legislation that was passed. I convened, I believe it was in 2022, the President's Working Group on Financial Markets to make recommendations about the appropriate regulation of stable coins. And I'm pleased to see that Congress did take up that topic and that a framework has been put in place. But unfortunately, I think it contains significant weaknesses. And so it's not all that I would have wanted to see. And that does give me concerns about what the role of stable coins, for example, will be going forward, whether or not there are adequate controls in place. And I believe they present financial stability risks that should be addressed.
Secretary, we got to run. Before we go, we had Secretary Besson on recently. He was making a comment about having breakfast, as you know, with his counterpart at the Fed in Jay Powell, and said that the Fed's food is better. So I figured I'd ask you, since you probably the only person who's ever had the job at the Treasury and the Fed, who's got the better food?
Well, my counterparts seem to have enjoyed coming over to Treasury, and I certainly enjoyed going over to the Fed. So I frankly think at this point it's a toss-up, and both have pretty good
Oh, come
food.
on, you gotta pick one.
Well, I like Treasury very much, but I think the Fed's food is absolutely fine as well.
Janet Yellen, thank you so much for joining us this morning. We look forward to seeing you again very,
My
very
pleasure.
soon. Thanks again.
Thanks.
Still to come this morning, founder and CEO of Monumental Sports and Entertainment, Ted Leonsis, on the big business of sports. His portfolio includes the Washington Capitals, the Washington Wizards, as well as esports and the Capital One Arena in D.C. Right now, though, as we head to a break, let's take a check on the futures this morning. Looks like Dow futures are off by about 14 points. NASDAQ indicated up by 5. The S&P futures up by close to 9. Squawk Box will be right back.
hear about Mount Jaro?
Let's take a look at shares of General Motors right now down by about 2.5%. The company beat Wall Street's estimates and affirmed its full year guidance, but that stock is under some pressure this morning as investors focus on margin numbers. The CFO, Paul Jacobson, joined our Phil LeBeau in the last hour and talked about the downward pressure on North American sales and the impact of tariffs.
This was going to probably be the peak of the tariff impact for us. While we experienced a little bit of timing pushback from some of the indirect tariffs that we will see later in this year, we'll begin to work in the 30% offsets that we've talked about. So we've uncovered a number of initiatives. We've been working on these really since the beginning of the year, really into the end of last year. Those 30% offsets will start rolling in the back half of the year, and we actually expect the margin impact to be lessened from the tariffs.
Again, shares of GM this morning right now down by about 1.5%. Squawk Box will be right back.
Happy with it.
Welcome back to Squawk Box. The Capital One Arena in Washington, D.C., home of the Capitals and Wizards, just began its first phase of a massive transformation. And to discuss that and so much more, an exclusive interview with Mind Mental Sports and Entertainment founder, chairman, and CEO Ted Leonsis. Ted, it is great to see you this morning. There's about 100 things to talk to you about in the world of sports, but do you want to start there?
I'd love to talk about the building and the rebirth of downtown. I think it's very, very important for our cities to be fully developed economically, and we have to get people back into the office. We have to keep the businesses flowing, and we're a portal. We can bring in 3 million people a year, concerts, college basketball, NHL, NBA, WNBA. So I think sports teams now have become this massive meeting and gathering place.
Do you think something's changed? And the reason I ask is, for many, many years, there was this idea that there were these stadiums that would become albatrosses. They'd become tax albatrosses for some, but also just that you were never getting the community really around them. And then you could argue basically in Baltimore was one of the first, when the Orioles built that stadium, that was sort of one of these first real hubs, and then people started doing this around the country. Do you think there's something that's different happening now?
Well, our buildings are very expensive. We have to program them all the time. We have 250 events a year. That's how we bring 3 million people in. And we have 25 years of data. So we're a driver of business, shopping. People go to the restaurants and the bars, go to the parking lots. It's very, very important part of
But what do you think
business.
changed? Because you used to be
I think
around stadiums.
Yeah.
They didn't necessarily collect people living there, working around the stadium. It was a different thing.
It's more football. I mean, football has 8 home games, 9 home games. We have 42 games in playoffs, and so we've never considered we would have an albatross, if you will. We're not as busy during the summer, so we loaded up with concerts.
Mm-hmm.
The next 3 years, this year, next 2 off seasons, we're building. There's 800 people working 3 shifts and trying to rehab the building, reimagine it, to make it modern, make it a much friendlier, a much more bespoke experience for the fans, because the fans are very demanding now. Tickets are expensive, fighting traffic. We have to really think about kind of an end-to-end customer experience. We also have to do it for the players. We also have to do it for our employees. These have become big businesses. I'm here at NASDAQ. This is an asset class. Our businesses now have real gravitas and real repeatable revenues. You have businesses up there that are SaaS businesses. I think our business is very analogous to a SaaS business. We sign long-term contracts. They have escalators in them. About 80% of our revenue in Washington, D.C. Monumental is under contracts. We have a very predictable business.
I had not thought about it
Yep.
from that sort of SaaS business plan.
And the multiples are starting to look like SaaS businesses. They're 6 times on the low end, 14, 15 times on the high end.
What are the risks you worry about most? Because we've seen nothing but higher prices that people are willing to pay for experiences, for tickets. We've seen nothing but higher prices for the sports franchises. But what do you worry about?
Well, we should never take the popularity of the game and competition and the players for granted. We're lucky in that there's something about sports that people crave. It's not just the competitiveness. It's like the only place you can go and here are the boundaries. Here's what's out of bounds. Here's the rules. Here are the officials. You have to respect the officials.
Or rough them up.
And I do think there's this tribalism, this feeling of being a part of something bigger coming. And we really saw that after the pandemic. I mean, I went to the movies this past Saturday. It was the first time I'd been in a movie theater since the pandemic. We came back after the pandemic, sold out, had our best years ever, and people just craved, they missed so much the ability to high five, hug people, be able to emote, be able to be a part of something. And so I think sports is really, and sports teams, what we're building is a platform-like company. We're a tech company. Mm-hmm. And we have distribution, we have the IP and the teams, we own the network, we own the venues. It's a bricks and clicks business. And so, I think these will become an asset class. And I would expect at some point a bunch of these assets will have to IPO.
Who does it really well in your industry besides you in terms of managing?
Well, Madison Square Garden started and wrote the book. Now they have many different companies. They put their teams in one asset, their real estate network in another asset, the Sphere. Liberty Media, they own Formula One, which is an unbelievable property, and the Braves, but it's tracking stocks. There's no real pure play public company that you can look at and say, here's what the teams do, here's what the venues do, here's what the network does. That's how we're operating now, like a pre-IPO company.
We got to run, but one last question. As a value play versus where you think multiples and prices are on leagues. So you look at the NBA, you look at Major League Baseball, you look at hockey, you look at the NFL. Where do you, or WNBA even, where do you think the opportunity lies at this point in the ballgame?
Well, basketball is the world's second most popular sport. Over 1 billion people identify that they are very enthusiastic about the game. The players are charismatic. They don't wear helmets. You sit right next to them. I think the move to digital, the move to be global, I think the NBA is talking about expansion. They'll be very mindful and thoughtful. But we're in China. We're in Africa. Africa has the most young people. We're looking at Europe. I think we will be a global platform, and the WNBA will follow. The WNBA is the growth stock. There's more women than men in the world, and I think the popularity that you've seen in the last couple of years has been dramatic, and everyone wants to be in the WNBA now.
Ted, it's great to see you. Thank you for coming in.
Good to see you
nice
guys.
to see you.
All right, up next, Congressman Raja Krishnamurthy on growing national security concerns of undersea communication cables. We'll be right back. Three Republican House lawmakers sent a letter to the CEOs of Alphabet, Meta, Amazon, and Microsoft asking whether they've taken steps to address national security concerns over submarine communication cables. Joining us right now is a ranking member of the Select China Committee, Democratic Congressman Raja Krishnamurthy of Illinois. Congressman, welcome. First of all, I think you know what this is about. This letter you didn't sign, but I'm hoping that you can explain what's at stake here.
Yeah, I actually echo the concerns of this letter. Just to level set for your viewers, the vast majority of undersea cables in the world are built, owned, operated, and maintained by private entities, including Alphabet, Meta, Amazon, and other companies in the US. And so what we're saying to these companies is be very, very careful about not using CCP or Chinese Communist Party controlled entities to either build or maintain or service those cables, because they have a history of potentially nefarious activities regarding those cables.
What do we know in terms of the demonstrable risk and what you've seen on the maintenance piece? I understand buying cables, for example, from the Chinese clearly would pose a problem, but on the maintenance side of it?
Same issue. Basically, unfortunately, in these CCP-controlled entities, they are tasked often by their intelligence services to conduct surveillance, to hack into telecommunications networks, and they collaborate with those intelligence agencies regarding the same. That's why, for instance, Huawei, which by the way is a big player in actually building these undersea cables, as well as SBSS, another carrier or another company that maintains these cables, should not be used by American entities. And so we are telling these companies, again, be very cautious about working with the CCP, and I actually support the FCC, which is now putting in place rules which would prohibit CCP-controlled entities from building or maintaining or servicing these lines.
Let me ask you a broader question. For many years, Huawei and a number of other Chinese companies, basically built out the infrastructure in places like Africa and parts of South America and parts of Europe and elsewhere. And they really got to dominate those spaces in part because they were providing much cheaper service, or at least cheaper products to those places. Do you think the U.S. made a mistake in either not trying to subsidize American business to do that? These cables, which you talk about being Chinese, what do you think I hate to use the phrase industrial policy, but do you think we're supposed to have an industrial policy around this, not just to tell companies what to do, but to make it so it's economically feasible or not?
I don't know if it's industrial policy, but we need policies that basically do what you are saying. We've basically left the playing field, so to speak, to CCP-controlled entities to dominate the landscape, especially with regard to telecommunications, especially in Africa. And our repeated failure, for instance, to have an offering similar to what they call the Belt and Road Initiative means that we are essentially ceding a lot of commerce to these CCP-controlled entities. And essentially what's going to end up happening is that they're going to increasingly control these commercial spaces, whether it's in Africa, the Middle East, or in the developing world.
Congressman, we want to thank you for joining us this morning. We will talk to you again very, very soon. It's a fascinating issue.
Thank you.
Okay, we've got some breaking news for you this morning. There was a report that we mentioned earlier that came from Semaphore that said Berkshire Hathaway-owned railroad BNSF had been working with Goldman Sachs and was looking into a takeover of a rival railroad. We can report that that is not true, at least not true in terms of speaking to anyone important at Berkshire Hathaway who would be making a decision on this. Just got off the phone with Warren Buffett, who said he called Greg Abel, and no one from Goldman had spoken with either Goldman or with either Greg Abel or with Warren Buffett, and that, by the way, they would not be seeking advice on what to do on something along these lines. To answer, it's kind of what we had expected at the time. Just knowing Berkshire, knowing how these things operate there, it didn't sound like a plausible story. There may have been someone from Goldman that contacted someone else, maybe trying to sell something. But just to be clear, this is not Berkshire Hathaway working with Goldman Sachs to try and figure out what to do with BNSF or to buy a rival railroad. So we can clear that up.
Take that off the list, at least for now.
For now.
For now.
Yeah.
When we come back, a lot more. Quick check on the markets ahead of the opening bell. We'll be back after this. Quick final check on markets before we go. Got some green on the screen. 10 points on the Dow. S&P 500 looking to open up about 10 points higher as well. The Nasdaq up about 4 points. And let's show you crypto, by the way. We're at what close to 120 again.
I think it was 118.5.
118.5, and you're looking at the 10-year at 4.3. You're looking at 3.8. There you go.
Climbs again.
Climbs again. A lot of news today.
A lot. But that's okay. It's Tuesday.
Good.
We're here to get through it.
Big week ahead. We got a lot of earnings that are going to be coming in tomorrow. And by the way, the CEO of Coca-Cola is going to be hanging out with the gang on Squawk on the Street in just a little bit. Their earnings out this morning as well. Make sure you join us tomorrow. Squawk on the Street begins right now.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Colonel Quintanilla with Jim Cramer. David Favors back at post 9 of the New York Stock Exchange. Stocks are set to add to those recent highs as a few companies trim guidance or at least quantify the impact of tariffs. Goldman today says the labor market is set to approach what it calls stall speed, 10-year 4.36. Our roadmap begins with earnings season ramping up. GM, Coke, defense stocks, and the home builders are all on the move.
Plus, we're going to keep an eye on shares of Alphabet, aiming for what would be its 10th straight day of gains. That would tie its longest streak, at least in the company's history. And the road ahead for the rails. We'll have the latest details on at least what might be that potential for M&A in that industry.
Let's get right to the markets, coming off another record close for the S&P and the Nasdaq this morning as investors digest this morning's batch of earnings, including Coca-Cola and GM. Jim, we talked some Stellantis yesterday, and GM does quantify at least the first half tariff impact.
GM, look, they obviously have a tariff problem. It's much bigger than a lot of people think. the theme of this quarter is that you have to have a tariff problem, and then you make it smaller. RTX did that. It was like, wow, we thought it was going to be like 800, it's going to be like 500. So when you see something that it seems like a very large number, it's entirely possible that people say, well, wait a second, that's not so good. I'd like to point out that there was a lot that was good. And I think that Mary Barr is doing a very, very fine job, because the only thing, added costs, but they're selling. And I think that those who want to sell the stock, go ahead, but I think that this is just another good quarter despite the cap. I think they can handle it. You disagree?
Do I disagree? No. I mean, the visibility in terms of the impact of tariffs and what they're doing to mitigate that apparently did not yet come to the fore in terms of this quarter. So I guess, what did they say? Impact would be $4 to $5 billion over the course of the year.
4 to 4.5 for the full year.
Yeah.
And we're pacing about in line with that, he says.
Right, and believe me, they're going to have a lot more that I think can go their way. When I was speaking to Cleveland Cliffs yesterday, to Lorenzo Gonsalves, who does not say hi.
Tell him I don't say hi back.
Okay, very good.
Yeah.
I mean, he's just talking about, look, this is the beginning of a lot of different things. It's very in flux. GM has, Ford has told me that GM has much exposure versus Ford. So I'm looking for Ford to have a good quarter. By the way, Ford's going from 10 to, Ford's making a 20% move here. So I look to see who has the most exposure. And I've got to tell you, Ford was right when it said, be careful GM. Because everyone in the industry knows that there's a lot of companies ship a lot of stuff, get the Allison motor down there in Mexico, comes back. GM, David's like back and forth with the car, back and forth. That is not what they want. Coca-Cola. Now, I'm going to defend James Quincy here.
All right, we've moved on. I just want to make clear, we've just moved from the autos to Coca-Cola.
Well, you've been away.
That was a seamless transition.
You've been away for 2 weeks.
Seemingly, apparently, having nothing to do with anything.
That you get to speak at the end of the show.
Oh, I did. Otherwise, I don't.
I thought that he was saying GM and Coke.
I listened to you yesterday. I listened to you guys yesterday, and you're right. I don't think you need me here, but I'm still here.
Give me your GM rap.
So deal with it.
Give me your GM.
No, I actually
now
wanted
you have no dog in the hunt.
Now he's referencing a. Why are you bringing that?
Because it's hilarious.
It is hilarious.
Go ahead.
All right. Coca-Cola, you were going to make a point. I just was
okay.
stating the transition from GM to Coke.
Okay.
Yes, Coca-Cola did.
I had a funny thing to say. Okay, that was my point because you're here.
I trampled on your joke.
There's going to be cane sugar.
Yes.
Everywhere. You'll be able
A
to
lot
get
of cane sugar because that's what RFK Jr. wants. What?
No, the president likes it.
Right.
He's in charge, the president.
Without a doubt, of everything. And we'll get to the rails in the next block, but so much of that will potentially come back to the president as well, potentially. So you're right.
Well, I just think that Coca-Cola was actually a good quarter. Was it perfect? No. They have a problem. Look, everyone, they have a problem with aluminum. They have a problem, David, a tariff problem. The only companies that didn't seem to have a tariff problem today are the housing companies. And I thought that was very interesting.
Yeah, let's wrap up Coke. We're going to talk to James Quincy later this morning.
Absolutely.
Case volume was negative on a global basis, down 1. Price mix up 6. They did say the sugar soda, Jim, will be an addition designed to complement our core, strong core portfolio.
Now, when I owned Bar San Miguel, we would serve Coca-Cola. We banged them for $8. I mean, people really wanted that stuff. But it tastes very sweet, and it's natural, and they've always been able to supply here, so that's not going to be a big problem for Quincy.
Right. We were asking questions last week about the corn lobby and whether or not they're really going to cede huge parts of the market to sugar.
He's making it. This is another thing that James is really, really good at. Was it the blowout quarter that I'm used to? No. There were some regions that were weaker, and that was hard.
Well, and we came off Pepsi last week, where a lot of that weakness was centered in North America.
But Pepsi had the anti-GLP-1s. That was the beginning of the end of the era where people just said, you know what, I only need to eat one. They're back. The eaters are back. And by the way,
Wait, what? They're back? They're done with their GLP-1s? We haven't even started the oral dosage when everybody's going to be getting these things.
The cheaper way to get the GLP-1s has gone. It's done.
You mean like hims and hers and
Exactly.
the ability for these,
Exactly.
right?
That's
okay.
what I'm talking about.
Okay.
And-
But the idea of widespread usage of GLP-1s, which really we're still in the earliest days of when we get the oral
Well, absolutely. I'm not going to
dosage
disagree with that.
from Eli Lilly sometime next year.
Same day. Absolutely. I think you're really right.
So we haven't moved on from the impact that that's going to have on companies like
But did you
Pepsi
see
and
the
others.
Pepsi number while you were away?
No.
It was fantastic.
Okay.
And Ramon LaGuardia is delivering. He's delivering more than James because he's got snacks that have been nowhere.
Right.
The stock was at 134. Everyone thought it was going to go to 129, where it would have a very big yield. LaGuardia pulled a rabbit out of a hat. James Cuisine did not pull a rabbit out of the hat. He's got tariff problems, and he didn't have growth in certain regions. And I don't think he was consumed by sugarcane, but it certainly hit him.
Yes. Let's turn to some of the defense names reporting today. Lockheed is the biggest drag. This Oppernet miss, Jim, is kind of jarring.
Well, we don't really know. There's a stealth problem. We're not sure exactly what went wrong. I will say, much to my chagrin, because I really, really like him, the long knives are out for James Taylor, Lockheed. They just are. All they ever hear about is that the stock's not going to make. The company's not that great. Now, they do have this F-35 program, and we can talk about that because we have RTX there. RTX seems to be doing better with that.
Yeah.
David, I think that when I look at what James is doing, I mean, I don't know the program that he's being hurt by.
The aeronautics classified program has experienced design, integration, and test challenges as well as other performance issues.
So what is that?
I don't know. I don't know. I don't know what that means.
You said something to me about drones. There's Dexter Filkins' article in Atlantic that says, listen.
What's in the Atlantic, not the New Yorker? Okay.
I'm sorry.
Is it?
No, New Yorker.
He usually writes for the New Yorker.
New Yorker, I'm sorry. But what's very clear is that there's an unmanned effort, a drone effort, that's big.
You know, the generation of new companies in defense has grown dramatically, I think. These are private companies. Anduril is a name that many of our viewers may have heard of, but there's many others. That's where the capital right now is at least going.
Yeah,
to your point about drones and the change in warfare, obviously we need to look no further than Ukraine. The Wall Street Journal, which does such great reporting on that conflict, today has another story about how it's become almost purely a drone war.
Right.
Now, unfortunately, it's still killing. Still killing as many people.
I'm going to disagree with that. Why? Because Chris Calio, who runs RTX, said the Patriot missiles are needed because the Russians are constantly sending missiles over.
They are. They are still sending missiles. I guess. Well, on the front lines, though, it's all about drones and how you prevent the enemy from advancing. I mean, everything. And obviously, we know the Russians have been using a version of the Iranian Shahed drone, and they've been ramping up their own production as well. But the point I'm making is there's a new generation of warfare that's happening, I guess, right in front of our eyes here, and that is not being lost. I'm sure many of the main contractors are focused on it, but there is an entire group of companies
You're so right.
that are private that are focused on it.
Also, Wahid Lawabi was on Mad Money. Now, he is the CEO of AeroVironment, and they have a gun that shoots them down, and it's a couple of pennies. So that's the hope. But what David is right about, I mean, not that you've been wrong about it, but you're really right about, is that there's a crisis at the Pentagon. Now, RTX would tell you that they still want manned vehicles, but there's just a lot of people who just say, pilots are too expensive.
Yeah, well, I mean, not to mention our main rival, if you view China as that, what they've done in drone technology, and again in so many other areas as well. I mean, they got a city that basically is like a drone test center. Apparently, anything and everything gets flown around there. You can have your lunch delivered, your cup of coffee. I mean,
hey, wait a second. Amazon,
virtually everything delivered by drone.
Amazon can do that.
Okay.
But Amazon doesn't have military drones.
No, they don't.
No. But I do think that we're going to have to start focusing a la Palantir. I mean, Palantir is behind a lot of the effort to have contractors be competitive and to have They gotta get diet. When you let me explain.
They're not making drones. That's a different, entirely different subset of defense.
But when you build when you build a fighter pilot, when you build a bomber, they have triple redundancy. Now, triple redundancy is really expensive. One engine gets shot, then another, and then they have a third. That's really expensive. That's one of the big reasons why they're overruns.
Because you have a human being inside, yeah.
Right. So how about you take out a human being, then you don't have to have any.
No redundancies.
Right?
It's a lot cheaper.
Right. And frankly, a lot better. Because we lose a pilot, and we can't do that. We don't want soldiers, we don't want people getting killed.
There are a bunch of movers to get to this morning. We will touch on Danaher, Philip Morris, the home builders, Sherwin-Williams, PACCARs, there's Sarepta news. We'll, of course, get to Open Door. Take a look at the pre-market here as we kick off a busy session. So Walk on the Street is back after this.
Insurance.
All right, welcome back. Talking more about the rails, of course. The last thing I kind of left everybody with before I left on vacation was the idea of rail consolidation. My partner here paid close attention at the time as well, and it's only picked up in terms of the chatter, in terms of some of the reporting about various companies hiring bankers. Let's wait a bit here and see when we really can find out about talks between the likes of the UNP and a Norfolk Southern, or perhaps the Burlington Northern and a CSX. That's kind of where the focus is right now, Jim. And then, of course, the focus will turn if, in fact, we do get talks that result in some sort of transaction potentially. Then the focus will turn to the Surface Transportation Board and to, of course, as you mentioned earlier, the president, who in this administration, virtually every decision seems to be made by him. And one would expect that would be the case here as well. There previously, of course, had been a belief that you would not see any further consolidation in the rails, as I had reported a week and a half ago, or whatever it was on that Friday. That was being challenged by many people who were saying the idea of a transcontinental rail would be a positive for U.S. competitiveness and for the reindustrialization that the Trump administration has been focused on. Take a listen to the Transportation Board chairman. This is about a month ago. He was on the Freight Watch podcast. Here's what he had to say, broadly speaking, about the industry and their goals.
When you think about the use of the board's authorities, it directly benefits the companies, including railroads, but obviously shippers that are part of that reindustrialization picture. Time is money and this sort of stuff. Capital can't wait. And so the longer it takes to know whether or not a transaction or construction is approved, whether or not you're going to get that rate, whether or not that practice can continue, whether or not you're going to have the access, whether or not that state law or local law that's unduly burdensome will be preempted. The longer that takes, the harder it is for you to engage in the business decision and planning that are going to put people to work in this country and to grow our economy domestically. So that's how we fit into this. And that's what we have to think about every single day is...
Okay, so, if they get a transaction in front of them, that's the guy, and obviously the Surface Transportation Board will be weighing in. Importantly, kind of interesting to hear his thinking about it. Again, one would expect if the president wants it, it will happen. I should mention Becky Quick reporting, on these reports about Berkshire hiring a banker. She, at the end of Squawk Box, shared her reporting saying that it's not true, at least not true in terms of speaking to anyone important in Berkshire who would be making a decision on this. She spoke with Warren, who said he called Greg Abel. Nope.
A lot of stuff that you all say is not true. I got a whole list. Big list. Good morning, retail traders. Oh, 629.49 to break. On the SPY, Tesla, I seen that 625 this morning. PLTR, Netflix had a downgrade. Schwab tried to pump it yesterday. You can't pump a stock that's up thousands of %. What's going on here? Oh, darn it. Nike at 74. Nike had a breakout yesterday. Coin. Intel's got earnings coming out. We got Coca-Cola. Coca-Cola called 68.79. What's 69? The LLY yesterday we were watching. Meta. Descending flag on LLY. I really like Meta when it's around 700 or under it. I'm doing what you call just on the top of my head stuff. Stocks that I constantly watch every day, just see if we had a nice little double bottom or something. Everybody should have a top 10 list. Yeah. We got Red Book sale at 8:55 Eastern. We got Richmond Fed Manufacturing Index at 10. Treasury buyback announcement at 11, which these bastards. Money supply at 1. An API crude oil report tonight at 4:30. 11 a.m. we got 4-week bill announcement. Fed speakers. (8:30) Chair Powell welcome remarks. So the Richmond manufacturing thing at 10 would be at 9 my time. A lot of red in the market. Sugar. Top shareholder meetings. We have Mullen. I wonder if they're going to go big K. MULN. And then we had TLRY yesterday running on the pot sector. And what was that? What was that one yesterday? The real estate one. What was the real estate stock yesterday I was watching? Open. Kind of want to swing this long. I almost got this thing yesterday on the dip, but I didn't do it. I'd be up a buck. Good morning, YouTubers. Good morning, room. I need my excitement to come back in this room again. I kind of got disappointed yesterday. Not with trading, but with just a certain individual. AMD, TSM, NVIDIA bounced back. It hit 169. There's another one that was on my mind. Boeing. Oh, airlines. What was airlines? Love? Was it Love? Love in the air. Love and AAL. Bind. Bind had a good run yesterday. Yeah, 388, man, damn. Fake meat. And then GM's earnings came out. Hit my support that I called in the video. This is a pump. Wall Street pump. And Uber. And Dash. And we got 3 minutes left. Gosh, do I have time to make a cup of coffee? Good morning, Robert. YouTube. Good morning, S. I'll just start calling you S. I like Sheba though. Good morning, G, Jesse, Magnificent, Richard, RTP, and R, and Subway. Initial reaction to J-Pal today. I'm going to say, it's hard to say. I think it's meaningless, whatever he says. I'm going to say, are we going to pull back? That's the question. Down and up. Or just down. I don't really have a hard time of guessing which one's going to be. So I'm going to put in no change and we'll go up. Initial reaction to J-Pal's speech. I'm going to say up, down. Down, up. I'm going to put no change. I like the, no, I'm going to change it. Can I change it? I'm going to go with down, up. Yeah, I'll stick with down, up. What the heck? Uh-oh, did I just remove all the votes? Yesterday really kind of was a hard one to deal with. Slash ES is pulling back here to the VWAP, or let me see. Oh man, this looks good. Right to the... We're at the 200 on the 2 minute, and we're at the orb, which ain't been created yet. In the 30 minute, we're on my trend line. We got a support at 33.40. SPX. Today's 22nd. The 63.20s. 6320s. $63.20s at $3. July 2nd. Oh, I won? They're $50. Well, that didn't make sense, how it dropped like that. Kind of fibbling around here. We got resistance to break at 63.06. If you want to take profit, take it. 350. I'm going to see if I can get a little bit more out of it. It's 360. $390, baby. Now, we're at the top of the orb. $420, Randy. Dang, it's 450. So when I looked at the /ES, that's why I took the trade, 480. We were at the 200 on the 2 minute. We were at the bottom of the orb. We were hit the bottom of the trend line on the 5. And same thing on the 30 minute. Now we've got resistance levels. $5. Shit. Oh well. $5.40. Come on. Dash had a knife. Yeah, I just can't listen to this crap anymore on CNBC. Why in the heck are they interviewing some guy about sports? Has nothing to do with stocks to me.
Beatings as far as
They just got too political for me. I really don't care about them. Wonder what WBA's deal with that. Let's take it off here. X, gotta go. Cleaning up the watch list. Snowflake, AI, Erica, $110 million funding round. So watching the video here. I got 166.89. What am I thinking here? I got an A+. Thank you, S. I'm going to start calling you Shingles if you don't give me something to call you at. Give me a nickname, S. I don't like the word. I don't like S. Is it Sheba? He likes shingles. I'd call you a piece of... No, I wouldn't do that. I like you too much. I'll call the guy yesterday a piece of work. Just watching the video. I want to look at Netflix, see if it's institutional trade. I still want it to come down. Okay, SMCI is pulled back, TSM pulled back, NVIDIA's pulled back, and AMD is the one that has nice rebounds with Netflix. Elon Musk says simply don't have the funding, doubts Stargate AI. They simply don't have the funding. Well, they can get the funding like you did through splits and stuff, selling shares. NVIDIA stock slips. Reasons to believe AI trend will keep going. Apple's online store is now live in Saudi Arabia. Kathy Wood pours $175 million into BitMine. We've got a VWAP scan. I'm going to see if anything coming up on it. Oh, Jivo. You got to watch AMD. It's the 25th. The 155 strike. Netflix. The SPY's at support. Double bottom, SPY. See if we get a reversal here. SPX is at 340 again, so let's watch it. Double bottom, higher low. See, there's 320. I want to see if I can get this double bottom. $310. There it is, 310. Another shot. Now this might be a little bit more riskier. No, he never does disappoint his head fudge buddies. Funk's looking at NVIDIA. I ain't gonna hold this sucker like I did yesterday. If it doesn't hold my support, I'm gonna get the heck out. That just disappointed me. I don't like staying in a trade over 2.5, 3 hours, especially when they're red. Here comes the sell-off. Now these fat cats, I don't want duplicate. $260. This will be my last one. We got 6. 2 at 310 and 4 at 260. Fat cats are definitely want to rotate this market. NVIDIA at 166. We got a triple top right here around 159.53. $159.68. And another one right here, 164.48. XYZ got pumped the other day. Yeah, darn, this ain't pulling back. That's some politician on Squawk Box bashing China again, Democrat. Jimmy said in his video that we'd get a market pullback, and he was right, and to buy the dips. They're definitely dropping the bucket on this, so I'm going to add a bunch of them right here. We'll get to $1. 1.35. NVIDIA is about to hit my first support, 164.48. Come on, let's go. So I got 182 here. I got 18 of them at 182. NVIDIA just 10 cents off my support right now. AMD at 124. Now it's no, it's not too far out of the money. The 155 strikes on AMD. /ES is reversing. Had a huge, pretty good little pullback, $20, 26. So I'm going to average 182. We've got to break the pivot point on the flag, on the snake. Netflix, still would like to see this go about $100 lower. Maybe a double bottom from yesterday. This thing's way overbought. Way too much pump. Google. I didn't look at Google. Knife on Google. Tesla hit 321. I got 303 for a solid support on Tesla. 303 something, 304. Open has a knife. Now this is a pump, but at long-term investment, I think it'll be worth your while if we get a good price, especially if they get rid of Powell. I don't know what's wrong with that guy. He just can't predict the future. Unless he in his heart knows that this market's way overbought. I'm still in the SPX, but I took some that are off the table. On that 135 entry. Let's change this to I feel dizzy. I have to stop taking that blood pressure pill. Let's see, alert. SPY says it's going to go down more. Open, nice call and open. Everything's consolidating there right now on the pullback in the chips. AMD, TSM, SMCI, and NVIDIA. So 95 cents added on to, took off, sold 135s, now I'm at 95. $0.95 for the SPX. I'm going to trade this a little bit different than I did yesterday. Definitely in a bear mood. We got a tweezer bottom on the 1 hour on NVIDIA. Now, I might scalp the 95 cents and keep on doing this. Yesterday, that was my problem. I didn't get in and out of that lower one. I could have made a little bit more. But it turned out good. It still turned out great, but I mean, God, it was tough. Three black crows with a tweezer bottom on the IWM on the 5 minute. We're at resistance at the 200 EMA. We've got a fallen wedge on the QQQ. Fallen wedge on SPY. And a fallen wedge on the SPX. So we might see an upside here. Let's see. AVGO's down $10. Coin's down $10. Meta's down $8. Meta's my favorite one of my favorite ones right now. I haven't been thrown in jail for. I got thrown in jail 3 times when Biden was in office. They didn't want to hear about the laptop, that's for sure.
Communications.
And I posted a crack pipe with Hunter, and they throw me in jail for that one. I think they threw me in jail for something else. So I got 63.20 with an average of 150 something. 5. We got to break the 21. We got a double top coming up. How are we doing? Opens halted. On the way down or up? XYZ's double topping. Oh God, they're halting it now. Man, that would have been a good trade. I'm liking this open. In fact, I might send Zach Morris, tell him it. He don't say much to me anymore. He should. So PM. This is the one that Philip Morris. I think I called a pullback on this one too. 165.78 is what I have. I got 156.26 to go long. Oh, I didn't see this. Dadgum, I missed that. Should have brought it up to the hour. I didn't do that on the video. $163.45. If I'd have saw that on the hour, I would have put that on there and called it a pivot point. Maybe disregarded this down here. Okay, we're at 90 cents. We got a no, we don't. We got a bull flag. Coming up on a triple top. Oh heck, I've had this thing on my arm. My blood pressure. I notice I've been feeling a little bit better. I've been break it. Take it to the 63 and exit. If we break this triple top, now this is a bull flag here. Can you get out now and sell these for $100 or 200? I mean. No, about 100 and something. There's 110. Break it. Can you do it? Do it. Do it till you're satisfied. Whatever it is, do it to ease your mind till you're satisfied. We got a triple top. Come on and do it. To the VWAP on the SPY. Mm. $120. NVIDIA hit the 9, or hit the 50 SMA. We're at the 9. So we're squeezing. We got the 9 crossing the 21. As long as that stays above the 21, still bullish. But let's be careful. Definitely the fat cats are putting it out there. Love's up. Target's above 100. Disney, God, the crappiest stock out there. Open's reopened. Pun intended. Today I'm going to have a slider and a chicken barley soup. Good job, Jesse. Philip Morris did hit my third support. So what's a V? We think the brand VEEV. I'd turn it. I didn't look at still got my blood pressure. It's like I forget about it. Get one more shot. ENPH was one that I wanted to trade and I forgot about. Big pop on it. Oh dang, 110. A little lightheaded. Netflix has a snake breakout, pull back, higher low, triple bottom boom, or triple bottom. NVIDIA has to break the 50 SMA on the 1 minute. Oh, this thing's going back down again. This is where it really needs to squeeze right here. In the video. I'm definitely not feeling very bullish in this market right now. Or the fat cats. I am, but the fat cats aren't. Break it! We're at the shoulder line of the head and shoulders. Slash ES is popping a little bit. Go, baby. Okay, we're about to hit my old resistance at 62.96.90. The 3 white soldiers. See, I can tell. I'm going to show you a little trick here when you're reading these charts. You got your left shoulder, head, right shoulder, right shoulder. So that's why I said we're getting ready to squeeze on that second touch of the right shoulder. That's where it has to break to be bullish. And we broke. And we lead it out with 3 white soldiers. So we run it to the 63, which was my resistance level. I could have scalped in there for 150 bucks or 200 and 300. But I'm going to hold on to these, see if we can get up here. Once we break the 63, we have a little chance of it going up one more time. And I got an average of 155 if I sold them all together. And the breakout on slash ES So what was that railroad news? 120. I'm gonna give Squawk Box some shit here. $125. You can get up now if you wanted to. 130. $135. We're about ready to hit my resistance. $145, yay! 150. Can anybody tell me where the next resistance is on SPX? S? S. Speaking to S. Private message. It would be the double bottom. Oh shit. Oh. Yeah, I'm debating on taking profit here. You probably have to wait for 6306. You're going to have a little bit of resistance right here at 6302.47. And that's probably where I'm going to go ahead and scale out. I should scale out now. I mean, I'm looking good here. $30. In 2 minute. $63.41. God. Really? Oh, on the ES? Yeah, 200 SMA. 63.40 on the 2 minute. We hit the 9 on the 30 minute, and we hit the orb on the 5. Sold some at 180. So we got to maintain the 9 to stay bullish. That it drops down to the double top at 62.93. Triple top almost. And it could be a triple top. And it could be higher if we put the triple top right here. It would have to be the 63 and the 9, somewhere in that area right there to stay bullish. We've got an upside down pennant flag, symmetrical flag on Netflix. How about my lifelong love for RITM? As long as I'd known you. Whoa, you broke resistance. RITM Capital enters partnership to fund acquisition of residential transitional loans. Up to $1.5 billion of residential transitional loans. So got news today. Partnership. Yep. So far I'm having a green day. I'm down. I sold a lot of my contracts there. I got 6 left. And I'm thinking about adding 12 more again and get back to 18. That's the 3rd time now. I'm scalping these a little bit different today. I'm taking my lowest entry and selling them and then buying the dip. Yesterday, if I'd done that, I'm not sure. I might have come out green. I did come out real green yesterday, but man, it was a tough day. Opens back to 327 with a double bottom, triple bottom. We got a falling wedge, could fall to 315. 310. We kind of broke out of the wedge and pulled back, squeeze point. I'm going to turn that air conditioner off. We're going back to 140 on these. NVIDIA held my support. We got a new high on the low, on the bottom. Oak. /ES on the 1 minute hit, 5 minute hit the orb as resistance. We break the 9 on the 30 minute, we'll move higher, or the 50 SMA. Come on, break out. AMD at 187. AMD had a nice little bounce. Get the market minute. How long does it take? An hour? Back to 95 cents. Okay, 95 cents. We definitely almost hit that double bottom or hit that orb. That's where I exited the last time. That's on the 1 minute.
And CMG tomorrow, and then you guys were covering GEV.
Got back in at 95. I sold my last ones at 95 to 180. I'm back in at 95. Got to hold this support. This is a pivot point. This is an ascending triangle or a rising triple top. We held that first soldier. I'm gonna go put my coffee together and make my lunch. I'm still watching this thing from afar, and I'll be right back.
Much bigger as we move out of banks and airlines into large cap tech. Things are going to get a little more exciting, Nicole.
Yeah, and Kevin, quickly, Northrop Grumman and some of the home builders, D.R. Horton Multi Group, Lennar, are some of the leaders in the S&P 500.
Honeywell.
Any thoughts on those groups?
Yeah, it's just an interest rate thing, right? The home builders and housing in general has been such stuck in the mud because of interest rates. And if you notice, last 5 days, interest rates have started to drift lower, and now we're starting to talk about second and half of the year rate cuts.
So you heard what he just said. I wasn't trading stocks back during the Carter years. I did buy Walmart because I worked at Walmart. We used to inventory them, so I had some Walmart shares for quite a long time. But I don't understand why Powell's punishing the poor and the middle class and enriching the top 1%. He's way behind the curve. On the /ES Shiba, we're above the VWAP. We could easily pull back to it. And we're at 110 now at these 95 centers. So we got a triple top. Pay attention to this triple top coming up. Ladies, I had to adjust to my boys. Triple top, triple top, triple top, triple top. Let's go. Double top, double top, double top. Let's go. Now you can exit this trade at the triple top. The 95 centers. Centers. Not centers. Center. CENTER. I might just sell them all in this next round and get out of it completely at 155 if we hit it. We have a triple bottom too. So your next resistance is the double top. Oh no. This is my third scalp on the bottom. Each one of these dips. And we're at 140, so I can get out of these with a nice profit. Almost 900 bucks. The 95 cents. But I want to see if we can get it up to this next resistance level. We got a wick right here. I'm going to explain how to trade the wicks, how I trade the wicks. Okay, let's go through this real fast. So I can get out of here at 140. So I don't think there's too many people that trade like I do, but we have the bodies of the candles. Okay, I draw most of my trend lines on consistency on the bodies of the candles. So anything, the wick is a gift, in my opinion. When you approach that wick resistance, that could be an exit idea for sure, because that'll be, harder to break. You have a lot of hot air. You have nothing else to look at. So when I get to a double top on a wick, I have to think twice. If I have to think, okay, we passed the body. Should I go ahead and sell it at the wick and take this gift? Because we're going to consolidate off that wick. Jimmy called AMD this morning at 150. Now we're at 153. AMD's been really good bounce backs on AMD. Love is at 327. Opens at 327. PayPal P. Was it P? PayPal P. PY what? I forgot what PayPal was. Let's look at GM. Kramer says buy GM. I say don't. I think Squawk Box is coming across a lot of credibility issues. I'll stick with Schwab.
Also throughout the program, let's take a look at some of the top moving stocks.
Even if I don't like this one new chick they got on here, she kind of sounds just like them. Like CNBC.
The best performance today after D.R. Horton and Pop Group reported earnings. Walk us through those numbers, starting with D.R.
This one's different. I'm talking about the brunette.
Talk about some clean movements to the upside, because I have been all over the place as far as the earnings names I've looked at today, which has given me basically no trend as far as what we've seen for earnings so far. But at least for the home builders, we are seeing this nice jump today in D.R. Horton on a profit beat, despite the fact they did still note some softening housing market trends. So as with everything, a bit of a mixed picture here, but I do think that D.R. Horton is one that is just so important to the entire space because it's so much larger than a lot of its peers. So for that reason, it commands more of the market share of the overall home building space. But buyback guidance was also lifted, so I think also worth noting, and they now expect their fiscal 2025 revenue to fall between 33.7 to 34.2 billion. At the midpoint, that's around 34 billion clean, so definitely ahead of the 33.9 billion consensus, and also ahead of its prior guide of around slightly below its prior guide of around 33.3 to 34.8 billion. They do expect now homes closed by home building operations to range between around 85 to 85,500. That was also slightly below their prior forecast, which at the midpoint were around 86,000. And they said, I mean, earnings still rose, and then we did see that actually it substantially surpassed the average estimate at around $3.36 a share. Estimates were around $2.90. And we saw that was at least, I think, encouraging on a consensus basis, but falling from a year ago. Same goes for their revenue. Revenue of 9.2 for the quarter did top consensus, but also dropped on a year-over-year basis. And the cost of sales also declined to around $7 billion from around $7.3 billion a year ago. Cancellation rates were pretty stable on a year-over-year basis, and there's a lot to be said about the value of homes right now. We are still seeing, I mean, the overall value. And the net sales orders did total just over 23,000 with a value of $8.4 billion. That was also roughly flat compared to what we saw a year ago. So it doesn't really explain why we're seeing a contraction in their top and bottom line, but they did say they expect their sales incentives to remain elevated. They also do expect now some further increases in their coming quarters, which will depend on, again, the remainder of this summer demand. And I also think that a Fed environment where we see further rate cuts, I mean, that does set us up for hopefully some improvements in the entire housing space, which has remained pretty challenged this year.
Yeah, it certainly has.
Wonder why, baby.
They do seem to be trying to address the affordability concerns right now with some of the deals, which obviously those home buyers are trying to take advantage of, which has been, largely talked about in the market today. But obviously they are using their margins to compete when it comes to those deals. So that's obviously something to keep an eye on in the future. What about Pulte Group? I mean, are you seeing this sort of same trend there?
Yes, and I also think this is an interesting one because they did highlight, you mentioned affordability. This is always something I just from a personal interest standpoint, I like to compare because Pulte Group's average selling prices for their homes that closed in the second quarter was around $560,000. So that actually represents an increase of about 2% from a year ago. So we were starting to see the average selling price for a lot of these names come down. That is now starting to rise again, which is not great for of course, if you're a buyer. It's a better seller's market still right now, but it does, I think, illustrate hopefully some resumption of the average selling prices growing again more consistently because we've been a bit choppier there. But Pulte Group right now has seen, consistently, I mean, it's just to me amazing their average selling prices stand at like between $570,000 to $560,000, which is considerable, of course, if for your first time home. But we also have seen, I mean, now from that pace of growth from last quarter start to wane a bit. Pulte Group, though, did say that the results are weakening because the housing market continues to struggle. This was a bit more of a doom and gloom report when you really get into some of the management commentary and the ways that they do still see a small tariff impact ahead. It wasn't hugely mentioned by D.R. Horton. So I think, again, could be the size of this company. They're about half the size of D.R. Horton. We did see them log net income of around $3.03 a share for the second quarter. That was down on a year-over-year basis. Total revenue also edged down to $4.4 billion from $4.6 billion, while their home sales specifically dropped about 4%. So they did say top-line figures in the quarter did reflect roughly 7,600 homes closed, a 6% decrease, which thankfully was partially offset by a 2% increase in their average sales price, again, of roughly $560,000. But home sale gross margin in the quarter came in at 27%. Versus almost 30% a year ago. And they did say the spring selling season in particular was one where consumers were dealing with these ranges of issues like interest rates, affordability, macro concerns. All that said, though, we do believe we could see hopefully some recovery in the back of this year.
Well, it certainly seems like investors are looking past any of the concerns under the hood and very much cheering what we got as far as those results you just broke down. Jenny, thank you so much. Very much doing the heavy lifting today and getting us across all those report cards.
Dang, she got that bit.
Now on the news that's shaping the markets, and for that, I'm very pleased to say we are joined by Ian White, who's the Director of Economics and Commercial Market Strategist
New high.
Commercial Bank. Thank you so much for joining me this morning, Ian, and joining us at the desk as well at the New York Stock Exchange. It's a funny old day, isn't it? Because, I mean, it's a bit quiet, certainly when it comes to the market reaction today, despite the fact that we've heard from a number of companies across a number of sectors and telling us a few different things. But obviously, we've heard from Fed Chair Jay Powell as well today. No doubt the market is keeping tabs on that, given the pressure we've seen building, certainly on the Federal Reserve Chair. How do you assess what we're seeing in the markets right now as we stand?
Home builders.
Jimmy gets the. Oh, Jimmy doesn't believe in the fat cats anymore. I just don't trust him anymore. NVIDIA, nice reversal with NVIDIA. 168.87 is the 200 SMA on the 1 minute. I don't trust the fat cats anymore. SPX back to the orb. I don't trust the fat cats anymore. I don't trust the fat cats anymore. Every time I listen, I wanna glisten, but I don't trust the fat cats anymore. Whatever happened to Caroline? I was about to send you 100 grand. All you had to do was go out with me, and I would put a ring on your hand. Caroline, I miss you. You left me here alone with these fat cats I'm jawing on my bone. Life is not the same. My life has gone lame. Caroline, please come home. Jim, you're magnificent. I miss your freckle on your right breast. I miss looking at that freckle on your right breast. I just have an image, and I didn't save that. I miss that freckle on your right breast. $63.41. Let me see. And you're on the /ES. 63.39.48. The 200 SMA on the 2 minute. What's up with MedP? Well, it depends on what kind of medications you take. Some will make you pee and some won't. MedP's clinical trial just soared. What caused the pop? I'll see. MedPlace stock soared a 50% Tuesday, trading after stellar earnings. Earnings. That's what's up with it. Second quarter on MedP at $3.10 a share, revenue at $603 million. Analysts' expectations was $298. So revenue was up, earnings per share were up. The company has hiked its full year earnings. A big old boost. So there's something going down there. They got the pipeline. I'm going to look at Coca-Cola. Oh my God. What happened here? I don't want to trade this right now. I'm going to go make my lunch, but man, I like it right here. I don't want to get stuck in it. Well, what the heck? 85 cents. Always clean. This is Washboardjim. May I help you? Mm-hmm. Really? Okay. I got the 6320s at 85. We're at $1. We're at 105. Oh, let me see what this chick's got to say. Okay. Mannequin's back. Where you been? I'm going to go into the kitchen to make me a slider and nuke my soup. Oh, hood. I was going to look at hood. There's somebody short hood. I fell in love with them sliders. I'm glad the hamburger did get to $7 a pound. Hot. Hot. Woo! Nope, back to 85. Protein Palace. I am. Powell speaks. Back to 85. Today's lunch was a slider and chicken barley soup. And it was seasoned perfectly. This would be a 5-star. If I was to cook you in a restaurant and you asked for a bowl of soup, I'd sell it to you for $20 a bowl. Well, I'd tell you, no soup for you. It's really perfect. It's really good. Funky's in QQQ. I'm in the SPX. The SPY has to break the 200 EMA on the 1 minute. Then you'll have a little resistance at 628.16 and new high on IWM. Or not a new high, but yeah, new high on the pullback. New high. IWM new high. We're at 95 cents. This blanket. Oh, yummy. I had a bay leaf in my soup. Secret ingredient, bay leaf. Cumin, garlic powder and salt powder, garlic and onion powder, a dash of salt, a little bit of pepper, barley, cup of barley, chicken boobies, celery, carrots, this is good shit. I'm glad I've switched to barley from noodles. Take away the carbs. Okay. Okay, back on track. It's lunchtime, and lunchtime is over. Let's see if that other travel agent got a hold of me. I got a prayer request. Clean, stocked, and ready restroom essentials for your business. Springfield Paper. Oh. Fleet Feet in Springfield turned 17 today. Might have some shoes on sale. A little bit of drama here. Slow down on trading this. The only ones that support right now is SPX and SPY. SPY's at support on it. 1, 2, 3 bits. We got a triple bottom on the SPY. Sue doing prayer request. Received a prayer request from John Bradley. Cynthia crashed on her bike last night. She's in the hospital. Oh, God. Bikes can be dangerous. She broke her femur, the ball on her femur, so that don't sound too good. So let's have a moment of silence for Cynthia to get better. Oh, shit. I wrote the wrong thing. Malcolm Jamil Warner, that's Bill Cosby's boy on TV, and drowned in Puerto Rico or Costa Rica. He's been in the news for 3 days. I don't know much about him. I'm still in my $85 calls here. Bounced off the triple bottom. Back to 90, baby. Take it. We're at the 200. So you know what that means. Does anybody knows what it means when we hit the 200 on the 1 minute? What's it mean? Tell me now. Tell me now. That's right. But I did not do it. I should have. Oh well, that'd have been a fast $50. How's your RITM doing? Open bounced off my support level, Jimmy said. 20 cents. 306 on the Fibbies. Tesla reversed $10 from the bottom. Tesla is at positive crossroads with Elon Musk's renewed focus. Dan Ives. Quadruple down, baby. And I think Funky likes the way I sing, don't you, Funky? On a 1 to 10, what would you give me, Funk? Hemptown races 5 miles long. Doo-dah.
You got false information. You got false information. You got false information.
I have a message to Squawk Box.
You got false information. You got false information.
The headline. Adam Schiff is 100% screwed. Packy accepts the contract from Mayweather. That's a fight I'd pay for. Because I don't think Pacquiao would play around with Mayweather. Funky, did you get out of the video okay? There's your answer for funk. I'm stuck in one trade, but I don't have a lot of them. But I've made it back scalping the SPX.
Time highs weaker today on the back of those NXPI earnings, but we'll talk Texas Instruments, and then we'll also cover, like Folio will cover consumer sentiment data in Hilton Hotels, which is just below all-time highs, also going into their earnings report, and then we're going to wrap it all up with ServiceNow, which is actually underperforming, down about 20% from those recent all-time highs into their report on Wednesday after the close. Now let's take a look at the indices here. The benchmark S&P 500 down just over 0.1%. The Dow Jones Industrial Average up about 40 points, fractionally higher. NASDAQ 100 down over 0.5%, and the Russell 2000 small caps up about 0.5%. In today's session, mixed across the board. Now help me break down all this market action. Let's bring in my co-host, and that's going to be Kevin Hinks. Kevin, give me your take here. A little mixed. Little consolidation after the S&P 500 and NASDAQ 100 hit all-time highs. Give me your take here on the markets.
Yeah, 9 straight days of rally time. Maybe a little fatigue setting in here as we wait for something relevant to begin to move the market in one direction or the other. I think tomorrow we'll get that with Tesla and Google Alphabet, but this is just more of, I think, fatigue than anything else, Tom. The earnings have been good. We can't argue with the numbers that these firms are putting up, but the stocks aren't, at least the earnings specific names aren't necessarily rallying with the rest of the market. But the rest of the market's been very strong. Yields have come down, crude oil's come down, and the market is drifting, at or near all-time highs. The S&P, the NASDAQ. I had the S&P and the E-minis around 68, 69 RSI. I had the NASDAQ around 70 and the NQ about 71, 72 RSI. So they're getting a bit lofty here, Tom. And so with Tesla and Google Alphabet coming up, things are going to start getting a little more exciting, but really not today, actually. I mean, the biggest headlines we can really make today are all the comments coming out from Scott Bessent, President Trump, Jerome Powell at this banking conference, Mohammed El-Arian, Bill Pulte from the FHFA. They're all making small headlines, but none of it is significant, Tom.
Yeah, you make a good point. It's pretty resilient when you've got, let's see, probably more than a majority of the Mag 7 names down today. NVIDIA off nearly 2%. Meta Platforms down over 1%. Netflix down over 2%. Amazon down 1%. But the market's kind of holding in there with the Dow and Russell positive. But let's expand this conversation, bring in our next guest. That's going to be Joe Mazzola, head trading and derivatives strategist at Charles Schwab. Joe, give me your take here because, if you look at the earnings, they're still pretty good. We've got some bifurcation that's going on with some of the moves that we've seen, but this just kind of constitutes the resilience of this market where traders aren't going to get all out of the market at once, right? They're going to probably just rotate into different sectors.
I think what Kevin said makes a lot of sense in that you're getting your, basically 85% across the board through the first 15% of the S&P 500 that's reported, but you're not getting a lot of follow through in terms of the rewards for that. And I think that's, indicative of a couple things. I think that's indicative of, valuations where we're currently at. I think it's indicative of guidance. And I also think it's indicative of, there's still some questions around what tariffs mean. I mean, we got a little bit of an answer yesterday from GM. 1.1 billion came off their bottom line from tariffs. And so we're starting to see, and we're going to see more, right, as we get into further along this earnings cycle.
Tempting to go out late, take a swim.
Next earnings cycle, the Q3 earnings cycle, where we'll really start to see what that's meaning to margins going forward. Because I think, even if you kind of parse out, Q2, just remember Q2 started off with a big bang, right? We had Liberation Day on April 2nd, and we can kind of get the pause, the 30-day pause, the 90-day pause on April 9th. And so, markets reacted favorably to that, but there's still a lot of question marks for the businesses as a whole in terms of what does that mean for their CapEx spending, what can they expect in terms of what can they do with their pricing, how much of that can they pass on to their suppliers, how much of that will they pass on to the consumers. So far, consumers have been able to absorb that, and then, last week's retail sales showed that. I think this week we get a look at durable goods, and we'll get a better indication there. But overall, earnings beats around 85%, revenue beats around 67%. Those numbers are good. I just think that, there's the combination of a couple of things. Number one, what is going to be the expectations for Q3, and then the guidance kind of built into those. And then number two, Kevin mentioned this as well. The idea that we're up, 9 days or 8 or 9 days basically in a row, there's some exhaustion up here. I truly believe that.
Yep, definitely, and maybe there should be some consolidation. Might be warranted at this point after this rocket rise. I mean, we haven't had a rally in this short a time from those April lows in about 50 years. So maybe some consolidation warranted. But Kevin, we mentioned the earnings reports that are coming out. The home builders are doing well after DHI and Pulte Homes reported. The bar was pretty low for these housing stocks going into the report. you're seeing those things explode. But then on the flip side, you've got, Philip Morris down pretty significantly, GM's down, and some of the other names that reported today, some of the LMT, Lockheed Martin. So it's kind of getting a little bit bifurcated, but is this that game of, the ones that have been outperforming maybe slide a little bit, the ones that have been underperforming, they're willing to buy at this point? Because if you look at it, the S&P 500 sector indexes, basically 8 out of the 11 are still positive today, but we're down because information technology and communication services are lower.
Oh, is that the reason?
Reverse.
That's not the reason,
Right?
bald-headed twit.
All the stocks that have rallied big up until now.
That's the
struggling.
reason.
And all the stocks that have been beat up, like housing, like home builders, remember the drumbeat of soft economic data when it comes to housing just continues. That said, there's a little hope going forward for the second half of the year. There's a little hope because the 10-year yield has drifted from 4.4 to let's see where it is now, 4.33. There's a little hope there. So there's hope is springing eternal for the second half of the year and a little housing recovery as maybe we get some lower rates. But this is the story. Remember, it started with PepsiCo, right when earnings started. They were kind of beat up. There was no good news to report, but they did a couple things and the stock recovered. So it's going to be no good news is good enough, Tom, and anything that can give you hope for a beat up stock can take that stock higher. And so far in earnings season, and I like to put themes and trends on earnings season, I think that's what it is. It's the reverse of the haves and have-nots, Tom.
Yep. NOC actually doing well. Northrop Grumman up 8%, kind of pushing back against what LMT is saying. RTX was hitting all-time highs going into that report, was pulling back here just a little bit. But Joe, I wanted to get your take here on these. We've seen that push into gold, 6-week highs today, back above 34.40 an ounce. Bonds have been catching a bid here. We got that 10-year yield, the inverse, down to 4.33%, as Kevin mentioned here. Starting to see a little bit of a push into those. Goldman Sachs came out with a note just this morning, forecast Fed rate cuts at all 3 of the remaining 2025 meetings, citing a stalling job market and stagnant consumer spending. What are they looking at, Joe? Tell me, because I don't see any of those things happening as this optimism about a reacceleration in the economy moving forward kind of pushes it back against that narrative.
I would agree with the stagnant jobs. I think that even though you might be seeing initial jobless claims come down a little bit, you're still seeing continuing claims grow, right? Anybody that's been looking for a job for over 6 months, I would absolutely agree with that. I think that we are seeing a stagnant job market. The hard part is there's not a lot of firing, but there's not a lot of hiring either. And once again, you can attribute some of that to some uncertainty for businesses going forward in terms of, not only CapEx spending, which you just talked about a few minutes ago, but also, hiring. And there's kind of a bit of a log jam right now in terms of the employment figures. So yes, we're not seeing a lot of layoffs and cuts, but at the same time, we're not seeing hiring. And you feel for the people that have been out of a job for the last 6 months because they're having a much harder time finding one. I do want to go back real quick, if you don't mind, Tom. You guys were kind of talking about the sector rotations and in IT and communication services and the haves and the have-nots. Just giving you an idea of kind of what that looks like in terms of prints today. So if you look at the NYSE composite, which is a little bit broader than looking at the S&P 500, right? You've got about a 3-to-1 advancers to decliners today on a day when the market is down 9 points in the S&P 500. So that's telling you that all of the weakness is really coming just from those two sectors, and the rest of the sectors are seeing some rotation kind of back into them. And you mentioned gold, but I mean, just take a look at materials and the strength that materials has seen over the last couple months. 85% of their stocks above the 50-day moving average. So that continues to be a sector where you see money moving into, whether it's copper, whether it's gold. Any of the minings names have done extremely well. So there's a trend that's going on, and I think what you're seeing today is maybe a little bit of a story there. Is being painted that we're taking some of maybe the gains out of some of the higher beta, some of the moves that we've seen in technology, and maybe some of the maybe some of the more speculative names and moving back into maybe some of the cyclical names, because we're not painting a picture, and I say this because I think sometimes when people see money moving out of IT and communications and services, they get nervous.
We got a volume squeeze happening on SPX.
It's just showing you that the rotation's occurring. And I don't look at the rotations that we're seeing now as anything to kind of concern me about a recession or slowness along the way. I look at this because I still see a lot of money flowing into the cyclical names, and when you see that tends to show you that investors feel good about the overall economy. The one thing, like I said, I'm keeping my eye on is labor right now, because we are seeing some slowness in the labor market. So that would be the one thing I'd be keen on.
Yep, we've been talking about that for the last couple months here, Joe, on the program, is the fact that I don't think the Fed's going to do anything until they see this job market cracking. You look at jobless claims, that gives us that up-to-date kind of read, and those numbers have actually been going lower the last couple of weeks. And unless that cracks, Jerome Powell is still on his high horse that there's no need to cut rates at this point. And if the economy does reaccelerate, why do they need to at this point? They wouldn't want to reaccelerate inflation at all. Kevin, Fed Chair Powell made no comments on monetary policy as he led off that capital framework for large banks. Scott Bessent, the Treasury Secretary, said, hey, no reason to get rid of Fed Chair Powell, to step down right away. He can do his last 8 months in office here at this point. But then President Trump was making some comments right before we came on air saying that interest rates should be at 1%. I get it. Every president wants lower rates, and it's always like that. It's always been that way.
No, it hasn't.
But at the same time,
you're an idiot.
If the Fed
Biden didn't ask for it.
Even though this rhetoric's pouring down on the Fed and Fed Chair Powell, I just don't see any reaction.
I'm done with you. You made every president. You said every president? You're full of crap. That upset me right there. Set him straight, Hickey.
Months of the Biden administration.
There you go.
Averaged 41,000 government jobs per month.
Per month.
In the final 12 months.
That's nuts. During the last year, they knew he was going to lose, so they went on a hiring spree and hired an average of 41,000 employees a month for government jobs that didn't need to be needed. And who's going to pay for that? And you wonder why inflation was up so high. Each one of them positions is an average of $65,000 to $75,000 a year.
Did in April, it gets very uncomfortable, but over time it gets less uncomfortable, and I think everyone is starting to understand the role that tariffs are going to play in the future, and the market is getting more comfortable with those tariffs. So I think you're going to see some extensions come August 1st. I think Scott Bessent has already kind of hinted to that, and there's a lot of rhetoric today, Tom, a lot of headlines, not only from Jerome Powell, but from Mohamed El-Arian, from Bill Pulte from FHFA. There's big headlines about Jerome Powell. You know who you should believe? Scott Bessent. That's who is the real mouthpiece for the administration. And he's the calm voice in the room. And he said, and you just mentioned it, there is no need for Jerome Powell to step down. So
there is a need.
If I'm going to see 10 comments, I'm going to listen to one. It's going to be Scott Bessent.
Maybe that's a safe thing to do at this point. All right, guys, let's take a quick break here. We've got a lot to get through today. We're going to kick it off with Texas Instruments. Chipmaker stock is up about 13% so far in 2025. They report earnings after the close. The stock's weaker, just a tad bit weaker today on those NXPI results. We're talking Texas when we come back.
Boom, baby. Let's break it. Break the orb. Let's do it now. Break the orb. Let's do it now. Woo. Break the orb. Do-do-do-do.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach.
I'm
It's
still in
interactive
them.
learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Fast Market here on the Schwab Network. We're talking earnings. Texas Instruments shares are up 14% so far in 2025. Just a couple, about 3% off of those all-time highs that we saw earlier this month. Kevin, when you look at this one, they're tied to, I think, just over 2/3 of their profitability or their revenue is generated from the automotive sector. That might be a concern because we're seeing the ramp up, but then what about guidance moving forward because of that pull forward on a lot of auto purchases due to the tariffs?
Yeah, they're also in smartphones and data centers, but I think the risk for them is in automotive because that's where a lot of their business is. Now, Tom, they got good news today in GM's earnings. GM EV deliveries like up 110%. So maybe the adoption is starting to pick up a little pace here. So that's good news for Texas Instruments, but that's their risk, Tom. And, Tom, we're going to say this a lot, so let's just start out with this little meme here. Show me the V, and the V in Texas Instruments is significant from, late March, early April to when it sold up to the bottom in mid-April and then all the way back up.
TXN earnings after close.
A 3-month recovery of 47%. And here's the problem that we're going to have in the next coming weeks. All these stocks are going to have big 3-month percentage moves. And the question is, can they earn enough or guide enough to hold these levels? There's the question for these stocks.
Yeah, Joe, about 20% of their annual revenue based in China as of 2024, and 70% of its annual revenues from industrial automotive. We've seen industrials, not maybe participate at the high end. Autos, we're going to see the ramp up smartphones that push into buying phones ahead of the tariffs. Also, that push forward that we're seeing. But what are your expectations here? Because it feels like Texas Instruments, the bar is high once again.
Yeah, no, absolutely. And then you talked about the idea of the pull forward, and I think that's what analysts are worried about as well too. Kind of a lack of visibility going forward after what was likely going to be a strong quarter. Expectations for $1.33 a share, which would be higher than $1.22 from the year before.
Well,
expectations are for quarterly revenue.
Love is love.
Billion, once again up from 3.82 billion year over year. So, yeah, I think probably a lot of the good news is priced in. When Kevin said, look for the V, I'm like, is he talking about volatility? Is he talking about, so Vega? I was like, okay.
The prison guys on.
Yeah, I get it, the V shape. So yes, I think we're going to see a lot of those V-shaped recoveries and it's kind of put up or shut up, right? In terms of, has
No, he
that
ain't the
been
prison
priced
guy.
in? That'll be an interesting one to see, because once again, it's going to be the guidance, and how much of that demand was pulled forward because of the tariffs. They did just announce, Texas Instruments did just announce.
This could go on all day.
About a week ago, the quarterly cash dividend of $1.36 per share. So there's some yield there for the income buyers, but we've seen some mixed reviews from the analyst community. We recently just saw Susquehanna raise their target to 250 from 220. A lot of the analysts are around, kind of keeping it at neutral at the 220 level, kind of where we're at right now. So that'll be an interesting one to see. The stock, as you guys mentioned, it's rallied over 40% from its lows. It's right at that 20-day moving average right now. It was overbought. If you want to look at it that way from an RSI, it dipped below that. To me, that's, like I said, that's more important than the overbought. It's the dip back below. And so right now, the RSI is about 58 after getting above 70 for a little bit. Options are pricing in around $11 move. So that's a 5% move through the end of the week, which doesn't necessarily signal elevated volatility for Texas Instruments, considering the IB percentile rank is around 25%. But it does price in, the possibility for some decent movement for about a $220 stock. It's not crazy to think that, or $215 stock. It's not crazy to think that this thing could go to 205 or could go to 230 either way, just because of the fact that it's had so much momentum off the bottom.
Yep, we always talk about that golden cross where the 50-day crosses above the 200-day. Well, it did, and that was the all-time high in the stock. It pulled back from those levels over the last week or so on that. But Joe, as you mentioned, option market pricing in plus or minus $9-10 move in the shares. Give us your example trade here.
Yeah, it kind of goes with the theme that we started off with a little bit earlier, that a lot of beats, but not a lot of rewards. So beats from the earnings, not a lot of rewards from the market. And so I'm looking for a little bit of a pullback, the potential for a pullback. Looking at the 205 put calendar, basically you'd be buying the August 15th expiration. You'd be selling this earnings week, all right? So you're going to get some implied volatility for selling that. And that's at the 205 strike. So buying the August 15 205, selling the July 25 205. Should be able to do that between, I would say, 210 or 215. I think I priced it up at 215 in this initial trade. It definitely has a little bit of a bearish slant to it. It's not exceedingly bearish, right? It's looking for a pullback kind of within that range, but it does give you a buffer down to around, that 195, 190 level should, you see a movement beyond that expected move. And it's not necessarily, a bearish take on Texas Instruments. It's just the idea that it's run so far so fast, and then just the market response to other technology companies that have beaten hasn't been specifically favorable at this point.
Yep, let's break this one down, because it's not short-term positioning, because you're buying the August 15th monthly option. So 24 days expiration, 3.5 weeks. Buy that 205 put, sell that same 205 put in the near term July 25th options that expire just 3 days. 215 debit, that's going to be your risk. Any debit you pay on this is going to be the risk on the position. So 215.
Okay, we're at 40 cents. So I'm going to load up the boat.
You see here from the risk profile, you want it to go towards 205, which is about that 1
Not yet, but I am.
To the downside. You got a range probably just below 200, maybe down to 195, and up near 210 to 215 to still be profitable. So while you want the 205 strike to be in focus,
right here,
you still have a range bound area where you can still be profitable, potentially profitable on this trade, Kevin. But if you look at it, you still, it's a 3-week wide, put calendar here, so you do have that potential to roll or adjust that short option as you get closer to expiration.
So far out of the money again.
Couple days too.
This trade really allows you to kind of geek out on the Greeks here. It's only got like a 2.5 short delta, but it's got 11.5 vega because Joe moved that long date outward, out to August 15th. So this one has a lot of Vega exposure. If you get that move down, Vega will probably at least hold or go up. So you do have a chance for some directional play and implied volatility. If it were to rise, you get that Vega kick as well. That's one of the great utilities of the put calendar, is you get that double profit from direction and implied volatility. This one certainly has it.
Yeah, Joe, and the idea is if this thing goes down towards 205, it starts expanding in price. It gives you some different scenarios where
35 cents.
Short option to the next week, to the week after, maybe close the trade if the market's open, right? So it gives you a little bit of flexibility as far as trade management goes. The only thing you don't want the stock to go higher or fall maybe 2 or 3 standard deviations, right?
Yeah, I think if the stock goes higher, then that long Vega is going to work against you, right? Either way, the implied volatility, since you are long, the Vega is going to work against you. It's just a matter of whether or not you can move to that 205 strike prior to expiration beforehand, right? So I think sometimes when we look at the risk analyze tab, you got to be able to take into consideration, yes, that front month volatility is really high, that's going to come in, but that back month volatility is going to come in a little bit too, right? So you need to be mindful of that. I think a big move, 2 or 3 standard deviations would not do well for this either. Then you always have to worry about assignment risk if that were the case.
Yep. All right. Great stuff. Great look at the put calendar there for Texas Instrument. Expecting maybe one of those scenarios where the stock goes down, even though it's a good report, because the bar is high on that one. Great example. Thanks to Joe Mazzola, head trading and derivative strategist at Charles Schwab. But coming up after the break, we're going to be joined from by Landon Swan from Likefolio for a look at sentiment data in Hilton. Hotel stocks near all-time highs into their earnings tomorrow morning. Stick around.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Oh, man. We just gotta face it that
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management.
on both Schwab and CNBC, they're just freaked out. Rotation, I heard again today. I heard careful about buying in the all-time highs. It's been like that for about a week and a half to 2 weeks now. I'm very bullish in this market, but they're not. And these things ain't moving. And I don't like it when that doesn't happen. I mean, move up $3 and it ain't moved. There they go, 40. I got to get 52 cents. I should be able to get it if we get back up to the orb. But we got walls to break. And then I'm going to put on my swimsuit and go lay by the pool for an hour. Be right back. Finish off this. Clean up my mess.
Oak.
We could. I mean, I just don't like the way they're talking. Well, here we go again. The prison guy is now on.
+100 and you're within 20 and 0, you're neutral. We've got a +21. So I mean that's as close as you can cut it while still having that very bullish, very slight bullish lean on there. But again, a lot of it I like it because of the pullback. Even though we're basically at all-time highs, we're a few percentage points off of that. And again, it's investing in or betting on the winner among losers, who maybe long-term can trade that off and become the winner among winners, and then it's even better.
Contrarian, Landon. You're talking 2x floor traders. That was our mantra. Contrarian. All right, great stuff as always, Landon. Appreciate it.
Thanks, guys.
All right, that's Landon Swan, co-founder of Likefolio, breaking down Hilton. Pretty positive on it, even though stocks rallied. Kev, how do you want to look at this one from an example trade?
So I look at the V, Tom. I look at the last 3 months up about 32.8%. It's already backed off the recent highs, Tom. So I looked at it, and I don't know. We're at the beginning of earnings season, Tom, but I'm going to really do some data on this strategy that I'm looking at here, which is it's a bearish trade. It's a short call spread. I'm selling this week's July 25th. 280, 285 call vertical. So, $9 above the market, Tom, as you can see, and, right in line with the expected move. So selling 280, 85 call vertical, using that to finance the 262.5 1 week put calendar. So a complex trade, that whole package, Tom, is trading about, I put it in for a 5-cent debit, now trading about a 15-cent credit. So now this is trading for a credit, Tom. This is I'm bearish because of how far it's run. But if nothing happens and it sits here, I'm still profitable, Tom. It's the short call vertical. You could just do that one to finance the long put calendar, Tom. So let's see if this theme of stocks that have run a long way, maybe putting out good earnings, but the stock not rallying. Let's see how that works on this one.
Yeah, you can be wrong and the stock goes higher and still be profitable on this example, four-legged example trade that Kevin brought us. In the July 25th weekly cycle that expires in just 3 days, sell the 280 call and buy the 285 call. So short $5 wide call vertical, helping to finance the purchase of the August 1st weekly options that expire in 10 days, the 262.5 put, sell that same 262.5 put in the July 25th weekly cycle that expires in 3 days. So 1 week wide put calendar to the downside. You're paying roughly, we've got a 5-cent debit on here. As Kevin mentioned, it's now a slight credit. If you pay a 5-cent debit, you've got $505 in risk, but that's all the way above 285, which would be a new all-time high. Now, if your break even, it's going to be around that $280 level, right? If you collect a credit, it's going to be a little bit higher. 280.15 is going to be your break even. If you pay that 5-cent debit, it's going to be just below the 280 level. So you can see here from the risk profile, you just don't want it to go more than one standard deviation above the current share price in there, that $9 cushion that the option market's pricing in. The apex of profitability, you can see here, is at or near that, where that put calendar is, around the 262.5 strike put. And then if you do collect a credit, or you do it for even, you've got no risk to the downside. You pay a nickel debit. If it goes below maybe 250, you're going to still have $5 in risk to the downside. So whatever price you put it on, you got to keep that in mind. If you take a credit in on this one, you've got no downside risk on that. So keep that in mind. But a good look at a complex four-legged spread. If you think this
kind of want to get it in the water.
But it can still go higher and it can still be profitable. Just don't want it to go above $280. All right, let's take another quick break. When we come back, we're going to take a look at ServiceNow.
There ain't no fat chicks by the pool.
Workflow software maker stock down about 20% from those all-time highs into their earnings tomorrow after the close.
gonna have to wait a little bit longer on these from now on. Take them about 2 or 3 times and just step back. We've got IBM earnings this week. Double bottom coming up. Triple bottom. I can't get down to my 277.57.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more, all crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Fast Market here on the Schwab Network. Let's take a look at ServiceNow. The stock's off 20% from its all-time highs, bear market territory. Let's bring in George Tillis, senior markets correspondent, to help us break this one down. George, I thought, all these investors were moving into the software side of AI moving forward, but we're seeing some laggardness here in ServiceNow going into this report tomorrow after the close.
Yeah, well, I think,
George.
considering ServiceNow, which is extremely large company, it's a $200 billion company now. I think interesting play, of course, in the IT services, procurement management. This is a company that's also moving into workforce automation, industrial automation. And so I guess my point is that they've been spending quite a bit of money. I think that's been essentially a drag on this company's performance. I mean, if you look at the last year, the stock is higher by about 28%. The year to date, it's significantly underperformed. Even the S&P 500 down about 9%. And since its reported last earnings about 3 months ago, it moved to the upside. It kind of stalled out. I think part of that has to do with the fact that procurement software solutions that are being sold to the U.S. government might have stalled out as well. I also noticed that Workday, which is a mainstay competitor of ServiceNow, is also not trading very well. So there may be an element to what these companies need to do to enhance their AI offerings, increase their productivity solutions through acquisitions, and of course the expenses through organic growth. And I think that's essentially why maybe the stock has been sort of listing or drifting effectively sideways since its last earnings report. Now, when they're going to be reporting earnings tomorrow, their estimated EPS is expected to be quite robust, still around 14% higher to $3.57 versus $3.13 billion. The kicker is you'll notice that 14% increase in the earnings estimates is being offset by higher revenues at 18.6%. It comes in around $3.12 billion versus last quarter, for the same quarter last year, $2.63 billion. So the revenue is estimated to be about 19% or close to that, but earnings only about 14%. So I suggest maybe this is a quarter that is going to illustrate higher spend, capital expenditures, and this is also a business which, if you look at growth rate wise, last year's sales grew around 21% sequentially for the last 4 quarters. Estimates are still 20%, quite robust, but they're down from their 5-year average 26%. But nonetheless, earnings estimates going forward are expected to decelerate to 23%. Versus 36% last year, but those numbers are still higher than the 27% 5-year average. So effectively, this is a company that's becoming more profitable over time. One of the things I noticed is that their net income margins in the last year have actually improved by about 300 basis points, but gross margins are relatively stable, only higher by about 60 basis points compared to their 5-year average. But that efficiency may have been offset by higher expenses in the last couple of quarters, and maybe that's why the stock is essentially drifting effectively to the downside on a year-to-date basis. But since their last earnings report, it got higher and sort of stationary in a trading range.
Go! We got an expansion pattern.
You mentioned a concerning word when talking about ServiceNow, and that is deceleration. I mean, a stock that's growing like this, and they're in, AI development. I mean, they've got a hybrid pricing model that should help with them to monetize the services that they provide. But George, if you and I have reported on this enough times with Tom, if their growth starts to decelerate, they're going to take valuation out of this name, and it still trades about 130 PE. So if their growth starts to trim or starts to decelerate, are they just going to take valuation out of this whole sector?
Yeah, I mean, that's the kicker when it comes to this name. I mean, on a trailing basis, it's expensive. If you look at the forward earnings going into 2026, it's close to $20 a share, which roughly places that earnings multiple around 50 times.
We got a megaphone. Oh, baby, won't you walk me home? Let's break the 200 EMA. I'll meet you in back of the barn, and we'll knit a little yarn. Let's break this 200 EMA. I want to get lucky. I want to get lucky. I want to get lucky today. Well, the 200 EMA, let's break it today. I've been waiting for the 1, 2, 3. Let's break this 200 EMA. I'll take my baby out today. I've been the 6320. I'm looking at the 1 minute time frame. Let's break this 200 EMA. My baby's waiting for me today. You know I'm but my love for you is a stay. Let's break this 200 EMA. I've been sitting here all day. Damn it. Megaphone. Was that Elvis? Was Elvis on voice with you today, Jimmy? USA. Should have bought that dip. That'd have really paid off there. Still feeling good about this. We'll see.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall.
Diane, we want to break 52 cents. Thing, every little thing. In sweet swims, melodies are pure and true. I've got this message to you, baby, don't worry about a thing, 'cause every little thing's gonna be alright. Baby, don't worry about a thing. So every little thing gonna be alright. By my doorstep, true and true. This is my message to you. Baby, don't worry about a thing. alright. Gonna be alright. Soup is good food. We broke the 200 now. It's trying.
Just in
Oh God,
the talking
she's
that
up.
we do and the notes that we're reading is that any kind of miss in any way or anything that isn't in line or a beat is being received much more poorly than a win. You know, than a win is being received positively. So
You
we're
think
not
so,
seeing a
honey?
whole lot of upside, but we are seeing quite a bit of downside reaction if the street isn't happy in any way, shape, or form.
It's somewhat the opposite of what we've said characterized like economic data for the last year. Like bad news is good news. Right now it feels like earnings, like okay news is bad news, decent news is still bad news, but you have to really, really exceed expectations, give stellar guidance, have like the strongest commentary on the earnings call, and then hey, maybe it's good news. So we'll obviously be parsing
Get her off the
earnings as they
station.
come out this week, and we will
Jenny.
be looking at some of our movers in retail
Fire her
consumer
ass.
focused stocks to kick off the show here. We will also be charting some names that are definitely earnings focused, XPI as we mentioned, as well as Texas Instruments. Still yet to report. That name reports tomorrow. And then we'll look at Oracle here, which actually it is still substantially lower in the session, but the amazing run that we've seen in Oracle is definitely worth noting, especially now with an OpenAI partnership continuing to build and seeing their AI presence just further strengthened. And we'll dive into the latest with TikTok and some of the political headlines that have really weighed on that narrative, and we'll close things out with the cruise line. So a wide variety of stocks to cover here throughout the next hour, of course, and as always, with some of these movers, not endorsements or recommendations, but all in the consumer world. I always try to find a theme. Today was very challenging, I will say. It's outside of like chips, obviously. So we're starting things off here with Kohl's, which is not a name we discuss very often, but definitely an important one today because Kohl's is on the move here. We are up now 34% in Kohl's, almost 35% actually, I'd say, rounding. So, I mean, Kohl's is one of those names that gets forgotten until it doesn't. And today's, I mean, obviously a great day to talk Kohl's.
You know, I know you love a meme stock, so I'm glad that we're starting with this one because all argument would point to Kohl's today being a meme stock. They got a couple mentions on Reddit. There are no major apparent corporate announcements or any major stock ratings or any reasoning behind this move other than social media mentions. So all the markings of a meme stock. They did have to halt trading earlier. Like you said, they're up 34% now, a little over 34%. Shares of the retailer jumped as much as 105%. So their largest one-day jump on record. And they did have to halt for volatility earlier this morning. They have since resumed trading now just over that $14 mark. But really interesting because this doesn't happen that much, you know. And if you're looking at it now, short interest, pretty heavy, about 48% of what's happening with Kohl's right now. And to go with the OG Hallmark meme stock, GameStop, I pulled them up just for.
It's hard to listen to her. I hate seeing it bounce like that. Sucker not moving. General Motors takes a 1.1 billion tariff hit. Digging in profit and sends the stock a reeling. Lockheed Martin stock rocketed on too big profit miss. While rival Northrop rallies to record highs. Home buying incentives to increase in coming months, says DR Horton says. Women are earning and inheriting more than ever. They're so stupid, they need better advice. I'm just reading today's headlines. I think they crossed the line. I might get back into music. Get back to the band. See how much more I can stand. Now QQQ had a nice little recovery on the pullback. SPX had a double bottom off the wick, higher low, breakout boom. Same thing with the SPY. Attempted to add another 20 contracts to my SPX, and that'll give me 50 or maybe 30 more, and that'll give me 60. That'd really bring the price down. Oh, might have had 30 more, 35. Well, I think I'm going to go take a break and go shampoo this one carpet. Might be back in about an hour. Randy, Funky, hold the market down. I think I'm going to go get this shampoo done. I might be back in an hour. We got a Head and Shoulders at 63.43.63. And I got a new resistance. We broke resistance. We broke resistance. I think we're going to get back to 52 at least. Put on my shoes and go do it. KISS is up nicely. KSS. Kohl's Corporation. Kohl's shares soar as it is reportedly the latest meme stock. Yep, they're definitely God, did I just see 45 cents? Nope, 40. I'll be watching my SPX too. I'm just waiting for it to do something. These stall out periods are just too much. This is what I wanted to avoid yesterday. So I'm going to go take a small break. Maybe this thing will pop before I leave. Get to the top of the megaphone at 63.44.11. We're back at 50 cents. $0.60, baby. $65, baby. I've got a ton of these. We just had a big fat candle. Jim, I got a song request. What would that might be? Oh, you want to hear that one, huh?
What's up, everyone? It's Avery Johnson, QB1, and the number one thing for me on my recovery days is my sunscreen from CVS.
You know, I don't know who you are.
I'll see you soon. So what sunscreen are you picking up at CVS?
You think you're some kind of surfer? Oh, my Lord, kumbaya, kumbaya. Kumbaya, my Lord, kumbaya. Oh Lord, kumbaya. Kumbaya, kumbaya, my Lord, kumbaya. Oh Lord, kumbaya. Someone's winning, my Lord. I'm getting rich on 60 contracts. We're at 80 cents. Take some profit. Profit, 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 profit. When you're up 100%, you want to take a profit. They could go higher. This could be a biggie. Sheba, what are you going to do when they come for you? Kumbaya, my Lord. Kumbaya.
On this world you made for the love that will never fade, for a heart beating with joy, for all
Come on, baby, brick. $0.90. I was going to do carpets. I still will, but I got to get out of this beast. I'm up 100%. $110. Now I gotta take it. I can't sit here and watch us do this all day now. We're at the top of the megaphone. Top of the megaphone. Called it. Took a while. See what happens when I sing? Does anybody understand what my voice can do for things? It can change the world. I mean, my music can make a difference. So I want you all to do one thing.
I'm at the top of my game.
I'm at the top of my game.
Peptides for healthy hair, skin,
110.
nails, and joints. With the Amex Gold Card, every meal is a reward, earning you 4 times.
Beautiful. Sitting in the morning sun, I'll be sitting when the evening comes, watching watching the ships roll in. Then I watch them roll away again. Sitting on the dock of the bay, watching the tide roll away. Thank you. Sitting on the dock of the bay, wasting time. Hey, next time I left my home in Georgia, headed for that Frisco Bay. I had nothing to live for, looked like nothing gonna come my way. Oh, I'm just sitting
On top of the bay,
watching the
tide go away. Can we get to the top of the yard?
I live my home in Georgia, headed for the Frisco Bay. I have nothing to live for. Thank you. Nothing's gonna come my way.
Sitting on top of the bay. 135,
sitting on the
top of the bay.
wasting time. Yeah, thank you. Look like nothing's gonna change.
225, 245. We had resistance.
So I guess I'll remain the same.
Yes. You owe me a big old smooch, baby. Come here, Sheba. Give me a kiss. Come on, baby. When things are looking bad, no reason to be sad. I'm up a lot of money. You're out of resistance. Do 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 do.
Thank you. My name is Roger Ridley. I got all this music that I'm doing on CD over here. The CD's like $15. Got 21 songs on it.
21 songs on it, yay. Oh yeah.
Switch to Google Fi Wireless and get unlimited essentials, our most affordable unlimited phone plan for just $60 per month for 2 lines. Enjoy unlimited calls, texts, and data in the US, all delivered with ultra-reliable 5G coverage. Switch to Google Fi Wireless today.
Positive attitude, S. I was violated once by my 3rd grade teacher. She took me into the closet and stripped me naked. So S had enough gut. S has been sitting with me on some of these bad trades, and I want to give him a shout out. If you're ever stuck in a trade, feel free to private message me, and I'll ease your pain with a song. You know what I'm talking about? I'm the only singing day trader out there right now, and I want to keep it that way. I used to do videos about me, the singing day trader. I might pull up an old video, see if they still got them.
Never found a four-leaf clover making his love to me. No rabbit shoot, no lucky star, no magic wishing tree, but I got lucky. Yes, I got lucky when I traded you. Ooh. Got no rainbow around my shoulder, no horseshoe on my door. I got you to hold me tight, and who could ask for more? Well, I got lucky, yes, I got lucky when I traded you. I always walk around with all my fingers crossed. I'm afraid of my found just might get lost. So won't you tell me that you love me? Hurry up and make my day. And I'll know that I am luck is really here to stay. Well, I got lucky. Yes, I got lucky when I treated you. I always walk around with all my fingers crossed. I'm afraid of my found just might get lost. So won't you tell me that you love me? Hurry up and make my day. And then my good luck is really here to stay. I got lucky, I got lucky when I traded you. Oh, I got lucky, I got lucky when I traded you.
Okay, enough of that. Are you done with the concert, or do you want more? That guy out there must be having an affair. Funk is still on here listening to me. That's hard to believe. Unless he muted me. I think I'll go now, do my thing, and Promised them guys I'd be up there to do this. Well, let me see if I do have a video of me back in the old day singing Day Trader. Singing Day Trader. What the hell's Joe got to do with this? How dare you? Is that Kurt Runstrom? No, looks like him. I don't know if anybody ever got to watch one of my own. No, I don't see any. I'm going to get on out of here. If I keep singing, the market will still keep going up. Aringa says I'm getting better. So she thought I was a whole lot worse. We wrote a song about a whole lot worse. That day's a whole lot worse. See you later, YouTube. Robert, did you get out? I love you, Sue. How do you do?
it's now time to talk TikTok and the latest drama that seemingly always is following the social media app as it does face a lot of these security and just overall political scrutiny. So joining us now to talk more about the latest is Eric Cole, the CEO of Secure Anchor. So Eric, thank you so much for joining us today. I am so excited to discuss this with you because I can just tell from your notes we're in full agreement here. I have no idea this became politicized because it had almost like bipartisan agreement from both administrations. The handoff was so strange the way that all, of course, happened. So walk us through your thoughts because it has been a long-standing drama of the social media world.
Yeah, so TikTok has turned into a political pawn. It's no longer about an investment or a business. It's all political. And all these companies and investment firms like Blackstone are realizing that whoever acquires it, they're going to continue to be subject to political scrutiny, and it's going to impact the business. And then what people aren't talking about that these companies are realizing is who is controlling all of this data. Even if you go in and you get a majority share in TikTok, all of the servers, all of the infrastructure is still in China, and that infrastructure costs around $100 million. So if you buy TikTok, that means over the next year, you're gonna have to invest hundreds of millions of dollars in building out data centers in the United States to house all the data. And then the bigger question is, China still owns all that data from the last 14, 15 years.
Okay, this is to me the biggest maybe question mark of the entire thing because who wants to then buy this? I guess maybe for the sake of it remaining in the US, but to your point, I think it's a political play, and also the algorithm is what makes it so valuable to its users. So without full control of that, which I believe TikTok has said numerous times they're never going to erase that part of this entity. I mean, how do we see so much interest in the potential sale? Because to me, it's not really going to be accretive to whoever buys it.
Exactly, and I think what happened is we're starting to go down the wrong path. This really needs to be an existing social media platform or e-commerce platform that has interest. This is not a private equity play. So these private equity companies got involved and said, okay, let's all team together. But when they're opening up and really digging into the details, like you said, what are you really buying? You're not really getting the algorithm, you're not getting information, you're not getting data. I still think that this, if anyone is going to purchase it, the best purchase is Amazon. And the reason is Amazon cares about profiles of users. Think if Amazon got all the TikTok data and they could see what people are talking about. They could see what the interests are. So now if somebody is posting a video on TikTok, let's say about health and soda and beverages and things like that, they can then do target marketing to them to try to increase sales. So I think this is going to switch from private equity. I think all private equity is going to pull out, and this has to be something the government has to incentivize companies like Amazon. But my prediction is this is not going to be solved by the September deadline. This ball is going to keep getting kicked down the court because the president is now in a dilemma. He can't ban TikTok because he criticized the previous president, but no one's going to want to buy it. So he's just going to have to keep pushing this down. And I think this is going to go into 2026.
I mean, I think so too, just based on also the quiet nature around the entire issue. It's like usually when he's trying to make moves, he's pretty vocal, frankly. So I completely agree this is going to be probably something we're still discussing well into 2026, but I am curious the way that TikTok operates from your perspective versus like other social media apps here in the United States. Of course, data privacy is a concern. I mean, servers and the mass amount of data is also now being, I think, more scrutinized than ever as we just see these companies have so much access to us as users. So is TikTok unique in any way that it operates, or would we see it eventually turn into more of like a Meta or YouTube?
And that's the crazy part is we are so focused on TikTok because it's owned by a Chinese company. But the real issue is, where is the data stored? The data is in China. And here's the crazy part. If you look at Facebook, Instagram, Meta, although Twitter, X, all those different platforms, most of their servers are not in the US. Most of their servers are in countries that actually have friendly agreements with China. So the reality is China not only has access to TikTok, they do have access to all the other social media platforms, but we're ignoring that because the real issue that we should be focusing on is not TikTok, it should be on data sovereignty. Data sovereignty is where users get to choose where their data is located, whether their data is located in the US or outside. And to me, the better way to handle this is for either the president to pass an executive order or Congress to go in and pass data sovereignty laws that says all social media platforms have to give the users options of where their data is stored. If we had that executive order or law in place that said every social media platform within a year has to give users an option of whether their data is stored in the US or not, now we're shifting it from focusing on TikTok to saying TikTok has to figure out how to get their user data in the US just like every other social media platform.
Okay, so walk me through how that would change the social media experience for us all, because this data sovereignty I think is so fascinating. And I will say I'm probably one that's too free with my data, because it feels like, you can't control one platform, not the other. You're just sort of like, hey, at this point I have like Amazon Alexa, I'm sure she has all of my data. So for that reason, I kind of just say, everything has your data. But would this change our social media experiences?
So the good news is, it wouldn't change our social media experience. We would still operate the same way, but on the back end, you're more protected. On the back end, you're more secure, so your data is only accessible within the US. But then this brings up the bigger issue. Do we really trust Meta more than we trust the Chinese? I mean, Meta is using our data for targeting, personal purposes, and everything else. So the reality is, whether our data is in the US or China, it's really a privacy issue. Do we really want all of that data and information out there? And like you said, people don't even realize it, but try this on your iPhone. Just go in and start talking about a topic. But let's just talk about a random topic like books. So you're interested in books, want to read books. If you then go into your phone and you open up Google and you type the word W, it will auto-fill in what are the top books. If you go in and put in areas, what is the price of books, it is listening to everything we're doing. So this is really a bigger privacy issue, that it's not just China, but our data is being accessed by these social media platforms and potentially used against us.
I mean, it's wild. It's ridiculous to me the way I'll even have conversations away from my phone, and it's still on like another device connected to my phone. It will pick up these things I'm talking about. Like every stock I talk about ever somehow ends up on my Instagram, which is always a pain. But I am, last but not least, just curious about AI and your thoughts about some of the data and the continuous server build and all that. Only, I think, further challenges the entire narrative you're making, because AI is only going to complicate things as it only develops and further strengthens this mass amount of data.
Yeah, and that's sort of the really, really interesting part of this is, to me, AI, if used correctly, is a net positive, because before AI, all of our data was being captured and used against us. It was being used for marketing and things that could be adverse. Now with AI, it's actually being trained on who you are, what you like, and now it can be used as a tool to benefit you. So to me, when I hear a lot of these executives saying AI is going to replace your job or 30% of the workforce is going to become obsolete, to me that's the wrong, naive way of looking at it. The way you should be saying it is AI as a tool is going to make your job more valuable. It's going to make you more beneficial, because now it's going to let you search and find things a lot quicker. So we have to look at AI as a tool to augment humans and not as a way to replace humans.
I completely agree. I think that it's actually, I mean, like having a curated search throughout everything you really go on the internet. I've never been complaining about that. I'm like, better that than, have something that I'm not interested in, right? I don't necessarily see it as a malpractice. I'm like, there could be very wonderful things that come of AI, and hopefully some of this more data sovereignty and consumer independence, which I love the way you phrase that. So we appreciate it. We're out of time, but a great conversation. So appreciate it. Eric Cole, CEO of Secure Anchor, for all that wonderful insight on everything TikTok, and hopefully what we're talking about by 2026, as he said. But coming up next, it's time for Under 30. We are switching gears and focused on the cruise lines, as we are seeing TD Cowen with some favorable analyst calls today on the entire space as a whole.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's now time to set for the seas here and talk these cruise lines, which are getting an appreciation note from TD Cowen today, all with buy ratings on all of our three major U.S. traded, of course, cruise lines. So joining us now is George Tillis to talk more about this note in the space as a whole, which this analyst called underappreciated share gainers in the travel space. I mean, I do have to agree with that, but also, like, I think the entire travel space right now has been volatile because we still have like so many unknowns regarding what future policy looks like. So walk us through your thoughts here with cruise lines, George.
Yeah, that's a good question, Jen. I think, we'll talk about policy in a second, but I think what's happening here is you have to consider, I guess, in the larger context that the cruise lines like Royal Caribbean, Norwegian, Carnival are basically taking the same play out of the airline playbook. And what that is over time, particularly since the end of COVID, these industries as a group, this whole group has actually cut back on capacity and has increased their bookings rate as well as increased their operating leverage. And so prices were basically moving quite a bit higher than the available supply of units that are on these cruise ships. So their profitability has expanded quite significantly. All of them are a little bit different in the sense their financials are all different, and it also speaks to the financial performance difference between all of them. But if you look at TD Cowen basically provided initiation of coverage with a blanket sort of buy rating on all these names. Cruise line on Carnival $36, they got $31 on Norwegian, and then of course on Royal Caribbean $405. And when the Z analysts do this, it's really because they actually see industry group pricing power. We're essentially seeing the development of an oligopoly here in these cruise liners, which means that they're keeping prices really firm, reducing available supply or increasing the available supply at a slower pace than prices are firming up. And overall, businesses like Royal Caribbean, for instance, if you look at the last 3 years, it's pretty remarkable that it's up almost 900%. And that speaks to the better capital structure of that business compared to its competitors, Norwegian and Carnival, which actually have higher debt loads to equity than Royal Caribbean. And so overall, if you look at the group, irrespective of debt and capital structure, they're all higher in the last year, between 100% and about 62% for Carnival. And I think that speaks to the fact that the profit margins have been improving for the entire industry group, but the profitability of each business is still different. And I think that's reflective of individual performance relative to their competitors as a whole.
Okay, and I think such a good point. I oftentimes compare these to like American Airlines because the debt load is to me not different, but similar in the sense that it continues to be this burden for a lot of these names where they can't get out of their own way. And I mean, I know right now we're in like wave season. We've seen strong consumer trends, I mean, at least for this summer so far, especially from the airlines. Does this trickle into the cruise lines? Because it is interesting to me the way the two don't ever really trade at all in tandem, even though what feels like is positive sentiment for airlines should be also positive sentiment for the cruise lines.
Well, yeah, I think the sentiment around consumer spending, at least for services and travel, appears to be really strong. And I think that the pricing power on top of that demand that these cruise liners are procuring speaks to better operating metrics. Now, when it comes down to things like debt levels, and this, again, anybody can do this, the financials on their own, but if you look at Norwegian, its performance relative to the others was worse because it's got a debt load that's higher than its equity. It's got about $14 billion in debt on $10 billion in equity. The best of the group is Royal Caribbean when it comes down to capital structure. They basically have about $94 billion in equity and only $20 billion in debt. So, but I think the profitability profile of each business is a little bit different. And that's why Royal Caribbean is actually doing very well because more of the money that they're earning goes to shareholders versus debt holders. So that makes a big difference, but right now the rising tide is lifting all these boats, no pun intended, because the industry group has pricing power. And if that's the case, and bookings are still growing, and of course capacity utilization is high, profitability as a whole will increase for the entire industry.
Vacancy rates are insane. I mean, they're like well over 100% for the last quarter for like all of these names. And I mean, that's like a hotel's dream. So I will say kudos to them on what has been the most massive turnaround in all of travel post-COVID. Appreciate it though, George. As we are out of time, that'll do it for Next Gen Investing for this Tuesday. We have the watch list coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network. Welcome to the watch list. I'm Nicole Petalides. We're live on the floor in the New York Stock Exchange. It's 2 p.m. Eastern time. I'm so glad you are with us. I was just checking to see if we hit any records throughout this back and forth day. And while we've had some up arrows, we didn't cross some of the gains that we saw yesterday, the highest point, because we did in fact close at records for the NASDAQ and also for the S&P 500. So any gains would be closing highs, but today so far no intraday highs. Here's what's coming up on today's show. We'll break down KPMG's mid-year M&A survey to analyze the latest trends in the space as deals makers are really eyeing the second half of the year to heat up for M&A activity. Technical Tuesday, that's right, Charles Schwab's very own Kevin Horner will join us and take a look at the charts of the S&P 500, Guidewire and Oklo. Also our panel standing by and looking at some of those defense stocks, some of the major players in this group, and some of them are doing quite well today, so we'll go over that as well. In the meantime, taking a quick look here at the market. So you're seeing some back and forth action throughout this day, and even right here, right? The S&P now is down fractionally at 63.05. The NASDAQ 100 is down 111 points. That's a 0.5%. Dow Jones Industrial Average is up 0.25%, and the Russell here is gaining 0.75%. Tech and communication services are lower. Healthcare, real estate, utilities, materials are the winners. Kevin Hanks, host of Fast Market, is joining me now, and he's live at the CBOE. And good afternoon to you. Oil and gold are mixed. The 10-year bond is at 4.33. Kevin, so we have some good action here today. Some of your thoughts?
Yeah, I think this is all a very dry powder day leading up to a big day that we're expecting tomorrow with Tesla and Google Alphabet. I think that's really the news event of the week, Nicole. Obviously, durable goods on Friday will be the biggest data point, but earnings, as we start inching towards large cap tech, they're really going to drive it. Why? Because they've driven stocks. And I think one of the big stories here is just this. The high-flying stocks that have run so much in the last 3 months, they're struggling. Despite good earnings, the stocks aren't going up. The stocks aren't following through. And some of the beat-up names, the stocks that have struggled over the last 3 months, those are the stocks that are recovering here and showing real signs of a bounce. So a really interesting market where it's the good, it's the strength of the underdogs and it's the weakness of the high flyers. It's really quite interesting.
All right, so yes, without a doubt. I mean, everybody can't wait to hear from Alphabet, from Tesla. Most of the folks that have been coming on, many of them still like the Mag 6 very much, and they put Tesla on the side a lot of times. We'll have to wait and see what happens. In the meantime, General Motors came out with numbers. Some of your thoughts there, as we heard from GM. I mean, there was a beat, some good numbers in there.
GM down 6% despite an earnings beat. $2.53 a share versus $2.45 expected on revenue of $47.12 billion. That's a beat over $45.16. Their guidance right in line with where it was, between $8.25 to $10. The estimates on the street were $9.30, so pretty much right in the middle there. Gross tariff impact. Here's one negative. They think it's between $4 and $5 billion of impact from tariffs. Now, the adjusted margins, overall 6.4% versus 9.3% in 2024. North America, 6.1% versus 10.9%. So margins coming down, a little hurt from tariffs, and the stock down about 6%, Nicole, despite an earnings per share beat.
All right, next up, I'm taking a look at the home builders. I mean, they were winners here, leading the S&P 500. Names like D.R. Horton, Pulte. Some of your thoughts there?
Remember, the beat-up housing sector and the home builders, those are the ones bouncing with big percentages today. We got D.R. Horton up 15%. Their earnings per share, $3.36 versus $2.92. Revenue, $9.22 billion versus $8.78. So big beat on earnings per share, big beat on revenue. Third quarter earnings, remember this is their fiscal third quarter. Homes closed 23,160, that's down 4%. Home building revenue, $8.6 billion, that's down 7%. So maybe those numbers, remember, homes closed down 4%, revenue down 7%, better than expected. And that's why the housing sector showing signs of life. And when everything is bad news for the housing sector, as it has been, all the data, it takes very little to make these stocks rally. And you're seeing that today in D.R. Horton. Now Pulte, similar story. $3.03 a share versus $2.95. Revenues $4.4 billion versus $4.41. In line in the revenues. Their home sale gross margin 27%. Backlog $6.84 billion backlog. And net new orders, 3.9 billion. That stock up a solid 10%. Remember, Pulte sells more, the higher price homes, over $1 million, at or over $1 million. So really good recoveries out of the home builders. It looks like housing going into the second half of the year has a heartbeat, Nicole.
Yeah, nice numbers here today, really wowing Wall Street, right? Okay, Kevin Hinks, good to see you. Thank you. Wanted to take a look at the ETF space. As you've seen inflows, people have been more and more mesmerized and they want to be part of the ETF trade and active ETFs in particular. David Mann, head of ETF product capital markets for Franklin Templeton, is with us now. Thank you, David, for being here. Is that right? I mean, more and more people want to know more about ETFs and they love actively traded ETFs. You tell us, what are some of the trends?
Sure, and thanks for having me, Nicole. Right, so, you know, I've been at Franklin Templeton almost 10 years. As I go back and think about working with regulators about the ETF rule back in 2019, we kind of stared at that thing and saying, you know, this really should be a real boom for active ETFs, and it's been very exciting to see that play out over the last couple of years. And so the numbers are actually quite staggering. Almost 40% of the net inflows have gone into active ETF strategies. On current pace, we'll be close to $500 billion of net inflows. And somewhat surprisingly to folks, there's now more active ETFs than index ETFs listed in the United States. Lots of reasons why. It could be some of these funds hitting 1, 3, or 5 year track records, or maybe just overall uncertainty that we see in the market where folks turn to an active manager. But you know, at Franklin, we're very excited to see this trend.
Yeah, you said there's no doubt that we've seen people turning to active ETFs and that they've accounted for nearly 40% of the net inflows. And that probably could grow.
That could grow. Yeah, it's really exciting, and we're seeing it really broadly. And we're seeing it fixed income, we're seeing it in U.S. equities, we're seeing it in international equities. So just more and more investors who have gravitated towards ETFs. ETF industry brought in $1 trillion last year. It's on pace to do $1 trillion this year. So we're just seeing more investors getting comfortable saying, oh, I like ETFs, now I can get active exposure with
Let's
ETFs.
talk about some that you have here. You have the Franklin Income Focus, the Putnam Focus Large Cap, and the Franklin Dynamic Municipal Bond ETF. Tell me about these three.
Sure. So, you know, one of the things that we've tried from a product development perspective is, can we bring some of the best capabilities of Franklin Templeton into the ETF form? So starting with that Franklin Income Focus, that's ticker INCM. That is a 75-plus year legacy of the Franklin Income investors. They've been running, you know, providing income for investors for a really long time. So our goal was, hey, we're seeing the growing trend in ETFs. Let's bring that into the ETF space where investors can, you know, really have a desire for income. The Putnam Focus Value, PVAL, is the ticker for that one. Once again, that's a flagship strategy from the Putnam Equity team, and bringing it into the ETF form. Wonderful track record over the last 1, 3, and 5 years, and that's been our best asset gather this year, and close to almost $4 billion.
Yeah, and before we get to the next one, that one's value. So while everybody's chasing the Mag 7, this is totally different.
Totally different, and that's, you know, one of the things that we're talking with investors about is, hey, let's have a thoughtful asset allocation, a lot of focus on growth, and so they're, you know, having exposure to value has been beneficial, and that's been a great tool to do so.
Right, and last but not least, some tax-exempt income.
Yeah, so just at Franklin, really, the Franklin Fixed Income team, very excited about municipal bonds. That ticker is FLMI. It's almost doubled in assets this year, and just more broadly, you know, the Franklin Templeton municipal bond capabilities, looking to convert additional funds later this year. That's going to be a huge focus for our firm.
When you say tax exempt, I mean, at some point when you take your money out, do you have to pay taxes?
And that's the beauty. Those are, you know, that's one of the beauty of municipal bonds is you don't have to pay those taxes.
That's good for folks. People love that. The generation before ours loved muni bonds. Maybe the younger folks don't know as much about it, but it was definitely a wave that we saw in the prior generations. Tell me about valuations outside the United States. Are you finding places to park some money and make some money?
Sure. Yeah. So a lot of focus on international equities, and you know, one of the things that's interesting, given all the, you know, macro noise and tariffs, et cetera, that there's been a big focus on targeted exposure to international equities. A lot of those international markets are at much lower valuations to the U.S., and for those ETFs, where the investor gets the benefit of both the performance of the underlying equities and the weakening dollar, which has happened this year, that can be very, very attractive.
And then you also have a couple of others. India, by the way, when we talk about international, you have India in there. That's important.
Great, right. So, back to the single country story, a lot of investors saying, okay, how do I decipher what's going on in the news and which of those target countries I want to? That ticker is FLIN. It's been our best single country asset gatherer this year to get Indian equities. A younger population, growing dynamics, somewhat insulated from a lot of the tariff news. So that's been a very exciting market.
Now, granted, these are strategies of their own. I mean, they probably work independently of some of the volatility in the market. Big picture, are you more bullish, bearish, or what?
Overall, staying invested we think is very important, and a lot of the conversations we're having is just being thoughtful about staying invested. So, back to your comment on the international equities, going just beyond U.S. equities and having a thoughtful portfolio that includes international equities, that includes fixed income, as you talked about. We think that is just the right way to get an asset allocation and staying invested.
Yeah, I mean, that's bullish enough. Because if you were bearish, you'd be saying take half off the table or go to cash or take profits. It's good to see you, David. Thank you for being here. David Mann, thank you for being here. Head of ETF Product Capital Markets at Franklin Templeton. Thank you, David. Coming up, Options Corner, and Tom White is standing by. He will highlight unusual options activity from the day, how investors are looking to trade on recent news. MGM Resorts, SLB, Rocket Companies. Stand by. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. Time for Options Corner, where we analyze unusual options trades that we're seeing made throughout the day. Welcome in Tom White, host of Fast Market here on Schwab Network, and you have a few bullish trades that you found for here for Options Corner today. We'll start looking at MGM Resorts. Tell us about this one. Good afternoon, Tom.
Hey, Nicole. Yeah, this one, it's been a tale of two cities for a lot of these gaming stocks, right? They're doing well in Macau now. They weren't doing well in Macau last year. Vegas was really good last year. Vegas not doing so hot anymore. So they just can't seem to right the ship here just because portions or segments of their business aren't doing well while the other does well. The stock was downgraded today out of Seaport Research. That the Macau was a surprise to the upside, but then moving forward, that's going to be a drag. Maybe it's not going to last. Las Vegas continues to deteriorate a little bit as visits are down there. The stock's still up about 7% so far this year. They report earnings next week, so we'll get some clarity on their objectives and where they see future trends moving. But right now, it just seems like every time Macau does well, Las Vegas is down and vice versa. So that's going to be something that they're going to have to figure out moving forward. But we did see some bullish activity, probably this trader trying to take advantage that the stock's going to move higher post earnings. This was out in the August 1st weekly cycle that expires in 10 days. You're going to capture that earnings event on the 31st. Trader bought 3,000 of the August 37.5 strike calls, paid an average debit of $1.20. So that takes a break even up to $38.70 over the next week and a half. That's only about 4% above the current share price in there. As I mentioned, you're going to capture that earnings. Call volume's more than double normal daily average volume that we've seen over the last week of trading. And there's only been about 6,600 calls traded on the day. So this one trade was nearly half of the volume on the day. So we typically don't see big position orders in here, but this is probably one of the bigger open interest positions that somebody's putting on ahead of earnings.
Understood. I mean, I'm seeing some analyst reports that are bullish. I mean, I saw Truist with a buy on MGM. They had its price target of $50. So that was some good news. But there was also some short interest and maybe some short covering happening too. Overweight from Barclays and $44. That's higher than where we are now. What about SLB? Let's turn our attention over to the world of energy. Bullish?
Yeah, having a little nice little rebound here today, up over 2%, but the shares are still down about 11% so far this year. They're off 30% from the 52-week highs also, so still in bear market territory. They did just recently, you see there from the chart, just bouncing off of those 3-year lows that we saw a few months ago. So it hasn't been a good run for SLB. They did have earnings last Friday. They missed on EPS just slightly. Revenue came in a little bit better than expected, so a mixed report. The CEO said that the company is navigating several dynamics, including fully supplied oil markets, OPEC plus supply releases and ongoing trade negotiations, and geopolitical conflicts causing that. Really high correlation to the price of oil, and we've seen the price of oil slip. We've got crude trading about $65 a barrel right now, so that's not a bonus. They did state that they're working on their new digitally enabled electric well completion technologies. That's supposed to be helping them move forward as far as what they're doing as far as digital and automated oil field services solutions, which is what they're part of. But as I mentioned last Friday when they reported earnings, didn't really help out the stock, still lagging. But somebody probably taking a shot here, but giving themselves plenty of duration. I saw some unusual option activity all the way out in the November monthly cycle. So you're giving yourself about 122 days till expiration on this one. Trader bought over 7,000 of the 37.5 strike calls in November. Paid an average debit just over $1.30 on those. So the break even of 38.81 over the next basically 4 months. That's about 13% above the current share price in there. Now, that break even 38.81, this stock for the first 3 months of the year was trading above in the low to mid 40s at that point. So it does have that ability to get up there, but you're going to need a pretty big move. I think that's why the trader gave themselves plenty of duration for this trade to work out to the upside.
All right, and I mean, I see that it's near 3-year lows. really disappointing for people in the world of energy. I mean, that was always supposed to be somewhat of a safe haven, a dividend payer, blah, 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 when everything else is taken off. But good to have a bullish trade there that you showed us. How about rocket companies?
Yeah, shares are spiking today, up about 5%, up over 50% so far this year, hitting 9-month highs in today's sessions. They report earnings next week also, but they did get a price target hike out of Jefferies. They raised it to $14 from $11.50. They kept their hold rating on the shares. Now, this has been an M&A story here for RKT over the last several months. They acquired Redfin recently, Mr. Cooper. So it seems like when the housing market and the mortgage market's not doing too well, Nicole, what do? Well, it's depressed asset classes right now in this space. So maybe this M&A activity will eventually pay off. I think that's what a lot of people are banking on. And maybe that's why you're seeing some bullish momentum in the stock so far in 2025, even though they're outlaying a bunch of stock and capital to make those acquisitions. If you look at the unusual option activity in here, I think a trader may be trying to take advantage of that earnings that's coming up next week on the 31st. This was out in the August monthly cycle, so about 24 days till expiration. Trader bought 7,000 of the 16 strike calls, just out of the money to the upside. Paid an average debit of $1.30 on these calls, so that break even of $17.30, where this trader starts to profit over the next 3.5 weeks. That's about 9% above the current share price. And there's a low price stock on a percentage basis. Those moves aren't that common, but at the same time, when you have event risk like earnings, maybe this trader's looking forward to something positive where they're going to say maybe these acquisitions that they're making are going to be accretive immediately, and maybe they're going to give some semblance that the mortgage and housing market's turning around.
Yeah, and look, as you said, some recent momentum, and 6 months up 45%, 3 months up over 35%, really has had some incredible moves. Tom White, thank you. Options Corner every single day here on the watch list on Schwab Network. So Tom brought us MGM, SLB, and Rocket companies. Coming up, we'll break down KPMG's mid-year M&A survey. The second half of the year, is that going to heat up in this space? It was supposed to, right? That's what people were saying. Well, let's see what they have to say now. Next on the watch list.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Trading the trending names every day. I'm Tom White, host of Fast Market. Ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
watch list. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange. M&A activity, that's been in focus for all this year. And now what? What are some of the trends? Dean Bell, Deal Advisory Strategy, Head of Markets at KPMG US, is here to speak about this. We knew that everybody was saying the Trump administration was going to be business friendly and less regulated, and all this M&A activity was supposed to happen. Is it happening, or is it in the works? What's going on?
Oh, it's in the works, Nicole. We did a survey back in May that talked about the fact that companies want to do a deal. Looking at a couple of things, yes, a very friendly M&A market, but 300 deal makers told us, half corporate, half private equity, 2025 was the year to do the deals. 3/4 saying they want to do it, mostly though in the Q3 and Q4 of 25.
So I also feel like, and you tell me, I mean, when we got the tariff, board with 45%, people were walloped. They didn't really, understand it. It seemed like a lot. They didn't necessarily know how to value anything. Now, does there appear to be more clarity?
More clarity in the sense that, yes, tariffs are going to be the norm, but the reality is you still got to do your strategy, which means acquiring other companies, thinking about what you want to do for your business. The question may be, though, you may look at other jurisdictions, other geographies, and thinking about ways to factor that into your overall deal thesis. So there's more certainty, but deals are going to get done because a lot of money on the sidelines to get deployed.
So these deal, makers are very enthusiastic, you said. Do we know how much money is ready to go? You said 3/4 of the folks want to do a deal.
Yeah, well, these are big companies, so look at corporates being at least $1 billion in revenue, and private equity being at least $500 million of fund value. And they're saying, yes, they're going to deploy. How much is there? There's been a lot. There's been billions on the sidelines to be used.
So you talked about the May survey. June, did we get the final numbers for June yet?
No, I don't have them right
Yeah,
but I'll
not
tell
yet,
you that
right.
talking to 3 clients in the last week, they're all very bullish. 2 private equity and 1 corporate saying we want to do deals ASAP.
What do you think is going to drive this? I mean, is it a particular sector? Is it rates? I mean, what makes the deal get done?
Listen, everyone wants certainty, so rates will be very helpful, lower rates. But I think what it comes down to is the idea that says we know what the inflation
Lower rates would be very, very helpful.
Which allows them to go ahead and focus on their overall strategy, which is go to where they want to be. Expand your marketplace, acquire...
Be boom. They don't want that.
In the overall industry you're in today.
So, I mean, are you seeing certain sectors? You talked about technology to help sort of decipher, I guess, the books to make it happen. But is technology an area where we may see more deals?
Yes, every company wants to acquire tech, but for us, we're seeing the TMT industry, technology, media, telecom, is probably the most bullish. They're out there trying to do something to differentiate their overall business as a whole. That by
I'm here.
For us, but also private equity. The money's on the sidelines to be deployed, and they want to do so now.
I'm here. How do you do? Did you miss me? Someone miss me? You miss me? 6315s. Well, it looks like I'm going to have to go back to Nicole because I don't think Caroline's ever going to come back. And I had the biggest crush on her. Resistance level to break on Tesla, 334.93. SpaceX warns investors Elon could return to U.S. politics. Bloomberg sucks. Tesla registrations fell in California 21%. Who gives a shit? California sucks. I'd have to have a real hot woman if I wanted to stay in California. That'd be the only thing to keep me there. Oracle's one that had a real good run. Okay. We got a yin yang right around 225. Another $12 dip. A little above 225, so I'm gonna set my alert off at 228.65. Now this is something I've told people in the past. When you're not in a trade or you're in them SPX calls went up pretty good. The 6320s, when I got here they were 45, now they're 80. So there's always something to do when you're trading. You can be looking up, setting alerts. You know, you need to get accustomed to set at least 10 alerts a day. Nice bounce there, Sheba. Triple top coming up. See where the body of this candle is right here? I'm going to put a line, price line right across, so I'm going to show you something here. right on the body, not the wick. Look where we stopped at. So when you're getting ready to exit a trade and you don't know where resistance is, we got a triple top. What are you going to do? What are you going to do when you have a double top? What are you going to do here at the triple top? 105 now. Yeah, that's right. Scale out, hold a few. Use the body of the candle. So the body right there, straight across. You'll know to get out of that trade. Buy the dip at the 200, run it back up to a triple top, and say, job done. So I'm tempting to do a video. Let's do it.
down 95%. Have you ever considered selling?
No, I can't.
You know, I'm sitting here this week thinking we were going to have pullbacks and stuff. And on the 20th, I posted this here on X. It's a laughed out loud. Use patience this week. And I didn't use my own things.
It's a... no.
You're down 95%. Have you ever considered selling?
No, I can't. It's a... no.
You're down 95%. Have you ever considered selling?
No, I can't. It's a... no.
So when I was down 95%, 90, 80%, I didn't sell. And it paid off. But it's not always going to work out that way. But 9 out of 20 to 30 times, 20 to 30, 40, 50 times, it will work that way. It's just hard to hold on when you're in the hole. And you don't know. Especially if you don't have the experience in seeing it happen every single day. I mean, I lost 20 grand because I sat here and kept selling at lows and then watch it just bounce back up and go, damn, man, if I held, I'm I'm the only one that's got the balls to say that. You know, it's an unspoken rule you're not always going to win it. But when you get stuck, and I've been on a roll here of getting stuck a couple of times in the past couple of months. And that's the only reason for that is because the fat cats say we're overbought, but the retail trader keeps buying the dips. So it's throwing these nutcrackers off. We're technical traders. One of every 1,000 might be a fundamental trader, and there are 99% fundamental traders. And they're assuming that, and they say the market is forward looking, and I go bullshit to that. I don't think it is forward looking. I think that's a big lie. Because if that's the case, we would be sinking like you'd never seen anything before.
You're down 95%. Have you ever considered selling?
No, I can't. It's a... no.
You're down 95%. Have you ever considered selling?
No,
I can't. No. So I had to get my mind off the market and occupy my mind with music that only makes me happy. And it keeps me from staring at the chart all day. It's like this one right here, Oracle. Now they pumped the manure out of Oracle, and this thing is way overbought. And we were at 120. Now listen to this. That's a 3-month chart. We were at 120 bucks. Why did they like that so much at 120? So let's pull up the daily. I want to ask myself, why did they like that so much at 120 bucks? There's your answer. Triple bottom on the daily. Triple bottom on the daily. Tempting to short this sucker, but I'll wait for it to pull back to my support off the 21 to buy the stock, to buy it maybe. But triple bottom, and then on the weekly, see that's up what? You're up 130%? Are you kidding me? In 3 months? And they're talking depression and recession and tariffs? Don't believe what them guys say. They're just trying to mold on the weekly. Look how beautiful that is. The 200 EMA and SMA, the 200 EMA. Put that 200 EMA on your charts. Maybe you might not like it, but I'm telling you what, I've seen a lot of, that's a fast action moving average, to where the 200 is a slow action moving average, and if you wanted to wait for the 200, you'd have never took that trade. SMA. There's another reason why I would have went long on that trade if I saw that. On the weekly. We got a gap here, so I'm waiting for this gap. I'm going to put a price line right across that gap. $227.20, somewhere in that area. So we got another $10 to drop. I have 335 on listed, and we got a triple top up here. So if it breaks 335, you get 428. Mimi. Yesterday it pumped Reddick. And it pulled back. Let me see here. Well, let's look at the weekly first. So we're on the 9 on the weekly. See what my alert is. Alert set for the SPY. We broke resistance. I had the resistance set on the SPY. Double top. Open door stock surge again. Steer clear. Steer. What the heck? Am I not what is stir? Steer? Steer? Is that steer? Yeah, that's what it is. Steer refers to several things. Castrated male bovine. Oh, a steer is a cow that's had its nuts cut off. You might get your nuts cut off if you trade Mimi stocks. What was it? What's that Trump stock? What is it? Trump. Damn it. What is the Trump stock? I can't remember. Rumble, RUM is one. DJT. DJT. And then you got rum. Then bind. SPX is at 155. The 6320s. What'd you think about that, Sheba? Anybody see Ozzy Osbourne? I got a story about him. Yep, Ozzy Osbourne had a concert here in Springfield, Missouri. So they told him he could have a concert here, but he had to put a shirt on. He wasn't allowed to have his shirt off. So he comes out on stage and his shirt's off. I thought it was kind of hilarious. Don't tell Ozzy what to do. Well, if I was to play an Ozzy song, it would be... Is he still alive? He didn't pass away, did he? After his big concert. I'll sing an Ozzy song. This is one of my favorites. I saw Black Sabbath too. tribute to Ozzy Osbourne. Let's have a good day. My ding-a-ling went off. I know Willie's about to go. Ding, 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 ding. That Washboard Jim's about the craziest person I ever met. He's one of the sexiest guys I ever met, too. especially at his age. Yummy, yummy. Do. Watch them block this. I bet you they do. So we'll see if they block it. I didn't think about that. Copyright, Ozzy Osbourne. Yes, you call?
Okay, so kind of put together original how you're getting a divorce.
Yeah, I figured that.
Okay, so she has filed a restraining order against me, and she's trying to get me put in jail. So
You didn't hit her?
In the past, we both have.
Yeah.
We got into a deal.
Yeah.
But we're both guilty of it. But no, she has got a restraining order against me. So I cannot contact or have anything to do with her. But also my family members also. Okay. So
Us?
Yeah. So like, if my friends or my family try to contact her.
Oh, yeah.
Or whatever.
Yeah, I got you.
Then it's going to violate the deal, and then I can go to prison for at least 5 years and have to pay $10,000.
God.
So I'm just kind of giving everybody a heads up that for them not to contact her, and if she tries to contact you guys, do not respond.
Do not respond.
Yes, because even if she I don't know.
God, she's nuts.
Every detail, but that's what the cop basically told me.
You go to your work?
Yeah.
What a nut.
Yeah. But yeah, so that's what's up, and then I got.
Did you get all your shit out of there?
No. But I got. So I have to go to court over this bullshit in August. August 6th is when I got to go to court for that, and then the divorce deal is a whole separate thing. So.
Wow.
But I'm just trying to get everybody.
She's gonna try to screw you over the property, or?
She can't. Well.
Ours.
Ours she can't touch, but the other one I'm just going to. I don't want it.
No.
So.
You ain't had no kids with her too, so that's a good deal.
Yeah. So. I'm going to make her refinance the property and get it in her name, the mortgage.
Yeah.
And if
She probably can't afford it.
And if the mortgage company says no, then I'm going to sell it.
Yeah.
So, whichever path gets it out of my fucking name, that's what I'm doing.
Well, I'm sorry to hear that. I know you loved her.
Yeah.
Okay.
So
I'll be good.
I just want everyone to be on the same page here.
You got the lawnmower though.
Oh yeah. That's why. Okay, so that's why she served me papers, because I didn't listen to her, because she told me not to take nothing from the property.
Yeah.
Saturday, and I did. So now she's making me pay for not bowing down to her.
Well, you gotta mow the yard.
Yeah, but
She's a bitch. Redheads are tough.
and then I explained that to the cop, and she said there was no criminal acts. I was like, yeah, I know.
God.
So yeah, it's about to get real crazy here. So
Yeah, don't do nothing stupid. Just mind your own business. And
well, that's what I've been doing, but it's just.
I don't think you got an anger side to you.
I do.
Do you?
Oh yes.
You ain't gonna ever whip my ass, are you?
It's not in my plans. You know what I'm saying?
Yeah.
But
I don't think I'd ever make you that mad.
no, it takes a lot.
Yeah.
It takes a lot. So.
Well, I'm with you, buddy.
Yeah.
Okay.
But, yeah. So just if you could do that for me, that will help me out greatly.
Yep.
So.
And I won't say a word to nobody.
All right, I appreciate that.
Yep. I just hope it works out somehow.
Yeah. I just wanted to be over with and settled and move on.
Okay.
So,
You ever need one to talk to, you call me up. Before you don't do nothing out of line.
Oh yeah.
Okay. I know you loved her, but that's the way it goes.
The way it goes, yep.
Bye bye.
All right, well, I'm gonna get back to work and everything, but I appreciate it and thank you.
Yes, sir. Bye.
All right, bye.
Well. Well.
And maybe by the November prints would be the latest I would expect to see a peak and see numbers lower from there. But yeah, I don't think this is about inflation. I think the concern is about growth and what the tariffs and the trade situation does to global growth and what the impact is on the U.S. And I expect it to be a slowdown. With that slowdown, I think it's going to be a policy easing from the Fed, and we're looking for 3 rate cuts to respond to that. So 1 in September, 1 in October, and then the last one in December this year.
And what do you think market response will be when we start to see that observable inflation in the prices of goods being put onto the consumer?
Did they bring you on just to talk about inflation, Chick? They're trying their best to bring this market down. Schwab used to hardly ever talk about it. Now they just every single day, especially this chick. I want to ask her if she ever worked for CNBC. She just ruins my day. We're back on top of the megaphone. We have to hold it. We're at the 63. Oh, looks like my nephew's going to go through a rough divorce. It's interesting on the hour time frame. Funky's /ES bounced right off the bottom orb this morning. Same thing with the 30-minute. I don't even think I noticed that. If I'd noticed that, I probably would have loaded 100 of them contracts at 25 cents. For sure. Did you see that, Funk? This morning? And then double bottom on them wicks. So YouTube, that second hour on the pullback on the 30-minute and the 1 hour on /ES. Yeah, I made almost $8,000 on that trade. Nice bounce off the AMD that I called this morning. Apple had a double top. Meta not much today. NVIDIA to the 200 off my support level. He has died. I didn't believe that. Wow. Huh. Wow. The legend. No, he's had a full life, that's for sure. Well, Huh.
You know, these guys are on track to deliver. They expect to drive about $500 million of free cash flow for the full year. So definitely free cash flow generative in a tough industry for that.
Well, certainly an attractive target they have in place. Waiting for those earnings. We've got, some other General Dynamics coming out, Booz Allen Hamilton on Friday. What's your overall outlook for the defense sector, especially considering all the geopolitical risks that we have currently?
Yeah,
You know what? You're a
skank.
skank.
That you have to be specific in what you're buying. If you owned a basket and you own both Northrop and Lockheed, you're zeroed out on the day. So I think you need to pick your spots carefully. Don't be afraid to look at some
You always
European manufacturers.
pick your
because
spots
if
carefully.
It's their target of growing defense spending to 3.5%. That's another incremental $500 billion of spending that's coming out there. U.S. is $1 trillion market, so keep your eye on names like Rheinmetall, BASF, Safran in the EU as well, because it's truly a global market. It is a growth area, but the companies have to have a tight control on margins, efficiencies, and make money for the stocks to drive higher. I think it's a great sector for value investors to think about, like industrials in general, because you've got assets, you've got free cash flow, and as we see today, that's really what drives share price performance.
And one last question for you, Christopher. As the Golden Dome is now getting funded and certainly being highlighted with the issues happening abroad, how is that going to impact and change the defense sector as a whole?
Yeah, I think it could be one of the biggest defense type programs like missiles since we saw, the Minuteman systems and those silos they were building all over the country in the 60s. Amentum is set to potentially be involved in that. I would expect Lockheed to be involved with that through Patriot and THAAD as well. So I think we really need to see, that go from being discussed and appropriated in Congress for some of those contracts to be actually awarded to see what can happen. But obviously that's a lot of, defense investment on the home front that could be very interesting, and there will be big maintenance contracts for all those systems as well. And sometimes those go to companies like Amentum or the primes themselves. So it's a lot of spending on the home front.
Some great insight there. We really appreciate it. Thank you, Christopher, for being with us today. That's Christopher P. Davis from Hudson Value Partners. And coming up, we have Options Corner. Rick Ducat will join us next to look at Lululemon after a downgrade over at JP Morgan. Market on close. We'll be right back.
Yeah, that kind of takes all the steam out of my wanting to play this last trade. I don't know if I should be trading now. Anybody in here seen Ozzy Osbourne? I've seen him 3 times. Rob's here. Hmm. 3:30, 2:30, 3:30. We pulled back to the megaphone again. I'll just wait. Could see more pullback. fact, the 3310s puts these 150 are tried. They got the, I'm looking at the 6310 puts. I'm gonna get these here. $150. No. Yeah, it don't look like it's going to do it. It better do it. I'll get out of here today when I get ready to leave and go out by the pool. And double top. $150 and 95 with an average of 128. It's 237, 337. Huh. Well, they're saying earnings have been mixed, and I figured they'd be good. Average earnings. The Dow Jones Industrial was up 4%. Well, you remember all them contracts that were coming in because of the war? We more or less fed them. Okay, I think I'm going to stop out here if this ain't going to... Just keeps going. We're at $1. Drop more. Drop, 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 drop. You'll probably stop here. But 17 minutes left, so I still have time. I see it hit the 63. $90. I can't listen to this girl. She depresses me, especially when I'm in a trade.
Cruise ship that you have one side of the
The
aisle
Lightbridge
saying that
Fuel's
these crew members
main
are being
advantage and the main
falsely
interest of
accused
the
and
utilities
targeted
that
because you have
we've always
ICE
been talking
involved, you
to
have
is
federal
that they can
agents.
get more power out of their existing reactors or new ones using Lightbridge fuel. So our fuel can take existing reactors up in power by about 17%. For some reactors, it'll be less,
one
for
support.
some, maybe even a bit more, but about 17% more power from an existing reactor with this kind of fuel versus the current kind of fuel. And for new build reactors, about a third more power. So you could build 3 reactors and get the power of 4.
So between the existing reactors and the new reactors, which do you see as the more immediate opportunity?
Oh, the existing reactors, because there are hundreds of them around the world that have already been built. 94 of them are operating in the US. And like the executive orders say, this focus on the existing reactors to get more nuclear power before we're even building new reactors. And as we roll out light bridge fuel into existing reactors, that will, we think, help lead to new reactors being built with even greater benefit.
And one of the major emphasis in the executive orders, and also I think concerns generally just from Americans, is this need for enhanced safety and some of the fear that's tied to the deployment of nuclear energy and technology. Can you explain, I was reading a little bit in some of the Lightbridge notes about how your fuel's design actually improves safety margins?
Yeah, tremendously. And as we get to tripling nuclear globally, which is a goal the US and many other countries have signed on to by 2050 to have that done, we're talking about potentially hundreds of new reactors being built in other countries that don't have
Yep,
them
looks
now.
like I pooped this one away.
All over the world, and more than ever, it's going to be needed to have safety by design. That those reactors, just the way they're operating, are safer. And the light bridge fuel operates about 1,000 degrees Celsius, about 1,800 degrees Fahrenheit cooler than the current fuel does in reactors, even while providing much more power. And this very high-tech fuel brings about tremendous safety advantages to reactors. And so we think it's very good for the reactors that already run in the US, but especially as new reactors are deployed around the world, that enhanced safety will, I think, be even more important.
And we have to say goodbye soon, but while I still have a little bit of time left with you, Seth, I would love to talk just lastly about this concept of recycling this nuclear waste. I know a lot of people focused on nuclear waste and, everyone has seen the movies, but you now have a process that's being tested to potentially eliminate nuclear waste. Is that correct?
Well, we believe that the current nuclear waste could be reprocessed, and both the uranium and the plutonium could be reused in nuclear fuel. And the plutonium in particular, we believe the light bridge fuel could be used more efficiently than anything else to eliminate it while generating power.
Come on, drop.
We have a study that's been done in.
Now I'm really testing it here. It's either get out, take a small loss,
plutonium disposition.
or just give it a few more minutes. I think I'm going to give it a few more minutes. There's 115. Come on. Now I'm definitely at another support. 125. I'm even. Come on, one big fat candle. Take me to the 1, 2, 3 bits, or get out now. I'm at 10 minutes. I'm talking to the guy I went to a concert with here in Springfield with Ozzy. He was told to do 2 things: to wear a shirt and not to bite any bat heads off. And then we saw him at the Shrine Moss with Black Sabbath. And I was real young then. Neck's killing me. Well, I didn't see that coming. The Aussie. KSS has them weird lines again. And the fat fingers. I'm gonna have to get out of this trade. I don't think it's gonna work. Get it down here, I'll win. That or I get out now, because this is second touch. Well, I got stuck. I doubt if I ever get out of this. Darn, 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 darn. You better go ahead and sell it. I can take this loss. It's nothing today compared to what I made. And I probably will. I'll give it 1 minute. Oh, my watch stopped. Not sure I wound that up today. That's funny. I cut it. Stopped right when I looked at it. I didn't lose a few seconds. Okay. Dadgummit. That sucked. Very interesting day. Bam, bam. Look at that. Why couldn't it do it earlier? I don't know. But that's that. So, I got to keep in my mind that the market is definitely overbought. And the dips are a buy. I loaded up big time on them on them calls this morning, and that really was probably one of my biggest paychecks in a while. But I didn't see it coming up like that. I was just going to try to get out a little above even. But it just started taking off. I just sat on it. So I'm going to get out of here and make my little bitty dinner. I like to eat early. Got a long night tonight, so I want to read my Revealing Jesus book. I told people in Sunday school that after I finished this book, I'd let the next person want to read it. So that's what I'm going to do. I'll finish it this week. Tonight's Tuesday. It's a long night, so I get up early. And I think that's about it. I wish everybody a safe evening. I want to give thanks to everybody in here. Franchise, Richard, Sparks, Rob, Magnificent, Livid Goose, Just Me, Jesse, and Bug, and Angel, and Washboardjim. Oh, that's me. So, I hope you're getting out of... Yesterday, I got a little upset. I come in here with a bad, not knowing if I wanted to do this anymore. I'm getting tired of it. You know, I felt like I was not appreciated yesterday by one person that I know. But I think you're going to hear that all the time. I've seen it happen over and over and over and over again on other people. I don't have, I have this one rule about life. If you screw with me, you're gone, you're history. I don't want nothing to do with you. And that's kept me out of jail, kept me out of trouble, kept me from getting killed. Kept me out of fights. So tell somebody you love them. My best message to give. And I'm gone. And again, thank you everybody. If there's anything I can do to improve, just let me know on my call outs. That's your wife's rule. So, I try to make it fun. Sometimes I go a little bit crazy. But if there's anything I can do to make it better, just let me know. And I'm going to go play a couple Aussie songs. And I haven't picked up my guitar in years since my dog died. And I played, but not much. I went 7 years without playing hardly. From playing every day. And it's true as stocks. You hit different plateaus, and you know it when you hit one. And I tell traders never stop learning. Try to simplify it and be patient. I pick things up from everybody that posts the charts, things like that, so I'm always learning, even at my age. I'm feeling real good, healthy-wise. I kind of was worried there for a couple months. My eyes were heavy, and I'd want to go sleep. So it's important that I'm sleeping better. I sleep 3 or 4 hours, 5 hours at a time now, and I'm going, what the heck? I never done that before. I'm always having to get up every hour and go pee or something. I got lucky today, that's for sure.